What's up, everyone? Welcome back to the show. This is Tasty Live. My name is Mike. I'm here with Jermal. It is Thursday, and we have kind of an inside update for now, but who cares about the markets? The Knicks won after coming back from, 29 points?
I can't even think about the markets yet. I'm still tripping on last night. That game was absolutely crazy. I'm sure a lot of people didn't stay up and finish watching it. I thought about that. I'm lying. Now, I knew I was going to stay up and watch the rest of that game. That was... For those who didn't see it, the Knicks were down. First of all, they
down bad.
Terrible. Yeah, down bad. Every game, there's the crazy part about is stats, and it's dope because the team has talked about how we're about to add a lot of stats to what we do here day in and day out. They kept flashing stats after the first quarter. There's never been a team that has been down at the end of the first four quarters in the finals. That's the Knicks. They've been down at the end of every first quarter. Then you had halftime. They were up. The Spurs were up 27 at halftime. That's the largest lead at halftime in finals history. We're talking 75 years of the NBA. And then after that, it was just crazy.
And then they lost. That was crazy. I can't believe that.
I can't believe what I just saw, dude. Like,
I think
you know what's crazy? You know how I know it's crazy? Both of my sons, who are 22 and 13, they never sit down and watch games. They locked in on that game from halftime on. They did not move.
Yeah, there's something about it. All the celebrities there, and then the comeback, and just the way that they won with the missed three, just like a chucked up missed three, tip in by OG. Insane.
Game two, the Knicks were up, and what the Spurs had locked down on D towards the very end of the game. A lot happens in a game. It's not all just one at the end, but everybody focuses on the end. Spurs were up. Spurs had just locked on D. And then they got the rebound, remember? And then Wemby throws that pass, steal. The Knicks hit 2 free throws. Wemby misses the game winner, game over.
Yeah.
Close game. Mm-hmm. Last night, they're up 27. Even with all that, they still had a chance. And it's just craziness. So it could easily be 3-1 Spurs, but give Knicks credit. It's not about like who lost it, but give the Knicks credit, dude. Like they were down 27. Most teams would give up. Those dudes never looked like they looked defeated in the first quarter, but towards the end they were locked in, man. I just love sports. I love that kind of thing about sports.
Yeah.
That's just amazing, man. I mean, it's absolutely amazing what happened last night.
Yeah. Just like anything else, you have your tail risk events, and that was certainly a tail risk event.
Yeah. There's no doubt about
all things considered. But yeah. Good for Chris Vecchio. I'm sure he hasn't slept a wink.
I mean, he hasn't. I know. I was tweeting like late last night. I saw him. He responded to some of my tweets like hour after I posted them. And again, he's an hour ahead of us. You know he didn't. I mean, he's our resident New York Knicks fan. Just craziness. That was absolutely nuts.
Yeah.
I can't get over it. I can't. I've
seen
a lot.
Good for all of our resident New York Knicks fans. Yeah.
No doubt.
I mean, it was crazy. Absolutely nuts. Yeah. Market's not doing too much here. We've got silver down 2.7%, down to 62.9. Natty gas down 1.5%. Gold also down 1%. And then to the upside, you've got Bitcoin, ETH, crude oil, and whatnot. So yeah, we will see how this plays out. But given the SPX move for today, we've got 79 points implied for the 0-day options. I tried to buy the dip yesterday with a short put spread, even after the 50-point sell-off, and that didn't work. So it's been a volatile market. Maybe 79 points feels light.
Yeah, I think I only did like 3 trades yesterday, or the Oracle trades, essentially. Mm-hmm. Actually, I ended up doing 5. I forgot. Towards the end of the day, I put on Tesla calendars. Next Friday versus this Friday, long next Friday.
Mm-hmm.
Just because, why not? Let's see what happens. I mean, we bought the Oracles, and that didn't work out. Oracle earnings. But, that was one of the we talked about it. Like, we knew. I actually thought the market would be down more with Oracle being down because I figured semis would be selling.
Yeah.
And maybe that's yet to come. I don't know. I did not do the SPX trades as many as I did a couple of days ago. I tried to get some of those same trades on at the end of the day. I tried to get some calendars, but we didn't get as low as we did. I didn't force it, thinking maybe we'll have that opportunity. Because market's been pretty weak all.
Yeah. Crude oil chopping around here, sitting around 90 now. I'm gonna have to roll this short put, but there's still $100 of extrinsic value here, so I might just hold it till tomorrow morning and then remove it. But yeah, just gonna roll it out a week, collect some more premium, stay in the N contract here before we have to go to the Q contract, which is now about 1.5 points away from the current price. So this backwardation is going away, but still back months here elevated at 75, 76. So not out of the woods yet in terms of heightened crude oil prices that will affect all things.
Yeah, this is good because, I think we've been pretty clear about the fact that we don't trade right away on the open unless we have an axe to grind and things we want to do. But we do look at positions. We do look around and look at things. I mean, I know I do that a whole lot. I know you do. We look at our book and, flip it a bunch of different ways, deciding what we need to do, when we need to do it, if it's actionable now or maybe a week or maybe a couple weeks. And that can be tough, right? Because you're looking at things and you're saying like, I'm not ready to do anything with this, or maybe I need to do something with this, or damn, I should have done something with this a couple of days ago, or those type of things. I mean, think about that. Speaking of, I did hold on to the CME and SIBO trades. Those have been bouncing nicely.
Yeah.
Amidst all this volatility, which is fascinating. Like, that's not uncommon for SIBO to bounce because everybody's like, oh, VIX is making, moves, and so therefore SIBO's making money. That's kind of the thought process. But CME bouncing during all this volatility is, I don't feel like we see that often. Like, this is typical. When it's a volatile market, SIBO is typically getting bought up. But CME, not so much. It's interesting, too, because SIBO is, like, conflicted about that internally. It's almost... It's funny. When I worked at a prop firm, 2008, everybody else is suffering because the market is falling. Everybody's pension is like not doing well. Our firm is killing it. I mean, absolutely killing it. Like, we ended up having a party in the summer where John Bon Jovi was the, like, it was one of those parties.
Naturally.
And the whole time, the founder of the firm is like, we're having town hall meetings, and he's like, be aware of the society. The regular society is, most of society is struggling right now. Be aware of that. I mean, I got a pretty decent bonus this year, but not enough to justify what he said when he goes, don't go out and buy a Porsche. Don't go out and buy a Lamborghini. Don't do that type of thing. Most people are struggling. So they made people aware of that. And honestly, SIBO kind of has a similar culture. Like, when things are going bad and VIX is doing well, the stock is rising, and they're always like, be careful of talking about, what's going on, or they're very worried about that type of thing because, it's a really good company. They're really worried about that type of thing. So it's kind of fascinating when that happens, and watching this phenomenon, you see it. Like, if we have a crazier market, it's going to go up. SIBO stock is going to go up. That's one of the things that happens pretty frequently.
Yeah. It's just, it's a natural phenomenon of financial markets, and anyone that works in a broker industry, it's the same thing. It's like when volatility kicks up, markets are crashing, like that's when the volumes are the highest, just because more people are involved and everyone's paying attention. Where when the market's drifting higher slowly, nobody's paying attention. They're all just doing something else.
Yeah. I know. How many questions have you gotten in the last couple weeks?
A lot. Yeah.
From friends and family and
like, what's going on?
A buddy hit
what
me
happened
up
to
yesterday.
Microsoft?
A buddy of mine hit me up yesterday about the IPO for tomorrow, and I guess he's a Fidelity guy, and he's like, should I do this right here? And I was like, he's like, should I get in on this IPO? And I was like, well, if depends. Are you doing this with today's money, or are you doing this with future money? If you're doing future money, then yeah, sure, why not? But if it's something you need, then don't do it.
Yeah.
He's like, they also have a lockup for 15 days, so probably shouldn't.
Yeah, I hear you. Well, markets aren't really moving too much, but we do have a very special guest to bring on to the show right now. Sven Carlin, how we doing?
Great, thanks. Great to be here.
Absolutely, thanks for coming on. So these markets have been kind of crazy. The vol structure has been trying to flatten out. What do you make of all this, and what are you focusing on?
Well, as a value investor, I focus on the fundamentals. So the short-term volatility, this is just the beginning because the markets are totally disconnected from the fundamentals. and therefore you can expect a big party for traders in the next decade.
Yeah, I mean, we've seen the rally from the lows here. We see the valuations. When you say disconnected from fundamentals, is that what you're referring to in terms of just getting through these earnings announcements and seeing the big revenue and valuations? Did we lose audio? Or you got
No,
it?
it's okay. So when it comes to revenues and earnings, it's all circular. You have to look at the end user or the marginal supplier of those things that everyone is using. And the fact is that the market, through all these venture capitalists, all this funding, NVIDIA funding smaller companies, they are just propping artificially earnings, but the market is bleeding money. True earnings are negative. And sooner or later, when it comes to accounting, this comes out, and then you see the real situation, what's behind the curtains now.
Yeah. And I think when you look at some of these things, so you can see this on the Taste Trade platform, which is always interesting. If you go to the news and research tab, you can click on financials and you can just see the income statements, balance sheets for a lot of these high flying tech stocks. Like a year ago, we were looking at 40 billion and now we're looking at a double of that, 81 billion. NVIDIA, massive valuation in terms of market cap as well. But yeah, I think it's all, the crazy part to me and the interesting part to me is that all of these companies that have these higher valuations, they're all doing this together. Like NVIDIA has deals through 2027 and beyond with Microsoft and all these other companies where it's like they're kind of relying on each other. And if something breaks, it could bring the whole thing down in a quick way. Mm-hmm.
So it's not if something breaks, it's just when the truth comes out. Ooh. Because at the end, you have to see, okay, everyone is investing in AI, in the revolution, in this or that. Demand is insatiable. Of course, demand is insatiable when it's all free. So I can burn as many tokens for a few $100 per month. And I'm sure that what I'm doing costs more than $300 per month. That's not a sustainable business model. And sooner or later, especially as you look at these investments, just a few hyperscalers going for 1 trillion investments into AI, it's crazy. And this will be reflected into bigger depreciation and amortization down the road, and therefore declining, not growing earnings.
Yeah, I think that's an interesting point, especially now. Like I was talking to our co-host Gus, and we're like, maybe we should just make a driving range and create a logo. I'm like, give me 1 second, I'll create a logo on ChatGPT right now. And like these things that you couldn't do before, where you'd have to hire a designer or outsource it, you can just do it immediately. And to Sven's point, like you can do it for free now on a limited basis. You get a few queries here and there, but to your point, like at some point when they know that demand is kind of faltering, they'll probably jack up those prices and make it a pay-to-play model, and that could shake up the environment we see today.
I know it is a crazy environment. And speaking of environment, I mean, we're in this point now where you got these equity raises that people have been talking about, and a lot of these names. Oracle, obviously, we just had earnings, and that's being one of them. SMCI. Talk to us about that, because I know that's something that you've focused on a lot.
Well, when it comes to all these equity raises, and this is the discrepancy between earnings and cash flows. If you look at the earnings, everything looks good, everything grows. But if you look at the cash flows, those are going to negative cash flow yields because everything is invested. In that way, as everything is invested, revenue, circular economy, you prop up the earnings now, but you will pay the price accounting-wise down the road. And just from a depreciation perspective. And we have no idea whether all these investments will be profitable at all down the road. If AI is so smart, somebody will find a way to do this cheaper, and there goes your profits.
Yeah. That's the way of the world, right? Look at a model, see the model, find a way to do it cheaper, and the original model maker, for lack of better phrases, could be out the door. We'll see.
Today's SpaceX IPO is the perfect example of that. What did Elon Musk do? I don't know. The cost to send a kilogram into space was $12,000. With the new Falcon Heavy rocket launcher is $2,000. So the cost for Elon Musk is now 20% of what it was just 10 years ago. We can expect the same for AI, and therefore profits go down the drain.
So talk to me a little bit more about SpaceX, because I've had this theory for many, many months that when SpaceX IPOs, you have so many people trading Tesla as a proxy to get exposure to SpaceX. Speaking of valuations being sky high, like Tesla, the stock price and the valuation is way higher than the money they actually make with electric vehicles. What is your take on that? Like when SpaceX IPOs, do you foresee liquidity coming out of Tesla, or do you think that they kind of move together in a correlated way?
I think there is so much liquidity chasing whatever is going up now. And if you look at SpaceX, just 2 years ago, the valuation was $200 billion. Now we are closing into $2 trillion, which is a 10x over just a few years. And simply, people are chasing that money. Everyone is a gambler today. So I don't think that it will suck up liquidity, because there is so much liquidity not thinking and happily chasing SpaceX at 100 times 2025 revenues, despite the fact, just because of the fact that it might go up 50 or 100% more next year.
Yeah, that's a good point. And we're expecting tons of volatility regardless. We're expecting the stock price to fly around. We might be seeing options on SpaceX maybe on Tuesday, Wednesday at the earliest. But that's going to be another interesting front, because we'll have the options listed. They'll be pretty wide at first, but I'm really intrigued to see just how narrow those bid-ask spreads get and how much activity we get in that product. But it's going to be one of those products that has like 80 to 100% IV at all times, I would imagine.
Yeah, you know it is. I mean, that's going to be, when you look at Tesla vol, you see what it is. You imagine it's going to be just a little bit above that. So it's fascinating. It's going to be,
but that's exactly
that. A big week, you can tell.
Exactly, that is the problem with this market, because everyone is about where the price is going, what's going to happen with the option, how can I gamble here, prediction markets, trading there. And nobody's looking at the elephant in the room, that it costs to live on Mars, it costs to send satellites in space, to make data centers, solar power plants, or things like that. And competition is on Earth already. Therefore, if you're an option trader, just make money on the way down if you can.
Love it. Fair enough. Well, appreciate your time, Sven. Thanks as always, and we'll catch you next time.
Thank you very much.
Absolutely.
Happy to see you.
Likewise. E-minis up 30, NASDAQ up 225, the Dow and the Russell up as well. Bitcoin and ETH up 1.5% and 1.2% respectively. But yeah, we're going to take a quick 90-second break. We'll be back on the other side of it. You're watching Tasty Live.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Grow a strong community with tastytrade's referral program. When your friend joins tastytrade, you'll both receive $100. As your community grows, you get more bonuses. Only at tastytrade.
First thing about tastytrade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that.
Investopedia says we're the best for options trading, period.
Everyone, welcome back to the show. My name is Mike. I'm here with Jermal. E-mini's up 36, NASDAQ up 250, catching a little bid here pre-market. We've got another guest for you, a long-standing guest on the line, Mr. TP. How are we doing today?
All right, Mike. What is this? Doesn't anybody show Oracle any respect? Stocks down, spoos are up. That just it's shit. You know, I don't want to get into the whole morality thing on the show, but that seems like it's morally wrong.
Think it's disrespectful?
Hey, I mean, listen. If Oracle was up, we'd be talking about it because we'd have some profitable trades. But hey,
yeah, I know, right?
these calendar spreads we bought are not going to be looking good on the open. But yeah, I think it's definitely interesting. We would have expected, and Jermal pointed this out, like if Oracle is going to be down 10% and the market's up, like that's a little ominous.
Well, so yeah, and I sold the, which one did I sell? The 82, 85 put spread, I think it was in Oracle. So I'm right there at my long spread. I've got another day to go. I'm going to hang on. I don't care. This is how I trade earnings, which I don't do a lot, but I'll use defined risk trades only because of sort of thing. My earnings trades are pretty much, a flip of a coin, really. It's not necessarily my bread and butter, but I wanted to just play Oracle. Just something to do. What's NVIDIA doing right now? What are big names doing?
I see he looks that up. When you do earnings, do you trade like in the did you trade in the near term, like weekly cycle?
Yeah.
Or do you trade like the 1 week out? Do you do? Okay. Just curious.
I do like a couple of days before Jermal, only because it's really the event is earnings, and the closer I can trade to earnings, and I don't bother rolling stuff. I don't bother adjusting stuff. It's more of a binary trade for me. It either works or it doesn't. And that's, Jermal, to your point then, that's why I just use verticals, because I can afford to do those a couple of, 2 or 3 days to expiration. Volatility is usually high enough in those earnings stocks that I can get the credits I want for the verticals. So I'll sell vertical 2 days to go. I don't want to push it out any longer unless some other compelling reason to do that. But so is NVIDIA up a little bit? I thought I saw, Mike.
Yep.
Yeah,
it's up 2 points.
Yeah, and so this is. I just wonder if Oracle is the outlier here in the quote unquote AI space, which it's what's Intel INTC.
Well, to your point, the interesting part, I don't really do the read-throughs too often on many of these earnings, but I think
Intel's up a lot. Not to interrupt Jermal, but Intel is up. Anyway, Jermal, go ahead.
I think I vaguely saw that they were talking about raising more capital, and maybe that's why they got punished last night. And that's been the story, right?
Yeah, that's part of the story, but everybody is raising capital, and that's the whole. It's the whole wealth shift. Right. Instead of borrowing money to build, steel mills, we're borrowing money to build data centers and AI. Right. And I made a comment on Twitter yesterday, and this is related to what Jermal, you and I were talking about yesterday, is AI is a natural resource. And you invest in it, you try to exploit it and let people access it and build tools and products from AI, just like you would an acre of corn, right? And so that's why, it's interesting that Oracle is the outlier, it seems, apart from Intel, NVIDIA, and some of these other stocks, and certainly the S&Ps. Crude oil is what? Crude oil is back down under the 90 handle again.
Mm-hmm. Well, I thought you're right. Everybody is raising capital. I mean, there's just not enough money to go around to do all the things they want to do. I thought they were one of the ones. People were talking about Oracle raising capital and selling bonds like months ago, I feel like 3 months ago. Like I thought they were already kind of in that situation, right?
There's no mystery to this. They all need cash. And one of the stocks like Amazon, for example, one of the warning signs of Amazon a few weeks ago was they were going to use up all their free cash flow to build stuff. Right, to build this AI infrastructure. Got no problem with that. You want to do that, that's great. I guess if you want to continue to do that, you need to borrow money. They're doing so at higher and higher rates, I imagine. And to the whole SpaceX thing, if SpaceX comes out, sucks up a lot of money into hey, let's play in Elon Musk's new toy. Then it's going to put more pressure on the interest rate payments for these companies. Is that going to make a big difference long term? I don't think so.
Yeah, I mean, dude, I always forget because this is about this stuff. You're a software guy, right? You're a tech guy. I mean, like this is.
Well, I build trading platforms.
Yeah.
Build Tasty. I understand the expense of it. This is it's a little bit different though, Jermal, because of just the huge server capacity, the acres and acres and acres of servers you need to, I can go on Claude and figure out how to plot a chart. Okay. I press a button and 10 seconds later, I get this nifty chart. I don't have to spend 3 years figuring out Python formatting codes. Right.
Thank God.
And to do that, you need a lot of, I guess. I mean, you two could tell me in 2 seconds, but I don't want to bother you guys. So I bother Claude instead. And to do that, it takes a lot of horsepower.
Yeah.
So it's not just software development. It's not just cool trading technology. This is a whole different league.
Yeah. It's going to be interesting to see how it plays out, especially with some of the big rallies and huge sell-offs we've seen in like Intel, Hewlett-Packard, Dell, all these companies that were the talk of the town 2 weeks ago. Like nobody's talking about Dell anymore, which is wild.
But like I tell my kids are in their early 20s. I say, in 25 years, you're going to kick yourself just like I kick myself now for not buying this stuff today.
Yeah.
That's what we told Errol the other day.
Yeah. Just buy it.
Yeah.
Close your eyes and buy it. Well, thanks, TP. We've got some more content. We'll bring you on in just a little bit, but appreciate you as always. We're going to swap over to Mr. Tony Zhang. Tony, how you doing?
Doing well. Thank you so much for having me.
Absolutely.
Tony, what's up, man? How you doing? Looking sharp as always.
Good to see you, Jermal.
Yeah, man. We met long. You know what? It's been so long. We met. You came to SIBO, right? You came to the the Options Institute. That's when we met, right? It's crazy.
Yeah, it's been quite a few years.
I know, right?
Last time I saw you was probably OIC last year.
Yeah, true that.
Love it.
What's going on, man? I mean, it's been a crazy market. We got a lot going on. What are your thoughts about what you're seeing these days?
Yeah, I mean, our primary focus still remains within growth, within AI. Obviously, we've had this, I would call this a fairly healthy pullback, healthy consolidation after what has been 9-10 straight weeks of record highs in the equity markets, right? That rally has been incredibly narrow and concentrated inside of these chip stocks that needs to see a little bit of rotation. And we're seeing that rotation here underneath the surface as these chip stocks take a little bit of a pullback here. I think a lot of it is looking at SpaceX tomorrow as potentially the stability in this particular sell-off. My expectation here for the IPO tomorrow is going to be a somewhat semi-muted response, given just the frenzy around this IPO. You have what is it, close to $250 billion in orders for what is $75 billion worth of stock. So you're talking about nearly 4 times oversubscribed, but you have about 30% retail participation. And I think we're likely to see some upside tomorrow in this particular stock, even though it's trading at fairly ridiculous valuations, right? We're close to 100 times revenue. And the question is really just, how's the market going to digest that? Because, there certainly are some concerns around AI, whether or not this is quote unquote a bubble. From my perspective, I think the long-term growth story here for AI is without a doubt still plenty of upside left for the long term. But in the short term, we could see some more volatility ahead. But the SpaceX, I think, is going to be an interesting barometer in the short run as to how these chip stocks will react, because ultimately SpaceX is really an AI opportunity at its core.
Yeah, and I think the most interesting thing is just the public eye on this thing. Like I'm aware of IPOs that come out, but really I'm not like tracking day to day because I'm not trading the IPOs directly. I'm waiting till the options market comes out. But we've been talking about SpaceX for like 3 weeks, at least. Yeah. So just the fact that there's so much attention on this IPO, I think could bring a record number of retail traders. If you think of just like unique people trading this thing, I think this could be easily, by far and away, the most popular IPO that we've ever seen. Just because like there's people that don't even trade that are asking me about this thing.
Yeah, absolutely. I think the only IPO that even comes close in terms of retail participation and just generally speaking, the public, having an eye on it really was Meta. We're going back close to 15 years ago when Meta went public, and there was a lot of talk around that. The SpaceX was really the only thing that's in the last 15 years that's even come close to that, in my opinion. And obviously, retail participation is a whole different ballgame than it was back then. You have the fast track in the NASDAQ 100, which is going to bring a significant amount of capital inflow into that particular stock. So yeah, you're absolutely right, and I think this is really going to potentially stabilize the recent rotation we've seen out of the AI chip stock trade, and potentially stabilize that and maybe see that reaccelerate here to the upside. You've seen all the space companies in the last few days pull back here. Rocket Lab back to around that $100 level. Those are all I think potentially buying opportunities tomorrow going into that IPO.
No, that's a good point. Looking at those names, it's probably easier to play than trying to play the IPO itself. Yeah, talk to me about that rotation. You guys are looking at certain other areas of the market, like you said, as we've seen a lot of people, obviously in tech, but starting to see some rotation out of that. What are the areas you guys are looking at?
Yeah, so first thing we were looking at is just the RSP, the equal weight S&P 500 index. You see how as the S&P pulled back over the last 4 or 5 trading sessions, the RSP has essentially stayed flat. The rotation has been out of the few growth tech stock into essentially the rest of the market. We've seen real estate break out to new 52-week highs. If you look at stocks like Simon Property Group, you see Coca-Cola, you see TJX. We've seen quite a few of these kind of even retail names show quite a bit of strength here. I'm not sure that strength is necessarily durable, especially, after tomorrow's, all eyes are going to be back on AI, tech, SpaceX. I would imagine that we probably see some of that rotation strength weaken a little bit back into tech. So, especially if you see some of just the major levels that the Mag 7 stocks have pulled back to, you look at NVIDIA, we're back to 200. I think that's an interesting entry point, because 200 was really the level that NVIDIA contended with for call it a year. Last year, broke out finally above that level. Now we're pulled all the way back to 200, and NVIDIA is trading at 22 times forward earnings. That looks like a pretty compelling valuation to be buying more. If, let's say, you missed out on the recent breakout here, you have Alphabet recent pullback. Now we're trading at around 27 times forward earnings. That, I think, is a really interesting long-term play for anyone interested in AI. So all of these stocks, even Micron, trading at 8 times forward earnings, we're back to around the 850 level here on Micron. So, there's going to be a lot of interesting names that over the last couple of days have pulled back to much more compelling levels from a technical perspective, from a fundamental valuation perspective. That's really where I think past tomorrow where my focus is going to be. But, at the same time, we are seeing some real rotation here as a result of the recent pullback here. And I think that's healthy for the markets, because we have seen what has been a market that has been too narrow, too concentrated in just growth stocks over the last 9-10 weeks. That isn't sustainable. You need to have rotation, you need to have consolidation, and that's what we've seen over the last few days. And I think SpaceX is likely going to be the catalyst event that kind of reverses that a little bit back into the AI trade.
So tell me if I'm wrong. Okay, but it sounds like to me, Tony is saying that we're crowded with a lot of these names in AI and tech, but we've pulled back, and so he's looked at other names like we've seen the Walmarts, the Costcos, the Cokes of the world, and that's been a rotation in that. But these names have pulled back to attractive levels, kind of like Julia said the other day with research, and PEs are low enough that maybe you can pile back in after SpaceX IPO. Did I hear that right?
Yeah.
Okay, I'm just checking. That sounded like what you said, Tony.
That's exactly right. And, also, the last couple of days, the VIX is up, 22% now, versus realized vol over the last 30 days is in the 12-13% range. That's a pretty significant spread between implied versus realized. So I think going into tomorrow, there's, especially with these AI stocks that have pulled back a little bit, there's going to be some interesting opportunities to be selling some premium heading into that SpaceX IPO tomorrow with some of these tech names.
100%. And yeah, all eyes will be on SpaceX tomorrow. It's going to be crazy. But Tony, thank you so much for your contribution. We love the insight. We're going to take a quick break here, and we'll see you on the other side. You're watching Tasty Live.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say? Other than, boom! Trade like a trader. Tasty Trade. Make your move.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments. Thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit. For lo, I am short, so I must needs thee plummet. Oh, market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
Yeah, and I'm fun on the block all day, all night. Isn't it? No stress, no fight. Fun on the block all day, all night. We just living it up, yo, that's real life. Wake up, sun grinning through my window. Text my crew like, what's the plan? Let's go. Shirts, wrinkled jokes, twisted, nothing too official. The outside flexing on my bike, out the bell with the whistle. Corner store, pick up chips, 2 shoulders. My board in the slides, trying to dump on the stroller. Kids running loose, auntie sipping lemonade. Every front porch got a beat, yeah, it's homemade. No drama, the heat waves of laughter. If we got problems, could we solve them after? Grilling on the curb, grill marks on the shirt. Somebody brought the tools, man, let that Luke word. Fun on the block all day, all night. After with my people, yeah, we feeling alright. Fun on the block all day, all night. Good vibes only, yeah, that's real life. Fun on the block all day, all night. Hands in the air, no stress, no fight. Fun on the block all day, all night. We just living it up, yo, that's real life. A's at the table, crowd tilted sideways. Grandpa talking trash, man, he wild for his age. Kids on the hydrant, street gets wavy. Auntie hit the double dutch, yo, she still crazy. Ice cream truck roll out, yeah, we all chasing. Pockets on lead, but the vibe still blazing. Cops roll slow just to see what's good. They know the drill, it's a party in the hood. We laugh, we boast, we live, we boast. It's all fam out here, raise a glass, make a toast. Sidewalk royalty, king of my block. Every place got a story, every joke hits the spot. Fun on the block all day, all night. After with my people, yeah, we feeling alright. Fun on the block all day, all night. Good vibes only, yeah, that's real life. Fun on the block all day, all night. Hands in the air, no stress, no fight. Fun on the block all day, all night. We just living it up, yo, that's real life. Yo, we just living it up, yo, that's real life. Yeah, we just living it up, yo, that's real life. We just living it up, yo, that's real life.
What's up, everyone? Welcome back to the show. Options are moving. E-minis are moving. NASDAQ is moving up 30. NASDAQ up 220. Dow and the Russell up 0.5 percentage point as well. We've got SAHILL in the house with me and Jermal. It is trades from the research team. SAHILL, how you doing?
Doing good. How are you guys?
What's up, man?
Yeah.
I feel like you graduated from Baby Shark to SAHILL now.
Yeah, graduated.
Are you happy about that?
Tony calls me Jaws.
Jaws.
Yeah.
Like
Nice.
it.
Yeah, my name, SAHILL. I guess you guys can start calling it me that now. That doesn't really matter to me, what nickname and all that. I found Baby Shark a little endearing. Kind of missed it a little bit.
Yeah.
Bring
You
that
had the
back.
song and everything going.
When you had Baby Shark, your expectations were a little low. Now they rise up. Now Julia says you got to put in the proper research, proper coding, proper everything. Yeah,
That's fair.
yeah.
Yeah, people are always like, do you want to be called Mike or Mikey? I'm like, I don't care. But if someone calls me Michael, I know I'm in trouble. That's the...
Is that what it was?
Yeah.
That's what it was.
Someone says, Michael, get over here.
Oh boy.
Here's on the back of your neck, stand up, freak out a little bit.
Your parents ever used your full name with you?
Oh, yeah.
You screwed up in life.
Yeah. That's when you really know you're in trouble.
Yeah, not really. My mom never did that, actually.
Really?
No, not really.
You do that with your kids?
Do I? No, actually, I don't. No, I really don't. No.
Are you a cool dad or a strict one? Who's like the strict parent out of you?
I'm the strict parent.
You're the strict
between me and
parent?
my wife. Yeah, I'm the one, which has definitely caused rifts at time between us. I mean, look, first of all kids figure out how to manipulate their parents.
Yeah,
at some point in time.
Oh, yeah.
And if you're definitely in a 2-parent household, the kids learn who to go to for certain things versus others. They figure that out really quick. So yeah, I was always kind of the strict one. But as they get older, I start to pull back. I chill out.
Yeah.
Yeah, I mean, I think you should. Like, as they get a little bit older, it's like, okay, you understand me, you understand what's going on, you understand what we're doing here, right? Like in this household, okay? Like as a family, let's just not, mess anything up.
I feel like we just got a little taste of it right there. That was pretty good. I'm like, wow, am I your baby? You yelling at me right now?
See, I knew exactly what stair made the noise when you were walking up the stairs when you were coming home late at night.
Yeah.
Your parents were sleeping.
Yeah.
I knew to hop over one of the steps or whatever.
Oh, yeah.
Like those are some of the memories I've had.
Yeah.
Yeah.
You
Little
gotta
trickster.
Yeah.
You're right.
Okay.
You're right.
Absolutely.
Well, SAHILL, we've got a couple minutes left with you, but you've got some trades from the research team.
Absolutely.
That's what I hear.
Yeah.
Awesome. What do you got for us?
So the first one is Oracle.
Cool.
Yeah, because the earnings were a little sus. They're actually like down a lot right now, right?
Big
almost like pre-market, they're down almost 10%, something like that. So I put this at the pre-market price right now. Like what it's trading at right now is around 182. That's what the spread's trading at right now. So a skewed iron condor because we want to be bullish, try to be a little bit contrarian, and I'd like to say skewed iron condor. We also kind of joke around in the research team as a poor man's jade lizard a little bit. Okay, it's kind of like just adding that call, buying that call at the top right there. So I mean it's pretty bog standard for an iron condor. 441 credit for 1500 buying power. You're not going to see too many naked strategies out of me with the smaller account until we get to stocks that are trading under $50 or whatever.
That's fair. That's fair.
Yeah. So what are we thinking in Oracle right now?
I like it.
I like it. I mean, yeah, I see. You got a little bit more risk to the downside. $20 wide. That's good. I mean, why not? Yeah, I like it. I like that one.
Yeah, it's going to open right around 180 here. So that's where the skewed iron condor comes in. It's kind of funny. You've got, even right now, like with the pre-market, the last price at 203, the 250 call is still trading for way more than the 170 put and the 160 put as well. So these options are still going to have some value. And, once we open at 180, maybe make this adjustment a little bit if these are lacking premium, maybe bring it down to like 230, 240. But I do like the idea of just throwing it right at the money and putting on that bullish stance. Poor man's jade lizard.
Yeah.
Poor man's jade lizard.
Yeah, I like it. Any idea why the earnings are doing kind of bad in Oracle right now, or why the stock market's reacted so aggressively to it, or just AI stuff?
I think it's just another stock that it's very similar to Intel, IBM, Hewlett Packard. Like that's where I put it, where it's like you had the pre-market rally or the pre-earnings rally to crazy levels, and then they report earnings and it just tanks. Like all those stocks that were flying high a week ago are down 20% now.
Hopefully they don't continue to go down.
It kind of started a week ago. Look, we've seen these names fly on earnings. Like he said, some of these tech names, Marvell, Oracle, Intel. Like a lot of them were flying on earnings. And then over the past week, HPE, I keep pointing to that one because when that one had earnings, was the rest of them did big move on earnings, that big red bar. It was up in the post market. And when we came in that day, it faded. And I think that was I feel like that was on a Monday. I can't remember what day that was. What day was that?
Yeah, June 2nd.
Day was the 2nd. I don't even remember.
11 days ago. It's Thursday.
Yeah,
too much
9
math.
days
Too
ago.
early.
I know. weekend 2 days ago. So
there you go.
So yeah, Tuesday. That happened on Tuesday, and then later that week we had CrowdStrike and AVGO, and those faded. And Mike and I were talking about it's like, okay, now they're starting to fade on earnings. Oracle was the next one. You talk about the storyline coming into this week was a lot of tech names are seeking a lot of funding. So that's what I think. I think that's why this one is down. If this were 2 weeks ago, this thing would be up. We'd be trading 250.
Nice analysis there by Jermal. I like it. All right, let's go to the second one, which is USO oil. Yeah, this one's hard to borrow, so be a little careful with this one. But if you're trading the options, should be fine. 4-man's covered call on this one, right at the 135 call, and then obviously buying.
Buying that one. Buying that 130, right?
Buying the 130. It's around like the 65 delta or whatever to simulate that stock, with a debit of $9.14 because you're buying, and Oil's a little crazy, obviously, right now. It's going to continue to be a little crazy, but we actually have some research coming out in the next week or so. I think that is saying that oil is actually a good buy right now. Might actually replace gold as a safe haven in the stock market. So something to look forward to. Yeah.
Interesting.
Yeah.
So the interesting thing about this one is that this works. This is actually better than doing like a calendar call. I mean, I think you know, but I think a lot of people who are watching may not know. Like a lot of times with USO, the way that it trades is based off of the futures, and the futures are, if it gets really volatile, the front month future is going to move faster and higher than the further out future. We're buying the further out right now to sell the near term. Doing a diagonal works, I think, better. You can get away with it. If it's a calendar, this is a little more. Probably probably won't want to do that. It'd be similar like doing a calendar in VIX. You never want to do that. You'll get blown up in the front, and the back doesn't move as much. So I like this idea. What do you think, Mike? I mean, I like this idea doing the diagonal.
Yeah, I always like diagonals. I think when it comes to USO, because you're seeing the crude oil backwardation come out of the futures contracts, that allows USO to move more freely.
Yeah.
I think when you had the backwardation in the crude oil markets, you had more of like an upside bias in USO, but that also reduces the prices of these calls, like the call that you're buying. So I do like this trade if you're playing for a bounce from here for sure, especially if we see the backwardation is at the lows that we've seen over the last 4 months. If we see the backwardation creep back into the futures market, USO is going to explode because like USO, if you look at the price, we had the that kind of shock right here where we were at 70, 80. Then the war happened, started to grow some teeth. Backwardation gets crazy, and this thing just explodes from 75 up to 150. And now we're kind of sitting at the bottom of the recent range while backwardation is flattening in crude oil. So if you see the opposite, this thing goes straight back to 150, I think. Love it.
One more?
Yeah, last one. HIMS. Yeah, so HIMS. So we're trying to get away from the AI stocks now, and this one's also trading at 28. So finally you see the naked strategy for me, just a strangle. 177 credit, 278 buying power. It's actually pretty good credit to BPR ratio, I think. So this is a healthcare stock, not an AI stock, not a tech stock. Thought I'd throw something in there as well. So yeah.
Good, man. Non-risk defined. I like it.
Yeah.
2238.
Do you think people become too risk defined sometimes?
Hell yeah, you guys do. It's good. It's good. You
got to find the smaller stocks.
Exactly. Do it
in
a
stock.
Right. Yeah.
Or the ETFs like EEM or something like that. Yeah.
But yeah, decent credit, $1.77 on less than $300 of buying power. So strong return on capital if you get this one right. But this is one of those where it's $27. You can manipulate the strikes however you see fit if you want to make it delta adjustments and whatnot. But 100% IV across the board. So you're going to be able to pick up a lot of premium relative to notional. And that's especially true if you go from July to August, because August has the earnings announcement, which will be August 3rd, at least is what it is looking like right now. So yeah, I like it. Yes, this is, for now, this is not an AI name. until you start taking the HIMSS pills and you become an AI robot.
One day, companies will always just say the word AI just so their valuation blows up a little bit.
Yeah. That was the crazy thing when they had the Super Bowl ad, and they were like, "Don't go to your doctor for your prescription. Come to us." And I was like, "What?
Yeah,
Wait,
wow.
what?" I was like, "When did this place become a subscription?"
I know, right?
Crazy.
Yeah, that's the model.
Yeah. SAHILL, thank you very much.
Yeah.
Appreciate
My pleasure, guys.
trade ideas. We'll pop some on when the market opens here in just a little bit. We've got 5 minutes left.
We don't know how much trading we have left. The SpaceX IPO tomorrow.
Is that it? Is that going to be the be all end all?
I don't know. People are saying the crash is going to happen right then. So.
Really?
Yeah.
Interesting. I guess we'll see.
Yeah.
Time will tell. Appreciate you, but we're going to take a quick break and we'll be back on the other side of it.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
What's up, everyone? Welcome back to the show. This is Tasty Live. My name is Mike. I'm here with Jermal, and we've got Liz on the line. E-Mini's up.
Hello, everybody. I don't know if we can see me yet. There we go.
There we go.
Hello, everybody. How's it going?
Good. How are you?
Hey, Liz.
Good. Clearly, Mike, you didn't get the memo. Now, I know we only have 30 seconds to talk about this before the bell, but Jermal, Blue and I, you need to go change your shirt.
I know. This is normally, so I usually wear a golf shirt because it's Thursday, PGA Thursday is what I like to call it. Like, it's just something I do, but I do have a blue shirt. Next time I'll do it. We'll reconvene next.
Yeah, what's your favorite?
Well,
that
know.
blue
I'm gonna
actually looks really good on you. What?
Oh, there we go. Spinning out of the turn. Spinning out of the turn. What are you guys doing on the open? Are you guys going to dabble in Oracle?
I don't. Not
actually. I do want to check out SAHILL's trade from the research team that he had on. So he had the 170, 160, and then the 250, 260. I just want to make sure we're collecting enough on this call spread here.
Well, and that's when you enter them pre-market, you do have to check your prices before when it opens.
Yeah,
so I do want to give that little PSA announcement.
Yeah. I was a little worried about the upside premium here. We're going to see once it adjusts when they open these options markets. But if we can collect $1 or $1.50 on this call spread, I'll throw it on and just lean bullish here. But if not, we might need to bring this call spread down. But I do like the idea of just throwing on like a bullish leaning iron condor here. He actually called it a poor man's jade lizard.
Yeah.
So
yeah. What is he, wider on the put spread, narrower on the call spread?
Same widths, just skewing it. So throwing the put spread at the money and then the call spread slightly out of the money.
Okay, so I'm not gonna lie to you. I'm dabbling in Oracle. I also yesterday, Mike, and I know when we were doing the show, I dabbled in a couple of those things that we were talking about yesterday. That NASA, and I bought some Google. I don't know what this SpaceX IPO is gonna bring, but those are names that already have SpaceX in them. So I figured that's the most defensive way to play that IPO that's coming out tomorrow.
Yeah.
The options aren't really open yet. When I'm looking, I'm like, why am I?
No,
I have calendars.
Not open yet.
Yeah, they're not, right? Okay.
But take a look at this. I mean, the E-mini S&Ps are only up 19 right now.
I was about to say, do you believe in this rally?
50. They're fading. Am I fading the rally?
Yeah.
I'm buying the dip.
You're buying the dip.
Ooh,
Okay.
I'm buying the dip. I leaned into it yesterday and took a little bit of heat, but I'm buying the dip. So I think it's anything goes for tomorrow. I truly do. I've never lived through an IPO this big. Lived through a lot, but so then I can say I've lived through the SpaceX IPO as well.
FB was pretty big at the time. Remember
at
Meta? Not Meta, but it was FB. That was pretty big at the time, and I remember it did not go well at all.
Oh no! Oh, I can. This is burned into my memory, Jermal. I bought it at 35. It went all the way down to 16, and I was like, "What the heck?"
Yeah. I remember that one. It did not go well. It did not open well. It did not trade well.
It took about 2 months. It took about 2 months before then it got some rocket fuel underneath it, went straight up from there.
Yeah. So people who are talking about all this sentiment for SpaceX, they're remembering that because that one was not good. It really was not.
No, it was not. It was not. And since then, Jermal, it has split and doubled and split and doubled.
I know, right?
There we go. They're open. Oracle options.
They're open. Okay, good.
Finally open.
They're open, so now I'm down money.
That took way too long.
Yeah, it did.
They were like, we gotta open these things before.
So people understand how this works, there are market makers and they have to get their footing as well because they are legally required to make the market on these options. So when you do get something that's down, what is Oracle down? 11, 12%? Sometimes it does take a little bit of time. Now, when I was on the trading floor, there was a way where when I needed to get my bearings, you just press this button and it made everything wide. You could go up to $5 wide on the options pricing just until you could get your footing on what was going on. You don't see that anymore.
Yeah, talk about too, like I remember when this was obviously 2008, so I was only 2 years in, and I remember the day that they I don't know how I want to say, whatever, canceled short selling. You couldn't short sell that day. And they sent the notice out, and I forget the name of the notice or the order, but basically all the traders like, oh, that's a license to steal. What do you remember? You know what I'm talking about? It was
when they stopped the short selling?
What's that?
They stopped the short selling?
Yeah, well, they canceled short selling that day, but they basically, they sent out an order and a list from the exchange. Basically, I forget what the order is called, but basically it was saying, market makers could open as wide as they want. And that's when I remember
yeah. As wide as they want. As wide as they want, but it was $5. The parameters were still $5.
Okay.
So when you think about that, there's nothing that's $5 wide here, right?
Yeah.
You would look at the monies and it would be like, you could be like one bid at $6. That's insane. So nobody knew the pricing of things. But yeah, that was to stop the bleeding, wasn't it? Weren't we in free fall?
It was crazy.
They said nobody could short sell.
It was wild. Yeah.
That's
So I mean,
Did you get filled on your Oracle, Mikey?
I didn't route it yet, but I think I'm going to switch it up because he had the 250 or 240, 250 call spread, but those options are worthless. So I'm just going to flip it around and just do a Super Bowl here.
There you go.
Sell the 170, sell the 170, 160 put spread, and just buy this call spread. Like the fact that you could still pick up $2 and change in credit just shows you how cheap this upside call spread is. All things considered.
200. So yeah, I like it.
All right, so here's what pretty much everything on my watch list or things that I look at right now has an IVR over 50, which is an insane place to be, right? So we still have the VIX. Where's the VIX right now? It is over 21, so it's 21.6, which means this is still an anything goes market. We could go down, we could go up, we can go anywhere. I know you were looking today, Mike, at the expected move for the SPX. Has it changed at all? It was, what was it, 79 on the open?
Yeah, it was 79 on the open. And it is 60 now, 50, 60 now.
Look at how much has come out of it already, right?
Yeah.
Which is pretty crazy when you think about this. But there is IVR across the board. So if you have, to me, this is a seller's market. Not selling the market, a seller's market as far as premium goes.
Yeah.
Oh, no doubt. Yeah. That's it. I do think we're going to be down. I'm buying a put spread.
You're buying a put spread?
Yeah, just because of the 72.50, 72 quarter. If I'm wrong, whatever. I paid $600. I think. I mean, it's just we've been weak all week. We've started the last couple of days. I feel like we started up a little bit and then we ended up fading. That's what I'm playing for, I think. And if I'm wrong, cool.
You know what I love about trading? Everybody can have their own opinion because I'm doing the exact opposite.
I don't get hung up in being wrong, honestly. I just don't want to be wrong big. You know what I mean? Like I don't get.
I think that's fair. You're keeping it tight, and it's defined risk, so that's good.
And guess what?
Now, Mikey could be our tiebreaker. Where are you?
Well, I'm petrified because the last 2 0-day trades I placed, one was in the money by 200 points, and the other one was in the money by like 150 points. So, I like the idea of being neutral, especially like the day before. Finally, SpaceX is coming. Like I feel like maybe you see a chop today. And with Oracle earnings out of the way, we do have Adobe earnings, which will be interesting. That's another high flyer, 20-point implied move on a $220 stock. This one I am much more bearish on. So I think this, like, I would be shocked if this thing rallies. If Oracle can't rally and all these other tech stocks that have more implied success in the future, like Adobe is kind of that weird spot where it's like, I don't know if this
nobody uses Photoshop anymore.
Yeah. But
I'm old and I use Photoshop. Oh, speaking of old, Mike, do you know that tomorrow we're going to be generations apart from Jermal? You and I are going to be so young.
I love it. She's always saying we're the same age, but now we're generations apart.
I mean, we're going to be generations apart tomorrow. I'm still in my 40s.
I got
You're
five
going to be in
handle.
your 50s.
Yeah, 5 handle coming in tomorrow. No doubt.
Really?
No doubt.
Yeah, that's right.
I don't mind it. I feel like I look decent for my age. I'm okay with it.
Very young.
I'm okay with it.
I still look good. What's that? That's from a movie. Yes. Jermal, you look great for your age.
It's coming for you soon.
Hey,
1 year.
You know what? I'm fighting it as long as I can. As long as I can. I have till November. I have. It's the summer of Liz. I have until November until it happens. But yes. Don't, Mikey, one day it'll happen to you. One day in the very far future.
Yeah, in the in a far away place, long time away.
But he's like us at heart, though. Like he's like an '80s baby in a way, you know. Like he loves everything '80s.
Yeah.
Yeah. Well, I'm finally catching up to my age. When I was on the trading floor, they called me a mother stuck in a grandmother's body because I was like, nothing good happens after 10 p.m. You guys get home.
No, it's like that. I mean, like with us, we're like, we've always been the youngest parents with our oldest. I mean, we were always the youngest, like even, recently graduating college, like, all his parents, most of those parents in their 60s. I mean, like me and my wife are like the youngest. But with our youngest, we're like the oldest.
You're like the oldest.
Actually, you know what's funny with our youngest? Almost like same age. Like people have kids late these days, bro. Like
they do.
It is wild. Technology.
Yeah, I guess.
Technology.
All right, so what else are we doing in these markets, guys? We got to put some more trades on. What else did SAHILL
put
bring?
spread is working.
So he was also talking about a USO call diagonal spread, which I think is interesting.
Do you guys have anything in oil right now?
Yes. I have a short put in MCL that I've just been rolling week to week to week to week to week.
Is this your yearly position, the one that you're going to just have?
No, this was just like a buy the dip in oil and collect the premium that's sky high. But it's been great because I've been rolling this 92 strike. I think I did it 3 times already. But yeah, started with the 92 strike in the May 29th cycle for $1.60, rolled 7 days out for $2, rolled another 7 days out for $2. So I went from $1.50 to $550 in premium. It's up $250 now. And I think I just got one more in me here in the end contract before we go to the queue. But yeah, picking up another $1 brings me to like $650 in premium on the 92 strike. So my break even would be closer to 85. And we haven't. So
are you just in this a perpetual trade, or when do you think you'll call Uncle? Like, are you waiting for a certain down move, or is this going to be it works until it doesn't?
This dude never calls Uncle on trades like this. This dude will have this thing for. I mean, it's amazing.
Well, that's why I'm asking, because I've heard a rumor that you keep trades going for years.
That's correct. Whether I like it or not, some of them I like MES. This is the year-long trade for this year. Love it.
Okay, yes.
We've got.
Is it a strangle?
Yeah, it was a strangle. And then basically the thesis behind this was just never have upside risk. So anytime the call was tested, instead of under hedging and rolling the put up, I was literally just shifting the whole thing up. So if my call was tested, I would move it so that my put was tested. And that's been working great. Even
do you go up and out or just up? Are you taking it up and out in time or just up?
A little bit of both. So I think I went up once in the same cycle, where I just shifted the whole thing up without changing the time frame. But generally speaking, I like to move it up while I'm rolling it out, because then you can be more flexible with the credit, or give up some of that credit to be more flexible. But yeah, the MES trade is working nicely. I'm at a 7,800 straddle now, and that's probably where I'll be until we get up there, if we get up there. But
well, I would say that's a risky trade, but it's in the M contract, so you're doing good. You're staying small, staying small and staying nimble. That's good.
Yeah.
What do you guys have in? What do you guys have? I'm just kind of looking. You have ETH and IBIT too. I'm talking my crypto book here too. But are you guys bullish cryptos?
Yeah,
crypto's at 62. It's getting a little bit of a bid, but it's sad to say that's a little bit of a bid.
I know. Yeah, we're bullish on the crypto space. I think like we've been bullish before. We have to be bullish now if we're at 60 in Bitcoin. But
because you like it at 80, you love it at 62.
100%. But yeah, I have an in the money short put in ETH. This is going to be one where I probably just take the stock and then wait for a bounce and then sell a call against it. And then IBIT, this was my year-long trade from last year, where I sold a ton of premium and ended up picking up $3,000 in total premium, and then I took shares at 65, and now I have. Yeah, it's been a wild ride, but I've got a short put in September. I sold a short put to finance 2 long calls. So this is another like Super Bowl setup, but collected $100 for that.
That's a super bull, because you're bullish.
Oh yeah. But yeah,
I don't have anything on an ETH, but I think.
But do you know what I love about ETH A and IBIT, and I know there's lots of other products out there, but what options traders have the ability to do is take what you just did, is have a bullish position in something, and it's very capital efficient, because you know we can go and trade crypto and buy the cryptos on our network, but that is all cash secured. And I'm not saying don't do it, right? But if you go to the cryptos, you can use ETH A and IBIT, and you're controlling a lot more crypto with a lot less capital.
Yeah.
So I like your bullish.
And the premium here is crazy. Like the 35 strike, you can pick up $3. Like that's a 10% reduction just from one option. Yeah, it's a little bit further out, but I went further out because I wanted that delta exposure with these long calls. So yeah, I still picked up $1 credit going out to September.
Can we just pause for 1 second? Yeah. Jermal, it's still in September. On September 18th, I will still be in my 40s. I'm just saying.
Just so you know.
You wait till November. You just wait. It's on now.
Yeah.
You wait.
He's going to be the first one to text you.
And Mike said it. I didn't say it. He said that's really far out.
Oh, you wait. You wait. November's not that far away, It's June. I mean, seriously. Like
Mike said it's far.
It's less than 6 months.
Listen, by then we'll know who the NBA champions are. We'll know who the World Cup champions are.
Yeah, we'll know it all.
We'll have a 4-0 record for the Bears.
I know you actually you're rocking a good color today. Mexico's playing today. Everybody's gonna think you're from Mexico.
I am.
You know what I mean?
Yeah.
Mike from Mexico.
Yep.
It's gonna be you.
That's gonna be my new name.
It's gonna be this is a big game.
There you
It's
go.
a big beginning.
Yeah, it's gonna be crazy. I'm excited for the World Cup.
That's
It's gonna
good
be
stuff.
fun.
Yeah.
Maybe there's this end game. Can I ask a question of something? And I really, this is a question. I don't know the answer to it. Sometimes I ask a question that I'm trying to get you to say something.
You
So
definitely do.
what time is it? Right. It's the European markets close. You know how the European, they raised interest rates. Do you think that's going to have any effect on the close?
Who raised interest rates?
And when does Chris Vecchio come in? Can someone ask him this for me? Because the ECB raised rates for the first time in since like 2023, and I didn't know if that had any effect on anything.
So I hadn't even heard that, but I'm not surprised. ECB and some of the other, some of the BOE, they were the first to raise rates back in 2022. I mean, we kind of knew that they were going to be starting to raise rates before we would ever raise rates. That's how you know that at some point we'll probably end up raising rates because
I know
do I think that's going to have an effect on today's market? Right. Nah, I don't think so. I think it's something that's it was already kind of telegraphed. I think it was expected.
Yeah,
but it's coming for us. I mean, that's the whole interesting part.
Yeah, and you know, Chris was saying that yesterday too. That it's pricing in. That they're pricing even a possible September.
Yeah,
So I don't know. It was just something that I wanted to ask because, like I said, I'm an options trader. I'm an old school derivatives trader, less a macroeconomist. But I know you guys are more versed in the whole circle of things. That's why I was like, this was pretty interesting. Because when I woke up this morning, or when I was looking at the market for the first time, we were up so much more. Now I know we probably sold off because the PPI. I guess the PPI, maybe a tweet. I don't know. One of those two things happened where we went from up 60 to only up 10. Now we're at least rallying back to up 30. Jermal, did you get out of your put spread?
I mean, this has been no. I'm in that thing, Liz. I'm staying in. I'm fine. I don't need to, dude. I mean, I'm long deltas for the most part. Market goes up, I'll be fine. Like it's cool.
Okay, look at you talking yourself into it.
I mean, it's
Good
true.
job.
This is every day, Liz. This is you can see. This is every day for me. I mean, seriously. I mean, this is the market we've been in though the last couple of days. It's been very jumpy, right? Especially for the first hour, and then eventually it determines a direction, and then. The last couple of days it hasn't been that great, but I mean, this has kind of been the market, I feel.
Oh, it's been so for the past, I don't know how long, like years, for the last years, the research that we've had on those 0DTE SPXs, it said traded at 9 o'clock. And the reason was because between 8:30 and 9, it's anything goes. And you said that in the beginning, it's just a little bit jumpy. And you're seeing that even in Oracle, the market makers didn't know where to price the options right away. It took a couple minutes, right? And you'll see that in some high flyers.
Yeah. Yeah, we're sub 180 in Oracle now, down 23 points. Big move there. And I was filled on that trade. Super Bowl 170, 160 put spread to buy a 200, 210 call spread. If we get any kind of reversal of this move, 5, 6, 7 points, this will be a $150, $200 winner, I would imagine.
Yeah, I mean, I'm not saying take this. You're already up $37. So do you both of you put GTCs in for your option trades? Good till cancels.
I should.
Or are you watching them? I do it only for profit taking.
Yeah.
So a lot of times when I'm putting something on, because my positions are scrolling, I have so many of them, that when I'm putting something like this on, I'll put an order in to close it only for a profit that I'm happy with. Because sometimes it can gap up there and you can get it even when it doesn't really move. Like you might get a bounce up for 5 minutes and it could come right back down.
Yeah. And that's a great point. And I think now with the PDT rule gone, it makes a lot more sense to throw these on, especially if you're not someone that can watch the platform or check out the markets all day. We're fortunate to where we can check it out all day. But if you right click on the selection, you go to advanced order and bracket, you can create the close at profit and a stop loss order if you want to. To your point, Liz, I think I like to use profit targets only and just let the losers run and manage them. But this is a flexible tool you can use to close at a profit, stop it at a loss, and then if one of these is filled, the other one goes away. So
I'm actually smiling as you're doing this because I had no idea how to put in a stop loss. I don't use them, so I had no idea that function was even there. I would always just hit the profit target.
I know, right? He knows so much more about the platform. Well, you know what? I'm not going to say what I was going to say.
Because I'm not
kids these days, Jermal.
Because I'm not 50. That's why.
That's right. Yeah, that's right.
You see, he said it. He said it much nicer than I would have said it.
I don't know.
He's
there's this thing called age, and
Mike is so much nicer than I am.
yeah, exactly.
That's right. I just learned.
I did stop myself. I really did. I really did. I don't like to use those orders because what if we get like a big spike and then like we see in the markets, right? Get a big move.
Wait, hold.
And then something
just rewind
changes.
for 1 second. You don't like stop loss, or you don't like good till can't the profit taking?
Either one.
You don't like either of those?
No, I like alerts. So I like to put out an alert. Let me know when it gets to this level. I'm going to watch how it's trading, and then I'll determine whether or not, like for example, the Super Bowl, right?
Yeah.
Say this stock takes off for $20.
Yeah.
I want to see how it's trading. Just like we're watching this market right now. To me, this market is very jumpy. When we look at SPOOs, we look at NASDAQ. I still think we're going to go lower today. But I'm not going to put an order out to sell my put spread at a certain level because we could actually really fade hard like we did a couple days ago, right? So same thing with Oracle. Say Oracle takes off for $20. I want to see how it's trading when it moves $20 up. I'll put an alert out for, let's just say, 200, right? Say it does get there. I want to see what happens at 200. And I'm just curious to see how it's trading at that point. And if it's looking like it went too fast and it's probably going to fade, then maybe I'll close it out. Maybe it's one of those like, in this case, we got July, so I'm not worried about time. But if it were near term, I definitely want to see how it's trading at a certain level, and then I'll make my decision. I'm not saying that people shouldn't use those good to cancel or whatever bracket orders. That's great, but for me, just being an old school trader, I just want to see how something's trading at a certain level, and then make a determination of whether or not I want to do something.
I get it. And I do. I think Mike Mike was the one who said this. We have the luxury of watching the market all day long, where some people, if they're putting their orders in the morning and, going off and to work or at lunch or whatever, and you want to make sure you have a profit target, that's great, especially with options and especially with the PDT that is now gone. So, like I said, I've got two teenagers now trading, and I've got them putting trades in and making sure the closing orders for the profit that they want are in. And that's it. And they don't really understand anything else anyway. So that's why I think those orders are in place to kind of save the people that don't really understand what's going on.
What type of names are they trading? Do they trade tech? Are they trading SPX? Like, what do they trade?
I hate to say this out loud. They are 0DTE SPX traders. Both of them.
Yeah.
Yeah. 0DTE SPX. And I became the most popular person at my son's fraternity when I was showing my son how to do it. And exactly. My son on Mom's Weekend, I was showing him how to put the order in and how to close it. And he was making about $90 a day. And that, for a college kid, is a lot of money. So it was pretty fun. Yeah, it's a lot of beer. A lot of beer. Especially when it's so cheap. I went down there and put my credit card down, and I was like, just buy drinks for everybody, whatever we needed to do. I was like, did you forget to charge me? It is so fun in a college town.
Yeah, I know, right? It is so cheap. That was the same thing when we'd go to Madison. I'm sure it's the same thing in Lexington. Yeah, it's pretty cheap.
It is very cheap.
See it?
All right, what are you looking at, Mikey?
I was just going to say, if you want to throw on your own alerts, you can click this menu on the right-hand side. I'm using the web-based platform here. But you can do this on the desktop too. You just click on the alerts, set your last price or whatever you want, last bid ask, greater than, less than, change the symbol, and then you can create the alert and it'll just show up here. So this will send you an email and a push notification, I believe, by default. So you will be alerted if Oracle gets above 200 here.
Okay. So you're that and you would do something like that, Jermal. You're going to put an alert in to see where it's trading.
I mean, I'm not that worried about it.
I was going to say you have to have a lot of alerts in then, because and
I do at times.
Mike, it's kind of fun to look at your positions because you have, like I said, we looked at it yesterday. You have a lot of the same names that we have, that I have, that most traders have in their accounts right now, because everybody's kind of watching the exact same thing.
Basically.
Yeah.
Basically.
Yeah. I think the biggest ones I would say, wow, Oracle catching a bid here. This trade is coming in nicely.
There it is. I already bought some.
Yeah, I think like my biggest hang my hat on this type of environment is Microsoft to the upside. I think it's the same kind of story. Like, you have a Mag 7 stock that's down 30% on the year. Like, why are we not buying this dip, especially after this? And we were buying it down here. We got the nice rip and closed the positions, but yeah, this has been 2 weeks straight of just selling all the way from 460 down to 392. So yeah, I think it's just a matter of time before this one reverses. You get some liquidity back into the software products. And if I'm choosing one, it's going to be Microsoft. So I'm going to keep layering into bullish positions there.
Yep.
Same with NVIDIA. sitting at 200. So yeah.
Yeah, I like the layering into the bullish positions. Take a look at this, guys. SPOOs are up 55. So
wow.
SPOOs up 55. Everything's getting a little bit of wind underneath its wings. Now, normally I would say that oh, great, we're going to stay up today. I think Jermal is probably right. This is kind of going to be a very wild ride today. I think we're going to have that big range.
Don't listen to me. I don't know what I'm talking about.
Nobody knows what you're talking about. Just trying to blame you for everything.
I just want to move. I don't care if we go up or down. I just want to move right now. I mean, actually, I make more money if we go up today. That's the reason why I put the put spread on, honestly.
It's a hedge. And you want to make sure that you're not going to lose more on your hedge than you would make on everything else. So that makes sense. Just something you could take off if you needed to.
Mm-hmm.
The VIX is pulling back a little bit. So the VIX we've got it. It's not in the 21 handle anymore. So we've got VIX down about 6%. Pretty good.
Yep.
Google's down $6.
Yeah, and you're seeing the contango steepen in the VIX futures. You've got the M contract down 2.5%, the N down 1.6%. So the near-term contract's getting crushed relative to these others. And I want to see the peak of the vol contango was like 2.5 points, somewhere around there. So if we rally today, if we rally tomorrow, and we see this VIX curve get more steep in the contango sense, I think it's up and away.
Okay, old person question, Mike. How the hell did you get there? What'd you type in?
Oh, for the vol watch list?
Yeah, to get that.
I just made it.
Just created one.
I just created it. So yeah, it takes a couple minutes. I think we'll get this in the platform eventually, just like by default. But yeah,
I would like that in the platform by default. So
I have one. I use one. I don't have a list.
If you know a guy,
but it's in
please
my
let me
main
know.
list. Yeah, I have the front three. I'm always looking at the front three.
Yeah, the
the powers that be should add Mike's list so that old people have it.
Yeah, near 50, almost 50. But both of you look not a day older than 35.
Thanks, buddy.
Yeah.
Oh, there you go. There you go.
I mean, you look 36, Elizabeth. It's cool. I'm kidding. I love you.
I know.
I'm going to get you back slowly over time, all the way until November.
Yeah.
All the
little
way.
bits.
Every single day.
Bits.
He's going to think about it. He's going to be drafting his little text he's going to send you for the next 2 months.
I know. I know how he operates. All right, you guys, I will be back in a little bit, I think, right?
Yeah, absolutely.
All right.
Mm-hmm. Thanks for coming on. Appreciate you.
Good luck, guys.
E-minis ripping higher, up 50-ish. NASDAQ up 400 now. Big rally there. But yeah, we will take a quick break here. We'll be back on the other side. You're watching Tasty Live.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
It's time to trade smart, post-PDT rule elimination. And Tasty Trade has the tools traders need. The Active Trader tab's comprehensive market data is designed for rapid order placement in a single click, while bracket orders let traders set entry, profit target, and stop loss all in one ticket. From the Positions tab, you can monitor positions, roll trades, close positions, and create conditional orders. Now, traders of all account sizes have more flexibility than ever before to engage in the markets. Smart tools for smart traders. Tasty Trade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Welcome back, everyone. My name is Mike. I'm here with Jermal. You're watching Tasty Live. E-minis and NASDAQ ripping higher. That might be to the chagrin of our next guest, Tim Knight. How we doing, Tim?
I'm okay. Hey, listen, I'm not that weak-willed. No, it seems to be like I mean, all week it's been like this. It's like the market's really strong, and we look at me, and I'm not crying, and by the end of the day, it works out.
That's good.
So yeah, it's a pretty green day, but I'm planning to short some more stuff.
Honestly, you know
Johnny
what?
OneNote.
And I wouldn't even say by the end of the day. I feel like not long after your segment, we've been selling off.
Yeah,
it's magic. Yeah, I have the power. And this will be the last day in our natural lifetimes where we live in a world without the ticker symbol SPCX. So I think the moment of silence is due.
Yeah, it's gonna be crazy. The market's pricing in a ton of volatility. Even products like Tesla, Rocket Labs, they have kind of this like binary event implied volatility priced in there. So it's gonna be wild. It's gonna be wild.
Yeah. Well, I've got something different today. Usually we thumb through some kind of live charts, but I made some images last night with some index symbols that I kind of painted and dolled up a bit. And these are static images, but I thought it'd be worthwhile to take a moment to thumb through those and talk about them a bit.
Cool. Let's do it.
Okay. So these are as of yesterday's close, so this does not include today's activity. But there have been some interesting shifts taking place, and these are all roughly the same span of time. And most of these are equity indexes. But so we begin here with the NASDAQ Composite, the CompQ, and we had this long consolidation period, which, as I've pointed out many times, was a great fake out because we broke down from this range, retraced, and this, in classic charting terms, this is only the place to go short because you're mashed up against this massive overhead supply, but it made this leap, this gap above, and in retrospect, we can see that it was the beginning of this multi-month uptrend. And then what's also happened in the past few weeks is twofold. One, the uptrend has failed. The timing of that failure has varied from place to place. The Dow kind of took the longest. And the other one is that we've got a pretty nice little topping pattern, which is the new definition of what constitutes resistance right now. And so, for example, with yesterday, at its highest level, the market did a beautiful job pushing right up against this multi-week reversal top right here. So we've got a broken uptrend, and then we've got this dip below. And like I say, these are not live charts. So if we saw this now, we're rallying toward that resistance again. So long as it stays below that block, that's a pretty useful area to note in terms of when the selling will overwhelm the buying. The NDX, the NASDAQ 100, kind of the same beast here. And we had our bottom, across the board. Basically, March 30 was the bottom, and we've rushed higher. And what even I, who just does nothing but think about markets, sort of realized this morning is if the tippity top here, which is like last week, even if we retraced just to where we were in March, a couple months back, it's about a third of the market, 1/3 of the entire NQ value is like, oh my God, it's extraordinary, which, obviously illustrates how radically this had pushed higher in a very short amount of time. So same deal, kind of a topping reversal pattern. And getting away from the pure tech stocks, and this is one that kind of took its sweet time. Here's the Dow 30 Industrials, and they only cracked their uptrend on, I guess that would be Tuesday. And we had a nice big tumble yesterday. And so interestingly, just Friday, 4 trading days ago, was the lifetime high in the Dow. And we were still above the uptrend, but now, same deal. We're below the uptrend, and we've completed a pretty tidy little reversal top here. A couple more of these in equity land here. S&P 100, the OEX, very clean. We can see about, I haven't counted them out, but it's about 3 weeks or so, 3 trading weeks of activity. Nice dip. And what kind of captured and captivated me about these charts is that yesterday's high did such a good job tagging the underbelly of that overhead supply, that the bottom of that range. And so that is especially tomorrow when things will be so crazy, that's going to be the key level to watch in terms of, all right, do we have a real downturn going on, or was this just, as it was down here in March, just a total fake out? And the last equity one, I've got one final chart after this, is the all-important S&P 500. And here's this beautiful rounded top, breakdown, push higher. And things were kind of going wrong pretty early, actually, as of here. We had penetrated that pattern again, and it started kind of pushing deeper and deeper, and then put on its tennis shoes and jumped right higher, blasting higher here, and then the breakdown occurs. So once more, this is the key level. And then just one last one, kind of quite different from the rest, is the XAU, which is the gold sector. And in this instance, we've got this beautiful right triangle top, and it's much bigger than the ones we just saw. And I'm sure it's been disconcerting to precious metals fans because it's like, wait a second, there's inflation, there's wars, and it's supposed to be good for precious metals. But from a charting perspective, after that sort of ecstatic leap late in January, it's just been breaking down ever since into a series of lower lows and lower highs. And my own kind of mental target for these months has been, if gold can get back down to 4,000, maybe it'll find some stability there, because it's a psychologically important level, and that's deep enough. It's more than 20% drop from where we were late in January. Maybe that'll be the zone where things settle down. The chickens agree. And so we're approaching that. But what kind of gives me pause is I look at a chart like this, it's like, this isn't anywhere near support. So I'm sort of holding off on any. The metal I'm kind of keen on is palladium of all things, but this chart here is like, not yet. I'm going to keep watching. So anyway, something a little different today.
I like it. I think it's really interesting that, obviously the E-minis and NASDAQ are super highly correlated. So, but it is interesting to see that the chart patterns are virtually the same, where we're kind of reaching that glass ceiling, if you will, and we'll see what happens today and tomorrow. We're kind of right there. If you look at the E-minis and NASDAQ now, with the E-minis up 45-ish, NASDAQ up 450 points, like we're pressing on that level that you mentioned, just on the upper side there. So we'll see.
Yeah.
Could be a fake out like yesterday.
The tension tomorrow is going to be just palpable. I'm no IPO expert, but I've done this long enough to know that they don't open at 9:30 EST. It's going to be probably some hours before we see the first real trade go through, and people are going to be on the edge of their seats, both at that first trade and, of course, every single tick afterwards until the close.
Yeah,
for sure.
Couldn't have said it better myself, and I think really we were talking about this too earlier, that I have people texting me about this that are like not even traders. So it's definitely like the public knows about this, and that's something to be said. When like the only other comparable, Mr. Zhang came out and said was
I've put in my request for stock, and I'll see if I get like 2 shares allocated or something. I guess we all find out tonight. I've never done this before. I've never done participate as long as I've been trading, which is like decades. I've never participated in IPO, but I put in my request. We'll see what happens.
Yeah, as long as you've been trading, and also you're in Cali and all these different, and you're Silicon Valley adjacent. I'm surprised you've never.
Hey, I could tell you Elon's stories for a while. Give me a beer. We go way back.
I bet. I can see that. First of all, your petting. Do you have a petting zoo or something like that? You got chickens? Like what?
Yeah, I have 3 beehives. I've got my chickens. I've got my beloved dogs. I just, if I probably have goats if I could get away with it, but not in Palo Alto, sorry.
Yeah. The honey is clutch. I assume you get honey and you use that daily.
I have
Same
my
with
own
eggs.
special Perma-Bear honey label that I attach to the jar. But yeah, this is a
that's brilliant, Perma-Bear.
The gentleman farmer in Palo Alto here. Yeah, very suburban paradise.
Nice.
Love it. Love it. Well, thank you, Tim. Appreciate your insights as always. Love the charts, and we're kind of right there with the NASDAQ.
Yeah.
And
Well,
the
tomorrow we'll see if we can find something to talk about. If anything's going on.
Yeah. Well, I'm sure we'll be able to find something.
Yeah.
I'm sure we'll be able to find something. But yeah, appreciate you as always. We'll see you later. But yeah, kind of a crazy day so far. We thought the E-minis were going to rip lower. They are ripping higher as of now. But to Tim's point, we're kind of on the underbelly of that glass ceiling in terms of a point of potential resistance.
We just finished Tim's segment. We'll see what happens.
Yeah. Yeah, that's right.
Most times.
Yeah.
We'll see. Also depends on what kind of research Julia has. Speaking of.
That's right. That's right. Julia, how we doing?
Amazing. How are you guys?
Great.
Great. Another day.
Did you listen to 9 Inch Nails yesterday? That's the question.
I did. I did. I also saw the Jackass movie for the first time all the way through in my life, and I'm kind of annoyed at how funny it was. It was actually hilarious.
I've never watched that one.
The original Jackass movie?
Yeah, the original?
I think it's Jackass 2, technically, because it was like a show, and then they made a movie. So I guess it's Jackass 2. And the resilience of the human body is amazing.
Yeah. That if that show shows you anything, it's just that.
Are they coming out with something? Did I see a preview for something?
Well, Johnny Knoxville is the host of Fear Factor now.
That's what it is.
Maybe
that's what it is. Yeah, because they showed
Seems up his alley.
last night, maybe during the game. I can't remember.
Yeah. But I think all those guys, the original, like they can't be doing that stuff anymore.
No, hell no, hell no.
Like Steve-O, he's been through hell and back.
I don't know how Steve-O lasted the first time, to be honest.
Yeah. Oh, yeah.
Yeah.
It was dangerous. Yeah. It was very like MTV era, like shenanigans.
Yeah. That's the way we like it, though.
So stupid.
Yeah.
So funny.
Julia, something amazing happened last night.
What happened?
There was this basketball game. See, I know she doesn't watch. There's this
I heard about it.
You did? Get out of here. How'd you hear about it?
Knicks, New York, right?
That's right.
Yeah, I did. Yeah.
So cute.
You see, there was this binary event that happened last night, and boy, was it a Black Swan event.
You literally could do like some research. I swear to God.
Maybe I should. I don't know. I'm sure there's some like call sheet data on it.
Yeah.
Yeah.
Absolutely.
It was wild.
Oh, there definitely is call sheet data on it.
Yeah.
Oh, there's 100%. Yeah, that was that was showing up in my feeds, and I am pretty far removed from just sports, all the sports balls.
Fair enough.
Want to hop into some research?
Let's do it.
Very simple concept that is extremely important, especially right now, because we are in a unique situation where we just had a big move in the market. And we know from historical data, there's pretty high probability that we might have another vol event in the short term. So I wanted to talk about the difference between price correlation, returns correlation, and volatility correlation, because they're fundamentally different things. Options have very complex risk profiles, and that makes managing a short premium portfolio, especially one that's more heavy in short premium positions, much more nuanced than like an equities portfolio, for example. So I wanted to talk about why that difference is so important and why protection is something that you need to think about a little bit differently when it comes to these kind of more complex products. Make sense?
Makes sense.
Love it.
Easy. So diversifying an options heavy portfolio is nuanced, right? Especially one with short premium positions, which have like that unlikely tail risk. And like the typical like bread and butter strategy for diversification in like an equities portfolio is underlying diversification, right? Like you pick underlyings, you pick symbols that have historically had like kind of like opposite price movements, or they tend to move in like opposite directions, such that if there's a drop in the market or drop in kind of whatever, sector, industry, whatever you have exposure to, you can like buffer some of those downward movements and have more consistent long-term gains going forward. But with options, directional protection does not protect you alone because there is a volatility component. So I wanted to take a look at how like this concept of implied volatility correlation can undermine what might seem to be a well-diversified portfolio. And here we're going to use SPY and TLT, which have historically been like inversely correlated price movements, returns movements, although we've seen a bit of a reversal of that in the last couple of years. Make sense?
Makes sense.
Cool. Let's hop into it. Okay, so this is looking at the 3-month returns correlation between SPY and TLT on the next slide. And actually very interesting. Can we go to the next slide? Yeah, there we go. Actually very interesting. So these historically tend to move in opposite directions, although we've seen like a bit of a reversal in the last couple of years. We're seeing something similar in gold, and there's going to be a piece about that on Monday. But this seemed like a good kind of like, example to kind of use just because of the historical relationship between returns for the S&P 500 and for bonds. So typically like inversely correlated, looking at the last 10 years, it's pretty flat. Like there's pretty much no correlation if you look at the whole time frame between these two assets. Although we see that ebbs and flows, right?
Yeah.
So
going from 0 to -5, I would say like correlation you can hang your hat on is like 0.5 and above or 0.5 and below. So to your point, we're kind of chopping within that, but it has reversed in terms of being slightly negative to slightly positive.
Which has been a very interesting trend, actually. Not the same level of diversification that you normally get from bonds or gold. So that's going to be like an interesting follow-up study. But historically, when we look at kind of like the long term, these movements tend to kind of like cancel each other out to an extent, which is like, why you would put some of these defensive assets into like an equities portfolio to kind of hedge against, any sort of potential drops in the market. Right.
Yeah.
So if we go to the next slide, this kind of exemplifies that. So just looking at the last 10 years, like the correlation, rolling 3-month correlation has been positive about 30% of the time. It fluctuates quite a bit, but just looking at the overall period correlation, it's negative 0.16. So just long term, these, tend to move in kind of independent, roughly directions, although we can see that fluctuates, especially the last couple of years. But if we go to the next slide and we look at the implied volatility correlation between these two, we can see that it is consistently positive, minus one wacky day in between 2020 and 2021. Wonder what happened there. But the implied volatility correlations of SPY and TLT are actually consistently high and consistently positive. And so if we then go to the next slide, what that tells us is that even though we might get some directional buffer from SPY and TLT in this example, like historically moving in either opposite or independent directions, the implied volatilities for short premium positions for these two assets are more likely to move together. When there's a big vol event in the market, that happens kind of across everything, right? Which means that even though you might have some buffer from the directional movements, the implied volatility, especially for short premium positions, still leaves some exposure there. So it doesn't offer complete protection.
Yeah.
Yeah.
I think the shifting nature of this relationship is the key here for me. And we say this all the time. Like if you're trying to trade a pairs trade or a highly correlated asset, again, it's got to be like above 5, below -5. Like that's where you can really get into those trades. But when you have something like this that's fluctuating, it's hard to hang your hat on the relationship, clearly.
Right. And that's kind of why like price diversification is something that like it's not I would argue a very reliable strategy for short premium portfolios. You can use it for maybe like short-term, capturing short-term deviations in the trend or short-term trends, the relationships between these two assets. But diversification with options is something that we would really use the Greeks for more, a little bit. And this is where that Vega comes in, right? So like these two positions, like if you had a short put in SPY and short put in TLT, those Vegas would be the same sign, although they're not additive. So this is where like those Greeks come in really, really handy for risk management, where the traditional approach of looking at like price correlations would not be as the best metric necessarily to use here because of these other nuances in the risk profile. Yeah?
Yeah.
So we go to the takeaways. Underlying diversification can be used to hedge against directional price movement, but it becomes less effective in a short premium portfolio because of this implied volatility component. Even though a pair might have uncorrelated prices or inversely correlated prices historically, the IVs, especially during market-wide events, tend to kind of increase together. One of the more effective ways to kind of mitigate these risks, and we've talked about it before, is just by limiting the capital applied to short premium positions overall. That is like one of the more effective ways to protect against the capital because underlying diversification just doesn't get you there. And 50% is kind of like the maximum that we've talked about in the past, although it depends a lot on your risk preferences and your account size, right? But like that's, one of those more, I would say like reliable strategies, arguably, versus underlying price diversification.
Yeah. And I think we can't emphasize that enough, like leaving cash on the side. You're already trading leveraged products. You have leverage by way of buying power reduction, relief, and really the sweet sauce or the secret sauce of options trading for me is just the ability to manipulate it. And you can't manipulate it if you trade too large and you don't have enough cash on the side to do just that. So love it.
Yeah. Yeah. That's all I got.
Cool.
Good stuff.
Well, thanks, Julia. Appreciate you. E-minis selling off here as we've talked about. Tim Knight, I guess, is the bearer of bad market news. E-minis down 11. up 11 only. NASDAQ up 220, about cut in half
It was just
ultimately.
Up 56 or so.
Yeah, craziness. We're going to take a quick 90-second break. We'll see you on the other side. You're watching Tasty Live.
Cool. Just my.
Well.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Just for a minute, let's forget about your favorite stocks. Just for 1 second, let's leave specific strategies on the shelf. Let's talk about what really matters. Your portfolio. How do you build it? What should you target? How do you manage it day to day? The answers to these questions and more are inside our newest crash course. So I'll see you there.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Are watching Tasty Live. We hope you are enjoying this morning as much as we are. E-minis have been bouncing around. We're broadcasting on Tasty Live's YouTube channel as well. Please join us there. Just head over to Tasty Live. You can pop in your trade ideas and questions and some comments along the right-hand side chat. We've seen some interesting comments this morning.
Yeah.
But we've got Jermal, we've got Glenn in the house. How you doing, boys?
Glenn, what's happening?
Pleasure to be back here, guys. This is intimate. I like this.
Yeah. No, we like it. What did you hear? Hello? What? No, actually, no, we don't care. We don't care what you're thinking about the phone. The phone is going to stay. Yeah, thanks. All right, bye. Sorry.
Click.
Yeah, that's what we need. We did the soundboard. That's what we need.
Yeah.
Yes, we see the there it is. We see the YouTube chat, and a lot of fixation on the phone. I mean,
what's the problem? I mean, you know what's funny? I saw something recently that's one of the hot things right now, like a tin can phone for kids. It's like one of the hottest thing, a landline. Like seriously?
Yeah,
landline.
It's right up there with dinosaurs.
And it's like $100. $100 for a damn landline?
That's different. Yeah.
No chance.
What about like the super thick ones, like the 80s, where you had the brick phone?
Yeah.
The satellite phones.
Watch it come back. You watch. It's like things go. This is going to sound weird, but I'm just going to put it. Things go up in size and then they come down in size. Like phones.
Like
right?
phones.
Like
exactly like phones. Now foldable.
Remember how, well, you don't remember. They were big, dude. Like Mike said, the big brick phones. And people would be on the side of the highway, you know what I mean, to get antennas out and like stop and get the phone. Yeah. Then they went all the way down to that size, right? The phones were like this and everybody wanted a smaller phone.
Yeah.
Now look at them. They're going back up.
Yeah.
Well, now they can do everything.
How about a car phone? You know what a car phone is?
It's like the brick phone.
The brick.
Right?
You just slam it right back in that car and we're golden.
Yeah, but did you ever see a car phone?
No.
Yeah, I didn't think so.
But do you accidentally like try and put it in reverse and just like pick up the phone? Where was it? It was in the middle console.
It was in the middle console, yeah.
I think they feature that a lot in Wall Street. That movie Wall Street.
Definitely.
With, Michael Douglas.
Oh, that movie is like a timepiece, basically.
They're
It's like
always
a
on the
period
bricks.
piece.
They're like, "Ooh, we got the deals going on."
That movie captured a moment in time for sure.
When I think of the brick phones, I think of Narcos. Because that's how they had the planes.
Yeah, I didn't watch that show.
Phones.
Pablo Escobar.
Yeah.
I mean, I've you know, like I was the way I felt at the time. I've seen a lot of shows. First of all, I'm from Miami at a certain time. I know that story. I don't just show me something else. Like, you ever see Cocaine Cowboys? If you see Cocaine Cowboys, like that's the real. Like
That's
Cocaine
real.
Cowboys is amazing. You guys ever see that?
No.
Yeah, it's great.
Miami.
Yeah.
It's a Miami version.
Yeah, check it out.
I watch-
Cocaine Cowboys is dope.
Interesting. I watch Narcos, try and pick up a little more Spanish. Girlfriend, Mexican. We've got
It's a big day.
Mexico playing today.
Today's a big day.
My cousin plays for the national team, so
Today's
we're
a big day
excited
for
to
you.
see
You
Brian
know why?
Gutierrez. Why?
Because if they lose,
Oh yeah, bad, bad.
it's gonna be a bad night. It's gonna be a bad night.
Yeah, no, that's the best part about this expanded format, 48 teams for this World Cup is there are a lot of games where there's only downside for a lot of these teams. It's like,
My wife's a
You
Packers fan. When they lose, it's not good. I mean, as much as I may relish in it, being a Bears fan, it's not good.
Yeah.
And if the Packers and the Badgers lose in the same weekend, forget about it, dude. Like, I mean, it's not good. So I hope Mexico wins today.
Me too.
I think
I'm
they
rooting
will.
for you, Glenn.
Thank
Rooting for you.
I think they will. So we hear little birdie told us that we had an interest rate hike recently.
We did just this morning from the Euro area, European Central Bank hiking for the first time in almost 3 years, hiking back from around 2% to 2.25%, their deposit rate, overnight rate equivalent. And that sounds cool. That's a great headline. What did it mean for the spot euro dollar this morning? Really nothing. ECB President Lagarde not giving us much, not giving much forward guidance, saying, this was widely expected, didn't get a jump on the news or any of the three scenarios that they laid out. And so we've seen, if you're able to scalp very quickly, like we've seen in the equity markets today, you're getting a healthy-ish range, but no real trending direction there. Outside of the euro dollar, everyone's favorite, we are seeing a stronger dollar across the board. Yep, Mike's pumping his fist. He's out of his long-term U.S. dollar Swiss franc position, but did the market care? No, it didn't. Now we're hitting 80 in that pair, new highs there, and new highs for this U.S. dollar against the Canadian dollar. That hitting 1.4 for the first time since December 2025. So that one's been. That one looks kind of like a NASDAQ chart, not as ridiculous of magnitude, but in terms of just really stair-stepping higher from the start of May onward. If you zoom out a little bit in this pair, you've seen this, we're approaching a kind of former resistance cluster. So
is this chart right here more of a dollar story or more of a weakness of the Canadian dollar?
Yeah, no, this one's more of a dollar story, and the Canadian part of it, I would say, is just kind of a lack of demand. I mean, if you're trying to play more risk-on currencies, you're looking at something like an Australian dollar, a New Zealand dollar, one of these more interesting narratives. Canada not really helping itself from that standpoint. But yeah, right now, the strike's escalating with Iran. It's given the dollar a bit of a lift here, despite a lot of mixed, slightly softer inflation data this week. We've got the Fed next week, so perhaps we'll get into this kind of dead period up until that decision. But it's the first time we got Big Kev on the mic, so I'm looking forward to it and looking forward to seeing how we get into this weekend if there is a ton of overnight weekend risk because of the escalating Iran situation. We'll see.
Yo, yeah, Big Kev. Yeah, what's up? Yeah, look, Glenn thinks that, he's rooting for you, but he thinks that you really need to get it together, okay?
Make sure he wears a purple tie.
And make sure you wear a purple tie, yeah.
Go Cats.
Go Cats, indeed. It's almost a requirement. But yeah, it's really interesting to see when we looked at the interest rate hike and then you look at the currencies here, like I thought the euro dollar would be moving a lot more than it is. So I think the pricing in of that is all but true. But Glenn, appreciate you as always. Go Mexico.
Mexico.
Is that what they're saying? Go Mexico?
Sure.
Cool. That'll work. We will.
Viva Mexico.
Yeah. Viva la Mexico. There we go. Viva la Mexico.
Dale, dale.
Don't you speak Spanish, guys? Come on.
Dale, 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 Chicago.
Yeah, there you go.
Ooh,
See?
I like that.
See,
We're going to go with that.
UIC, Chan.
Yeah. We're going to take a quick 90-second break. Markets haven't moved too much from previous levels, but we'll see you on the other side. You're watching Tasty Live.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
It's time to trade smart, post PDT rule elimination. And Tasty Trade has the tools traders need. The Active Trader tab's comprehensive market data is designed for rapid order placement in a single click, while bracket orders let traders set entry, profit target, and stop loss all in one ticket. From the Positions tab, you can monitor positions, roll trades, close positions, and create conditional orders. Now, traders of all account sizes have more flexibility than ever before to engage in the markets. Smart tools for smart traders. Tasty.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
What's up, everyone? Welcome back to the show. You're watching Tasty Live. Please join us on the YouTube channel. Let us know what else we should pick up and talk into next. We've got the red phone checked.
Yeah.
But yeah, joining me is Jermal and Q. Q, are you feeling better than you were yesterday in terms of rest, relaxation? Oh, sorry, you can't say anything.
Oh, yeah. Oh, man. Our bad.
My apologies. Q, hello.
Hey, Q.
Now this
What's happening?
Thank you for bringing me in, fellas. How are you guys doing?
Good, man. The chat was ablaze yesterday with you, and we talked about your powerlifting skills, but they were focused on other things. They were focused on your gams there, man. I mean,
big thighs save lives.
Yeah.
Thank you. We try. You know, there's this other guy on the desk. I don't know if you guys know him, Andre. A lot of people, you know, he takes a lot of calls. So if you called in, you probably know who I'm talking about. But Andre loves to comment on my backside when I wear sweatpants in the office. On Fridays, I like to wear sweatpants. I'm like, it's, you know, hoodie Friday or sweatpants Friday, because we can wear whatever we want in the office, which is great.
It's a perk. It's a nice perk.
Yeah, I'll wear sweatpants on Friday. And then he'll be like, damn, Q. And he's like some big Russian guy. And I'm like, all right, I'm a little afraid.
Yeah, oh, yeah, him. Yeah, that dude's big as hell. Yeah, I mean, I'm sizable. Mike's sizable. That dude's big as hell.
He's, yeah, you don't want to mess with
him. Hell.
Like, I feel like it comes off through the phone, too. You could tell just like by the way he talks. It's like, you don't want to mess with this.
He doesn't have like a
Mike when he tells you need to close out of a position because you're in a margin call, you feel it. You're like, okay. You know what? I'm going to close.
I'm sorry I ever got into this position.
We just need to send him to people's houses to go close out that margin call, probably. I mean, I think
right. Yeah.
It'll be more effective.
Yeah.
Show up at the door, you know.
But yeah, if you got it, flaunt it. All right. That's what they say. So
there you go.
Yeah.
And so I got some stuff to go over today.
Do you?
Because tomorrow big day for SpaceX IPO. And so when it comes to trading the SpaceX IPO, right, it's not available right away, right at the open. And so it's typically available somewhere like mid-morning to early afternoon, just because the exchanges aren't ready for all the like regular volume yet. And so just be aware of that. At 8:30 Central, you're not going to be able to buy SpaceX right away. It'll be available once it's available on like the national exchanges. That's when it'll be available at Tasty Trade. So just little PSA out there if you're excited to trade it. And then also when it comes to the options as well, a lot of our customers want to trade the options too. Those will be available probably something like Monday or Tuesday. They should get listed pretty quickly, but they won't be available on the exchanges tomorrow.
Yeah, we had an exchange veteran on yesterday, Henry Schwartz. He thinks free works receivable. He thinks Tuesday. So
yeah,
it's probably.
I would think Tuesday as well. I know like Cerberus had options really quickly, and so I'm thinking SpaceX should probably be the same.
Yeah, it's gonna be super exciting. But good call out. I think you'll probably see the ticker symbol earlier than the launch itself, but you'll start to see the market moving around. And that will be the green light for available.
Like you said, we've been talking about it for 3 weeks. I put it in my watch list like 2 weeks ago.
Yeah.
Or he just put it in just for the heck of it.
Yeah. It's going to be wild.
Yeah, and then also when it comes to like the options and stuff like that, once they're listed, be careful with the prices that you're putting in, just because there's probably going to be a lot of price discovery when it comes to these IPOs. The markets, they might be a little wide. So just be aware of that. Don't be afraid to put in your limit and then just let it sit there. If you want to, if you want that price, you can wait for that price. It might not be, it's not going to be like SPY right away or Tesla right away day one.
Yeah. Even IBIT, I keep going back to that because IBIT launched and the markets were like 50-cent dollar wide. And I was like, this is not going to be like this forever. Like people are going to start trading this. This is going to be the number one thing. And now it is in terms of IBIT, Bitcoin exposure. And now those are 5-cent wide, 10-cent wide. So probably a similar situation. But at the same time, it's going to be 100% IV product probably for the lifetime of the product itself.
Yeah, so really. Yeah.
That's going to create some more width between the bid-ask spread. So to your point, just watch your pricing, and price discovery might just be a normal thing for that product.
Yeah, for sure. At least in the early days, first couple of weeks, I would think so.
Yeah. So what do you got for us today?
All right.
Interesting symbols.
Yeah, let's go over the list. Top 20 symbols going through the system and their IVR. At number 1, we've got Oracle with a 47, Intel 85, TQQQ 81, Tesla 47, Micron 95, Microsoft 61, Nvidia 41, Google 47, Amazon 29, Meta 46, AMD 94, Apple 48, GLD 57, SLV 37, SOXL 100, Palantir 26, Marvell 87, SPCE 49, NBIS 91, and Robinhood 64.
Man, it's
NASDAQ.
A lot of names, a lot of NASDAQ. Yeah, gold and silver has creeped back in the last couple of days, but it remains to be the case. And again, that's where the liquidity is. That's where the volume is. So it's not surprising.
Yeah, and that TQQQ with the big intraday ranges, see a lot of customers trading that.
Creeping up to that number 1 spot. Can it take it over?
That would be crazy.
That would be insane.
If it got number 1. Yeah, triple leverage. Yeah.
Triple leverage, number 1 traded.
Yeah,
that'd be nuts.
That would be crazy. Exciting times though. Exciting times for the retail trader. A lot of things are moving.
Yeah, for sure, man.
Yeah, it's crazy. It's actually wild that QQQ only has 15 million shares traded today. TQQQ has 40 million shares traded today. I always like to compare these, like SPY, IBIT. Yeah, TQQQ is just flying off like crazy. But the NASDAQ is what's moving. Like we've seen it time and time again. This new relationship, like back in the day, it used to be E-mini's up 30, NASDAQ would be up 90. It was like a 3-to-1. Where like E-mini's up 7, NASDAQ up 21. Now you're seeing a 10-to-1. E-mini's up 30, NASDAQ up 300. So kind of crazy, but we'll see. I have faith that TQQQ can take over the number 1 spot.
Yeah.
But again, that might spell trouble.
That's exactly what I was going to say. I think
and it's an interesting product because, not everyone might have the size or the risk tolerance to trade futures. And so you could trade like a leveraged ETF, which you can size into a lot more specifically, and it's not as large of a product. There is slightly less leverage when it comes to TQQQ, even though it is 3 times leverage, right? But it's not as potentially like scary as some might see when it comes to futures.
Cool. Well, Q, appreciate you. We're going to install the leg cam soon, so we'll give the people what they want.
Let's do it. Give them a small physique update.
Yeah. Awesome. Thanks for tuning in. We're going to take a quick 90-second break. You were watching Tasty Live.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day. Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
What's up, Tasty Nation? Welcome back to the show. My name is Mike. I'm here with Jermal, and we've got Dr. Jim on the line for a little skinny action. I like the daily skinny.
Dr. J.
Yeah.
Man, daily skinny. Man, we're getting after it, man. Like, we're getting after it. Not unlike the PPI print this morning. Like, gentlemen, I mean, I guess it came in line, right? But these numbers are high, guys. These numbers are high.
I mean, we talk about this all the time. Like, I try and save some money by going to Costco. I try and save at the pump, but it's becoming impossible when it comes to the inflationary nature of everything.
Yeah, it is. I mean, these are numbers. And that's the thing. Having been around trading for a while, never paid attention to PPI, never paid attention to CPI until 2022.
Yeah.
And over these last 4 years, it's been something we've had to watch and keep an eye on, and it's affected markets. So yeah, it's just persisting, and it hasn't really changed much.
Yeah, it's crazy. No, it's totally crazy. But then the market reaction today, I mean, is that not even crazier? I mean, look at this reversal. I mean, I know there's other things happening with US and Iran, whatever, but I mean, I don't think we're that much closer to a deal, are we? Like, I think it's kind of just more of the same.
Yeah.
Yeah. I can't follow that soap opera. I really can't. I don't understand it. I don't.
You just checked out, man. Like, there's some wisdom right there. Like, I'm done. I can't do it. I mean, I think we should all follow in your footsteps.
I'm not a joint chiefs of staff. I don't understand this crap. Like, I mean, dude, and it's psychological. You know, there's a lot of psychological warfare going on too, as you would imagine in this situation. Nobody's going to tell everybody the exact truth. So how can I follow along? I just got to watch price. It's one of those times where watching price action really does just save you. I think it helps.
Yeah, it reminds me of the Chicago Bears going to Indiana. I saw a tweet where it was like, "Are you happy? Are you sad? Or are you over it?" And it was like 70% of people just said, "I'm over it." Like, it's just one of those things. Like, that's when you know you messed up, when you're playing with the hearts of fans and you're like, "We're going there. We're not going there." And that's the same thing with the crude oil situation in Iran. Like, we've seen market down, crude up, market up, crude down, war off, war on, and now it's to the point where like the market is even pricing in that it's going to be over eventually, but still at elevated crude levels.
Yeah. No, it's totally crazy. But all right, but let's get into this morning's skinny because we have a lot to get into. And so let's go ahead and do it. So Greeks, short-term and long-term. So I think when we look at our Greek short-term versus long-term, it can be very, very, very different. So the option pricing model, such as the Black-Scholes model, sets the stage for much of the trade analysis that we implement on a daily basis. Specifically, the Greeks that are output from that model provide us with plenty of opportunities to find trades in the market. But all Greeks are not created equally, especially when you compare short-term versus long-term impacts. Gentlemen, day to day, what is the one Greek that you're looking at more than any other?
Delta.
Yeah.
That's it.
The
That's
end.
the only
Show's
answer,
over.
right? I mean, could there be another answer? Like, I don't know that there really could be. Like, day to day, it's got to be Delta.
And you know what? I feel like at this point, I don't even look at Delta. I just kind of know it. But I mean, that's where we are in our trading careers, right? But I just kind of know what my Delta is. That's why I can go ahead and put that SVX put spread on this morning, because I know what my Delta is in my book. I know what positions are going to move if we do XYZ. Like, yeah, for sure.
Yeah, I mean, it's 100% got to be Delta. So, Laura, go ahead and click us. Click us on the next slide. So, when we think about Delta being the driver, that's absolutely true day to day. But then when we flip to the long term, I'm going to posit it actually shifts over to Theta now. Because now when you start thinking about what we're trying to do, especially as a premium seller, it's like, well, I want to take advantage of time. I want to take advantage of time decay, blah, 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 blah. It's like, well, day to day, I'm managing my Delta because I need to manage my directional risk. Market's random, unpredictable. It's like, man, I got to make sure that I understand what I'm signing up for with leverage and direction. But over time, it's actually going to be a much greater emphasis on something like Theta, especially in my portfolio Theta levels, because that's going to show me how much decay am I working with kind of in the aggregate when it comes to, extrinsic value coming off of the options and what I'm primarily trying to tap into as an option seller.
Makes sense.
I think Theta isn't something I look on day to day because Delta is such a bigger driver of it. But to your point, 30 days from now, 45 days from now, like Theta is going to eliminate a ton of extrinsic value regardless of Delta. And I think that's the key. Like Delta can be intrinsic and extrinsic value from an effect standpoint, but Theta is just a pure extrinsic value drag over time. And that can either help you or hurt you depending on your strategy.
That's exactly right. And it's like, again, it's like the thing that's going to potentially put me behind the eight ball the most quickly is going to be Delta. It's going to be the directional move. It's when we think about the option P&L, we talked about this just the other day, I think earlier this week. It's like it's Delta, it's Theta, and it's Vega, right? It's direction, time, and volatility that are going to drive our P&L on any given position. Well, of those three, Delta is going to be the lion's share of the P&L move on most days. Theta is not going to be the big driver. Theta is going to be, 8 cents or 10 cents or 12 cents a day, whatever. And then Vega, sometimes with a big expansion or big contraction, that can play a big role. But most of the time, it's going to be Delta day to day without question.
100%. Yeah, Vega, I would say from a day-to-day standpoint is isolated to binary events, earnings announcements, those kind of things where it can really play a big role. But when you don't have those things, it's definitely going to be Delta from a day-to-day standpoint and then Theta long-term.
That's exactly right. Yep. So if we take a look at an example, I just, kind of worked up a fictitious example, hypothetical example, but this makes the exact point that we want to make this morning. So let's say over 5 days, you've got a Delta on an option of 35 and you have a Theta of 4. Obviously, Delta, Theta are not static, they're dynamic, but still, just to make the point we want to make this morning to keep things kind of simple. Well, let's say the first day that, I make 35 cents from Delta. So the stock goes up by $1 and I make my 4 cents from Theta. Okay. But then the next day, the stock moves $2 against me and I lose 70 cents on Delta. I still make my 4 cents on Theta. The third day, I lose another $1 on Delta, so I lose 35 cents on the option price because the stock moved $1 against me. I pick up another 4 cents. The next day, I lose, another 35 cents because the stock moved another $1 against me. And then the last day, the stock moves $4 in my favor. I get all that Delta pricing back. But look at Theta just trucking along, right? Like this situation, it plays out so often, so many times in the marketplace when it comes to, directionally in Delta, it just kind of chops around it. You end up right back where you started, but Theta is trucking along the entire time.
Yeah. And I think this is the power of doing a year-long trade like we have in the MES and MNQ. Like we've gone from MES 2026, 7,000 open down to 6,300, the rocket ship up to 7,700. Now we're sitting 400 points lower, but because we've picked up all that Theta value over time and we've adjusted our Delta, we're sitting on a nice profitable trade. And like these are the types of trades where you really see the effect of Delta. But to your point, it's got to be something that's more long-term, has more longevity, because day to day, you just don't see it until it adds up.
That's right. That's exactly right. Yeah. Jermal, what do you think?
No, yeah, man. I mean, Mike said it best. I mean, it's one of those things where you're focused on Delta, but the ability, Theta is just working in the background, right? Yeah. And so it's kind of a nice thing.
That's 100% right. And so, so day to day, it's Delta. that's going to be the driving force. But then in the end, right, it's going to be that positive theta that's really kind of stockpiling in the background. You're 100% right there, Mike. I mean, longer term, that's what we need to be focused on as volatility sellers, as premium sellers. Theta and volatility, positive theta, negative vega. Those are the things that are non-directional and are going to ultimately kind of move the needle. So let me get them a few takeaways, and then we'll get them to we'll get you all to the next segment. I think the final look is coming up. So the Black-Scholes model gives quantitatively minded traders like us ample opportunities for analysis, not the least of which is studying the Greeks that come out of the model, such as delta and theta. Still, it's critical to remember that the short-term impacts and long-term impacts of different Greeks are very, very different.
Yeah.
Beautiful. Yeah.
Yeah, I would say this is spot on, obviously, because you're a doctor. But yeah, Delta's number one thing. And yeah, if you have your platform set up, I would make sure you've got Delta on there. You've got Theta on there just to make sure you're on the right side of it.
Beta weighted Deltas too.
Yeah. Yeah. But yeah, I think Delta day to day, obviously going to be a big driver of option premium. But over time, Theta really starts to add up and play a role, especially if you're in a long-term position. You have a core position like an MES or MNQ, like we've got. And yeah, it's really wild to see just how much that picks up. Like our MES position and your MNQ position, we started with like a couple $100. Mine's up to $3,400 in premium, and it's June. Like this is going to be a $7,000 credit by the end of the year, I would imagine, just by picking up, a couple dollars every single time we make an adjustment.
Yeah, for sure, man.
It's crazy.
Actually, I just
That's
made an
right.
adjustment
That's
today.
right.
Yeah. Well, Dr. Jim, do you have any? I know you're a sports guy. Do you have any allegiances in the World Cup before we let you go?
Not in the World Cup. Who's playing again?
Everybody, every country.
It just got started. Oh yeah, I know. I got you. I didn't know if it was down to the end. Like I'm so out of the loop. I have no idea. I'm still. It just started. Okay, yeah. I mean, I'm all in on my Knicks. I mean, I've been a Knicks fan from the beginning. Like you guys know that. I've been talking about this for many, many years. Hey. So I'm all in on my Knicks, and that's it, man. It's all about Ewing and Starks. I think I get it done.
Honestly, what a crazy comeback. We've talked about this this morning.
Wild last night,
that was a 3 standard deviation, probably a 4 or 5 standard deviation move, I would say.
Yeah.
From the
that was silver. That was silver January of this year. That's what that was.
Absolutely. Well, thank you, Dr. Jim. You can root for Mexico. We have a lot of Mexico fans. There you go. That's your team.
I like it.
Appreciate you. E-minis up 20. NASDAQ up 250. We are just chopping around.
Had Ewing and Starks.
He was trying to show that he has been a fan.
Yeah, exactly.
I think he got it. I think he proved it.
It's funny.
But yeah, I love seeing the older guys on the floor. Like I remember David Robinson was on the floor in the Spurs game when they were coming back to win, and he was like, hand over his head, just like rooting like that. I think
Yeah. That was those dudes last night. Like some of those old I saw Larry Johnson and I think Stephon Marbury. Like it's kind of funny. I mean, that's the beautiful part about like last night, just seeing some of the reactions of some of the people, like not only the old players, but like former players, but they showed Seinfeld,
Chalamet.
Yeah, you know what I mean. And they obviously Taylor Swift, had the spotlight. She was there last night. But all the nerdy people. What did they notice? Not Taylor Swift. They noticed Paul Tudor Jones sitting right behind her. That's all the nerdy financial people are like, oh, I see that guy. I didn't even see him in the picture. They were all over it. It's a trip.
It's amazing. We'll see what the series brings. But 2 games in San Antonio, 1 game left in New York. Would be poetic if they lost in San Antonio just to win at home.
In New York. Oh my God.
Be nuts.
People were almost all over the floor last night.
Yeah. Just jumping out there. Oh, it would be just
Starks was like all on the floor. My wife was like, "Can he do that? He's got to be careful." I was like, "He doesn't have to be careful.
Yeah.
They're not going to do anything."
No. But yeah, crazy moves in the market, crazy moves in basketball. World Cup starting soon here. It's going to be a blast. But yeah, Oracle down 22 points now, chopping around. That Super Bowl we put on this morning, working nicely. But yeah, I just want to see like a 10-point rip higher over the next week or two. And this will be a multi-$100 trade. Microsoft can't catch a bid at all. This is really surprising to me, but we're getting back to that territory where it's like I'm just going to buy it here with some longer-term positioning and see what happens. But I mean, this is literally 2 weeks in a row, just selling, down almost 100 points from the recent high after ripping from 410 to 460 in 3 trading sessions.
Yeah, it's been back to like software is unloved once again. CRM has the same profile if you look at it. So does Palantir.
Yeah. Oracle. So you got into the same trade, the 170, 160, 200, 210. Same with me.
Yep.
What's the M&Q adjustment you made?
I adjusted my short call was the 32K. I turned it I turned the year long trade into a straddle now. So
Nice.
I've been short that 31,000 put. Just decided it was time to roll this down and collect a little more premium. So yeah, that's what we got going on.
I like it. And then micro crude. I got filled on that. So just rolling the 92 strike out from the 1 day to the 5 day. And the net credit now with this $7 credit that I got is up to 657. So that's kind of crazy. I mean,
here. So the other day when I talked 2 days ago when we had the big down move in the market, put on some trades in SPX. One was a call spread that ended up, I think it was like the 73.50, 73.75, which worked out well. But I also had a bunch of calendars. Started coming up with this idea of buying. It started with the idea of buying this Friday to sell Thursday. It was like the cheapest I could do, 7,500, and I think I did like 75.50, 74.50, something along those lines.
Yeah.
And then I was like, well, let me just go further out and do a couple of these. Maybe all this blows over by next week. So I started doing June expiration versus. I wanted to do the 18th versus the 12th, but it was a little too expensive. So I decided, what's the next catalyst? Well, June 16th, we do have a Fed meeting, right? So decided to do calendars, same strike calendars in that way as well. And when we bounced back on Tuesday, took everything off. But now that we're back to we're getting close to levels where near Tuesday's low. And I just put one out earlier while we were on. I know Julia probably thought I wasn't paying attention. I was like, oh, let me put these trades. I wanted to put them out. So I put out the 7,600 strike calendar, selling June 16 to buy June 18. That got hit. And I also have out the 7,550, also have out the 7,500. So we'll see what happens. But so far I've only gotten hit on the 7,600 strike calendar, put out the 7,550 calendar, and I put out the 7,500 calendar. I think there's something there. We'll see. I mean, this has been a very, how else do I say it? Weak couple of days. I'm not going to say weak. That sounds dumb. It's been a very weak 4 days. You almost anticipate tomorrow being similar, but this could all kind of blow over by next week. And these are, just got filled on another. So I just got filled on the 7,550, paying $4.50 for this. Paid $2.50 for the 7,600 calendar. I got a bid out for. I'm further away now, so this is kind of how you layer in stuff. I got hit on the 7,600 as we're sliding down here, and mind you, bought a put spread earlier this morning. That's the other thing I did, right? But this is one way of trying to like recoup your deltas back and recoup some of your costs back on the put spread that I just put out. That's near term. I'm buying these calls further out. I can leave these things. I don't have to worry about them. I don't have to think about these for a week. You know what I mean? So. Yeah. Got filled on the 450 kind at 70 for the 7550 strike. Got filled on the 250 kind for 7600. Now I'm away. I do want the 7500, but I'm away. I'm not gonna like be aggressive with that. Right now it's $8 bid. I'm $6 bid for that, and it's at 8. So I'm away. Like I don't need to jump in on that when we're sliding lower. I'm probably going to get hit, but I'm a little bit further away on that one.
Yeah, I think it's interesting. You can clearly see there is a bid in the June 18th cycle relative to the 16th, but you're still collecting a lot of premium here, almost $4 against your $10 premium. So 40% of the cost of your 6-day against your short 5-day. And then that was the 7,500 call calendar. And then the 7,550, paying $5, collecting $1.25. So these options, basically you're looking for a smooth rally higher, get all the value out of these shorts, and then these long options that are currently worth $1,600, your net debit's only $10. So you just need these options to maintain a value of over $10, and this will be a nice trade. But yeah, I like it. I like the calendars, especially the near-term calendars where you're kind of wrapped around these binary events. I think it makes a lot of sense.
And again, I'm $200 away from the one that I haven't gotten filled on yet, the 7,500. These are further away on purpose. I feel like these are cheap enough that my portfolio can withstand it. And if we bounce back, which it seemed like if we do, it could be violent, and I don't want it to blow through the strike. So I feel like that's reasonable risk given the time frame.
Yeah. And just like that, E-minis are down 6. NASDAQ up only 75. Seeing a little bit of a market sell-off here. And we basically bounced right from that chart illustration that Tim Knight had. So, and this is what, the third day in a row where once he leaves the air, the market just starts selling off.
Yeah.
There's something about that guy.
It's a thing. It's a thing. It's definitely been happening.
Yeah. But yeah, just a real quick recap from the stuff we got filled on this morning. Oracle, Super Bowl, selling the at-the-money put spread to finance the long call spread. We got the 170, 160 put spread in July. We bought the 200, 210 call spread in July as well for $2.10. Micro crude, I rolled out a week, the 92 strike 1 day into the 5 day, picked up a total of $657. It's up like $250 right now. And then the MNQ adjustment rolling from a strangle to a straddle down to 31,000. So yeah.
And I just posted my trades, the other two, the SPX trades. So those are up there too now.
Awesome. Yeah. We'll keep our eye on the rest of the market the rest of the day. But stay tuned to tastylive.com as well as the YouTube channel. We got plenty more content coming your way. So stay tuned. You're watching Tasty Live.
To rewatch that market measures from this morning, Bodacia. Our raid really distracted me. I was like, get away from me, uncontrollable fire.
I told you, Tasty Cracks, you can't plunder with headphones on. Light pillaging, maybe.
Sometimes I'll hide in a gross peat bog in the middle of a raid just so I don't miss market measures.
I'm only recently comfortable admitting this, but I think I trust market measures more than I trust my savage hellhorse, Arbitrageur.
God, I forgot to tell you guys that I slaughtered a horde of conformerons this morning. Did the whole terrifying row of severed heads on pikes as a warning thing, but you never know with those idiots.
Okay, thanks for the heads up.
Ha ha ha! Goblets of hot blood for everyone.
Nice.
Thanks, you guys.
Normally I hate puns, but that one was okay.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade. It's time to trade smart, post PDT rule elimination. Now, traders of all account sizes have more flexibility than ever before. With rapid order entry and bracket orders that let traders manage entry, profit target, and stop loss, all in one ticket. Tasty Trade.
Hello, everybody, and welcome. We are coming in live with two of my favorite people. We did have to bring in Mr. Vecchio because you're in already, Vecchio. I've got TP and Chris Vecchio. I've got 10 minutes.
All right, Liz.
With a Knicks fan.
You have every right to do this as Lord Humongous. Okay, you call the shots.
We are.
You determine what goes on in the trader wasteland. You own this place, okay?
I do. So TP, you and I'm going to let the viewers know what's happening. We have called in Chris. We probably
as a pinch hitter.
He's a pinch hitter.
We probably woke him up because he was out late last night celebrating, I don't know, some kind of basketball game that was going on yesterday.
No, I think
some kind.
No, I think he's a soccer fan. I think he's doing the FIFA thing. Is that what it is?
I can't have anything nice. Like I root for the Mets and the Jets on the side here, guys. I'm allowed to have the Knicks.
I mean, Chris, we talked about this. I'm married to a New Yorker, so he was so concerned for you when I was talking to you the other day.
Last night was the day. The sun shines a little bit brighter. Who cares that semiconductors are 1% off the high and the Nasdaq's giving it all back today?
Who cares?
The birds are chirping.
Chris, trading, there's no superstition, but whatever you're doing last night, continue to do it so they can get number 4. That's all.
You can't wash your clothes that you were wearing.
I was wearing it in the 1999 playoffs. My dad took me to a round 1 game versus the Hawks when the Knicks were the 8 seed and the Hawks were the 1 seed. That's when they went and played the Spurs. And I bought a T-shirt at the time in a child's XL, thinking I can wear this for a few years. I'll grow out of it one day. Alas, I am one of the shorter members of my family. Some of my cousins are like 6'7", 6'8". At 5'11", I'm like the second shortest member of the family. I never really grew out of that T-shirt, so I got to wear it last night. And a friend brought me a 1999 Knicks playoff towel to adorn with it.
So wait a second. You put on a T-shirt you had since you were, what, 5?
I've 5. Yeah, no, I had a T-shirt that I've had stowed away that I only wear in the playoffs since I was 10 years old.
10.
Long story, he wedges himself into the T-shirt, and we say thank you.
It fits perfectly fine. I just didn't grow that much, apparently.
All right. Picture it didn't happen, Chris. Picture it didn't happen.
True, picture.
I will. I'll send you a photo.
So, Chris, we do not want to keep your time because you need to go rest that voice. You need to gargle some salt water because
Hasn't helped.
You've got a couple games ahead of you. You got to get ready.
I do. The team needs us, and I'm very much one of those people. If a butterfly flaps its wings in the Sahara, then a hurricane forms in the Atlantic.
Yeah,
I can't upset the juju here. Like, we gotta stay focused.
You cannot upset the juju. Now, you were ironically called in because of something I said today, and I'm going to let you say that, and then I'm going to let you exit stage left because I was kind of teasing the Mike and Nick this morning, Mike and Jermal this morning about the rate cut in the ECB, and I said, what comes first? Is it leading or lagging? Like, is this because they cut in the ECB for the first time since 2023? Does that mean does that increase our chances of cutting or decrease our chances of cutting?
They hiked, right? So
hiked. Sorry.
It's definitely more than just Europe right now, and I think you can see it in the PPI data this morning with respect to the inflation pass-through that's happening. The headline numbers were up 1.1% in May. It's now 6.5% over the course of the past year. It's the highest reading since 2022, and everyone remembers the 2022 inflation scare. That wasn't great. But energy, gas prices are up 23.4%. Final demand energy was up 10.7%, and it's on the transportation and warehousing side. That jumped 2.6%. So inflation's moving from fuel into the broader economic pipeline right now, and when it moves from fuel into the broader economic pipeline, it's going to cost money to get those trucks of food to your local grocery stores. Grocery stores are going to want to maintain their very thin margins, so they're going to have to raise prices. The ECB doing so today, they're in a little bit of a different situation than us. They're a little bit more energy dependent on imports from the rest of the world, whereas the U.S. is a little bit more independent in that regard. And so they've seen the inflation bite much harder and faster sooner, and they're worried about the echoes of 2022. So is this the start of something here? Maybe. Warsh probably doesn't hike rates next week. I don't think that's on the menu. But the market's contending with the idea that maybe we get a hike in fourth quarter, and that certainly is not where we want to be going. People like their cheap money.
Did the probabilities of the hikes go up at all?
No, I'm looking at that now. They're all staying the same or low for current. In the July one, a rate hike went up by about 2%.
Okay.
So it's like Chris said, they're kind of independent right now. The U.S. Fed versus the European Central Bank. European Central Bank, who knows what they're doing? I just look at the probabilities. I don't see a whole lot happening in the next couple of months with the Fed.
And a lot can change during that time. So
yeah, exactly.
What's interesting, though, is how the euro reacts to this, because obviously people think, oh, rate hike, stronger currency. Euro's down today on the session. And so when you have those widening interest rate differentials and you're still not getting your currency in a place of a rally, the market's issuing one of two concerns. Either they expect the interest rate differentials to close in the other direction, right? So the difference between the Fed and the ECB rate will eventually compress because the Fed is now hiking, and so whatever advantage the ECB theoretically gains today, it's still going to be eliminated in the future. Or there's just such a big demand for dollars right now in a global liquidity crunch that who cares where the interest rates are? You'd rather have that sweet king dollar in your pocket than whatever that lousy little euro is. So that's the flag here for me. Rate hikes are coming. They're signaling more hikes, and the currency is still down. Not great.
Okay.
Very cool.
Chris, I appreciate it. I appreciate all of your knowledge all the time. You are a wealth of knowledge. So now I need you to get off this screen and go lay down, because I don't know what time you were up till last night.
I think I rewatched the fourth quarter of the game twice when I came home. I don't want to say that. That's out loud. That sounds fanatical, but I am a fan. So, Knicks in 5.
Well, amazing. Knicks in 5. I like it. All right. Your lips to God's ears. Thank you so much, Chris. Go get some rest. We'll be rooting for you. All right. Thanks. Okay. TP. And then there were 2.
Yes. Lord Humongous.
And then
what are we looking at?
So today, so we can go in any direction you want, but I thought today's theme could be, I want to look at the SIBO's most active and talk about open interest versus what is happening with, so we're going to look at the open interest and we're going to see what's trading, because in my opinion, it's been an indicator of where things are going to go. Puts versus calls, what's happening. Are you okay with that?
Yeah, it's a great discussion. I think I might cover that in a video this afternoon. So there are a couple of things going on. We can see on the platform where high open interest is, and you have the SPX up, by the way, Liz. If you open up those 0 DTEs, just for point of reference.
Let me change this. I got to go open up the interest, and I'm going to go volume.
This is now a different world. Okay, and I just got to say, look at the 7250 puts. They're 20 cents wide, Liz.
Yeah, for a $7,000 product, they are very, 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 very tight.
Back when I was a kid, those puts would have been $1 wide at least. $1 wide at least.
I think you're being generous, because a $1 wide market back in the day would have been tight for this type of a product.
100%. This volume and the trading activity, you can say it's a chicken or the egg thing. In other words, does high open interest bring in traders, or do traders bring in high open interest? It doesn't really matter. The point is, what we've seen is the growth in the trading activity. Doesn't mean it's easier to make money. It's not what I'm saying. It's easier to execute trades. Less slippage, faster executions. I gotta love this stuff.
So the more players in the game, I do agree with you. So everybody's like, oh, well, what if you guys got to stop saying this, because you're gonna let out the secret sauce. The more players in the game that there are, the more liquidity that there is, the tighter and more efficient the markets become. Right?
Can I just address that point? Liz, I've been doing this for 30 plus years. I've been watching retail traders for 25 years. You can lead the horse to water, but you can't make him drink. No matter how much you might explain to people what a good strategy is, what a bad strategy is, they still keep doing it. They'll keep buying those out of the money puts, buying out of the money calls, thinking today's going to be the big day down and up, and sometimes they get it. But no, it is, like you said, Liz, the activity is what protects you from the one-sidedness.
Correct. Well said, TP. All right, I'm going to show you something. Let me see if I can move my screen a little bit. There we go. Here we go. So here is the SIBO's most active, which I do like to look at. And I love this because Frank will sometimes post the volume calls over puts and how they're going. I'm going to go back to so we're in SPX. But so I kind of glance down here and look at this. So this is probably one of the first times you're seeing this. So I'm going to say calls are on one side. There's the expiries of everything it's trading, and puts are on the other side, and there's the expiries. And this is index options. I just want to show you something real quick. This is
they're all the 0 DTEs.
They're all the 0 DTEs. So I was going to scroll down to see where we can find a non-zero. And so far,
keep scrolling.
Oh, here you go. Here's the VIX option.
Oh, there's one in the VIX.
In the VIX, yes.
Oh, wait a second. Yeah, they're in the VIX.
It's in the VIX. So if you take a look at this, it's every option on the board in the SPX is the 0 DTEs. And when I would look at these before, I kind of glanced too and look volume to volume. And in 9 times out of 10 TP, you're seeing calls. I would argue that this is pretty evenly spaced, right? I mean, your first on the board is the 7,200. There's 36,000 that are traded.
Yeah.
Oh, and the reason I referenced open interest, so this is volume, correct? So open interest is what was already open. So you and I, as traders, know. And actually, I'm gonna let you take it from here. But let's take a look. Let's take a look at the and we can bounce back and forth. But let's take a look only because it's a round number. Let's look at the 7,400 call, and about 30,000 have traded today. And then I will reference open interest. So let's go back here. What did I say? The 7,300.
7,400.
Was it 73 or 74? Let me look. It's the 7,400. And the 73 is right underneath it. So just to keep things at the money, 25,000 of the 73 have traded. You come right here. Here's the 73. I have it on open interest and volume. The open interest, this is what I find fascinating. The open interest on this line right here is only 1,000, about 1,000.
Like 1,100. So in other words, it's Ks, right? It's in thousands. And so the open interest, I am very certain, is updated overnight. Okay?
It is.
Because it's back in the day, and I think this was true for you, Liz, at the CBO. I was at the Board of Trade. When on the floor, seller reports. And what that means is the buyer and the seller write up tickets. All right, Dierking, what are you doing? Blah, 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 blah. She's buying, I'm selling. So the court report or the pit report or the trade, the person, the exchange employee who keeps track of all the trades and who gets, all right, Liz bought these puts for 11, TP sold them for 11, that the seller hands in the ticket to the reporter, the clerk, the exchange clerk who keeps track of all this stuff. So what you see is 1,100 contracts are still open. Doesn't mean that there are an equal number of longs and shorts. There are 1,100 contracts that are long, 1,100 that are short. That's the open interest. What you see today is 25,000 new positions opened. Today, thank you. This morning, in the past 2 hours. So if this were not a 0 DTE, okay, we're going to do a little conceptual jump here. If this were not a 0 DTE and the numbers stayed as they are, the open interest would probably go up to 27,000, something like that.
Well, and I do want to put a little bit of an addendum in here, because sometimes you can take a look at it and you'll see the volume. Say the volume was 25,000, but the open interest was 50,000. It could be a closing order. So volume goes in as closing orders too. So I want people to realize that. So this is why it's a good example on that line we're on. There's 1,100 open interest and 25,000 have traded. So tomorrow it very well could have been, if it weren't a 0, could be 23,000. They could have closed those, and then
you don't know.
We don't know. You don't know. You don't know.
But here's the thing, because these are 0 DTEs, they disappear this afternoon. Okay. Poof. And that's what was that? Poof?
They're gone.
Lord Humongous says they poof, therefore they poof. Okay.
That's right.
So the point is that this trading activity right now, for me, the volume is more interesting than the open interest, because sometimes, Liz, not all the time, I'll look for high open interest, maybe not in the 0 DTEs, but maybe in a weekly option, something like that, to see if it might pin at that strike. That is an unreliable indicator for me.
No, but I think it's a good thing to do. So I'm going to actually go to June 30th, because TP. Yeah. June 30th is end of quarter, end of month. Okay.
And rebalancing and adjusting and all that stuff.
So what TP is saying is, I'm going to go to, and it's usually round numbers. So take a look at this one. This is actually a good example, and I'm glad you brought this up. So if you go to the 7,400 in the 30-day, you can see that the open interest is 4,000 and the volume is 33. So it's completely flipped with the regular options versus the zero options. And what TP might say is that it could pin these round numbers. numbers. You can see it at 45, 7,500, and then I'm going to go all the way up to 7,500. There's 9,000. These round numbers sometimes have the volume that's traded in it.
And now, when I'm looking at open interest, typically I'm seeing some, in the tens or the multiple tens, like 20,000, 40,000, 60,000 open interest on the SPX. That's what kind of gets my attention. But the other thing this points out too, Liz, is how simple people are with their trading. Yeah. They like round numbers.
Hey, I like round numbers. I'm a simpleton. Lord, what am I called? Lord Humongous. Large Lord. Hey, listen, I'm a simpleton. I love round numbers. And whenever I'm doing something, I try to keep it simple with the round numbers, easy math, as simple as I can. I'm one of the simpletons. Okay, PP, how have you been doing? Because I know I have to give you the W today. I texted you last night on the close, being like,
"Oh yeah."
I said we were going to end up, and boy, was I wrong.
Yeah, we get clobbered yesterday. Well, all right. So I sold a further out of the money put spread.
Than me, way further out of the money.
Yeah, it was a winning trade and I held on to it and was like, okay, I can handle the risk. I can take this, whatever. I don't want to lose money. And what do you know? They stopped being down 112 points the SPX. So I just kept the profits. It had nothing to do with me being a great trader. That's not what it is. It is simply the strategy. That's all it is.
Well, but I will tell you, I think this is worth kind of a discussion. So my trade, different strikes, but I literally went to the expected move and sold something like this. Okay, so this is a very Liz trade. I do this with my kids too. My kids have they'll narrow it a little bit, but so this is. I thought conservative, and it wasn't. So this blew through our trades, but because we were taking very little drawdown, it's kind of 6 of one, half dozen of another. Versus you, who went down. I'm gonna make this up, but weren't you?
I'd go down even further. Go down to go down to 7180s. So I'll sell the 7180s.
Okay.
Buy, let's say 25 points out, so 65. So it's gonna be 55. And I'll buy that and I'll sell that for $1. And I'll do a little bit of size in there. But the point is, if I am right, to me, Liz, it all comes down to the return on capital.
Right.
That's all it is.
And in a day, $1 on putting up $2,400, that return on capital isn't bad if it's daily.
It's what? if I'm right, 4%? What? In a day? Okay. Yeah. And I'm not saying, this is the whole point, is yes, I have losing days on this trade. And sometimes I close out before, at 50% profit, all that stuff. That is what I typically do, especially if I'm putting these on in any kind of size. I just take the risk off, take my profit as it comes, take the risk off, and go back to trading something else. But the point is, the return on capital on this stuff is very, very high. You can do narrower spreads, you can do closer, further away, whichever is comfortable for you. And this is each trader's choice. There's no best, there's no, TP does this and Liz does that. Neither of us is correct, right? We choose what we think is going to work for us, but the return on capital is high. You know what I do want to look at, Liz?
Talk to me.
Is go back to that active trader, the active options thing.
Got it. I'm going to refresh and see if we got any more too. So I'll refresh this.
What's going on with so this is all options. What's Pfizer?
PFE. So when it's got a 2 in front of it, these are different in there because I don't think we can, let's take a look. Let's take a look at Pfizer. PFE, July 17th, it's the strike price.
The 28.5 call.
So that's today's. A week out. So a week out, 20.5 call. Okay. So PFE. 1 week out, 28.5 call. Yeah, take a look at that.
Holy smokes.
Yeah. No, but the open interest on this is high. So the open interest on this is high. It might be closing orders.
Yeah. Pfizer.
Sometimes when I look at these, because this is the SIBO's most active, it's a little bit different when you have the 2 or the numbers in front of it. And I haven't quite cracked that code yet.
So the other thing too, I know BTDR, BitD or whatever the heck it is closing only on the Tasty platform. So it's all of this stuff. And what's interesting that you look at this stuff, Liz, and I look at the most actives too, it is one piece of the puzzle, right? There's no like, oh, well, Tom Preston only looks at volatility probably. Yeah, okay, I do, to determine what the strategy is. But to get an idea, right? To get an idea, like yesterday in the cherry bomb, I talked about selling a put in Chipotle. Do I know anything about Chipotle? No. But I know the volatility is high. I know that the market was down and the restaurant stocks were up. Okay. So let's sell a put in Chipotle.
Okay, a guy from Texas, we have to call a spade a spade. A guy from Texas who's got better barbecue and better tacos.
Okay. I don't eat a Chipotle. I don't eat Chipotle, Lord Humongous. Okay. Okay. I don't actually darken the door, but the point is it's just another symbol. It's just another trade. So I'll look at this to prime the pump. Okay, who's trading what? Because I'm always looking for a new symbol, and then I go through the process.
Yeah, I agree with you. You can find it's just an idea generating, just like we had Chris on, and Chris is a great macro economist. But I don't follow trends or look at the macro economy or things.
Everybody already knows that.
Right.
All that is priced in. Yeah. And what I need is a high number of occurrences to get the probabilities to work out. So if I have 80 positions on, I'm looking for my 81st.
Yes.
Looking for my 82nd. Because what I want, and you say, well, Tom, you're over trading, but no, it's not over trading. It's not day trading. That's not my point. It's yet another symbol to build the high probability portfolio.
Do you think that I know you're building this, but I love that you said you don't eat at Chipotle, right? But you noticed something that you noticed an anomaly that was happening where the market was down and the restaurants were up. Let me pick a restaurant. Let's take a look at it.
Yeah. And, I remember I was actually talking to Chris on the last call last week, and I brought up, what was it? Kava or whatever it was.
Oh, Kava. My daughter said I got to go there. Is it good?
Yeah. And I asked, and Laura knew what it was. I had no idea what Kava was.
So it's a Chipotle, but for Mediterranean, correct?
Okay. I'll ask Laura, because poor Laura, we're so old. Anyway.
Well, speaking of old, TP. Okay. I've been teasing Jermal all morning.
What's the matter with Jermal?
He's turning 50 tomorrow, the big 5-0. Now, I'm turning 50 in November, so I've been teasing him that we're going to be generations apart. And so we've been going with this.
All right, I got to say, Jermal, it's either moisturizer or good genes or whatever, but Jermal doesn't look 50. When I was a kid, 50 years old, you were creeping around.
You were creeping around. We were talking about this. You were saying you were creeping around. So this is what I did. TP. I Googled this in the Golden Girls. So Blanche, this is what they looked like back then. This is what was a 50. She was 51 in the show.
Yeah. The world has changed. SPX options have tightened up.
Yes, the world has changed.
Nobody cares about the central banks anymore. And Jermal's going to be 90 and he's going to look like he's 17.
And that SOB, can I say that on air? Well, I just did, so nobody can stop me. He doesn't even have to do his hair. He comes in and probably just polishes it.
Because he's bald. Isn't he bald? He doesn't have it. In other words, I have a whole team working on me. Okay. I have a whole team doing the hair and makeup, everything. Because I'm big by big, right?
You are big by big. Great. So what else is going on in Cherry? Did you ever do any of the stocks that are going to go into the IPO?
No. Okay, here's the story about Kava. So I was talking to Chris last week, and I just brought up Kava on the last call. He says, "What do you know about Kava?" Nothing. He said, "Why are you trading it?" I don't care. I just need another symbol.
Yeah.
Okay. I don't care. I don't know what they do. I don't care what they do.
No, but TP, that's because you're a true trader. So you're a trader through and through. And I think it's very jarring when that is said, because I've gotten blowback on that before too, where I don't know what a product is, and that doesn't bother me. I'm going to go through and be like, is it liquid? Let's see how many people have traded. My trade check, is it liquid? Are there options? Is it cost effective? And what is the IV? That's it.
Because you and I don't get paid to know about companies.
No.
We don't get paid to read the news. We don't get paid. The only reason I put in a context in the cherry bomb, when I write the cherry bombs, I put in a rationale. I'll look at the news for something because it's a talking point. It's context. Right. But I don't base a trade on, gee, the analysts say this or the CEO says that. I don't know.
Like I said,
I don't know,
because you're a true trader.
It's just how much can I get for selling the stupid put? What's the return on capital? That's it. What's the probability? That's it.
What's the probability? That's it. So did you not jump into the stocks for the SpaceX IPO that we were talking about? So like Google has a hand in it, and that NAS.
Yeah, so I did a video on it yesterday talking about selling a put spread in Google as a for SpaceX. And so this is the argument about the whole sort of circular firing squad in the AI industry. So, NVIDIA invests in data centers and Microsoft invests in NVIDIA, blah, 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 all that crap, right? Google owns about, 7%, 6% of SpaceX?
6%, I think, yeah.
So what's Google doing? Yeah, it's down $9 right now. I might sell a put spread in there. The volatility, 47%. I'd open up the Julys. I don't want to trade through earnings. I'd open up the 36 DTEs. Let's go down to, let's try the 35.30. Buy the 30, sell the 35s.
Yeah, just
see what I get, $1.50.
Yeah, these are simple trades that you can make a play in, just kind of saying you're bouncing off the SpaceX IPO. But 14 million shares have traded. It's got a 47 IVR, so why not?
Yeah, and I only need $350 of buying power to put the trade on.
Yeah, not bad.
All right,
we are out of time. You and I could talk for hours and hours and hours and hours, but we are out of time. But I think I get to see you again tomorrow. So
tomorrow's Flame Shirt Friday.
Flame Shirt Friday. Can't wait. All right, everybody stay tuned. I believe Gus and Errol are next. Is that right, Laura? Just Errol? Okay, wonderful. Everybody stay tuned and happy trading. We'll see you tomorrow.
Let's make this quick. I got to get going. I make $4.97 every second that I work, and if I don't clear $145,000 by the end of the day, I'm going to go crazy.
Okay.
It's a cute dress. Where'd you get it?
Oh, thank you. H&M.
$23, 10% off sale.
That's pretty good.
Probably not worth more than $4 now. That's too bad. You got to be aware of these things. Everything has value.
Well, not everything has value.
Everything has value.
I am pretty sure I can name a couple of things that don't have value.
Go ahead, go for it.
Okay, caution.
5 cents.
Feebleness.
That's a sad one. $1.12.
I have a toughie for you.
All right.
What about us?
Me and you?
Yeah, did we have a price?
Yeah. 2 cents. We should have sold that one a long time ago.
2 cents?
Yeah, we could have made a lot of money on that one. Oops.
2 cents? I wouldn't even pick that up off the street.
Exactly. I think that's more on you than it is on me. Lord knows I'm trying. Hey, you know what, though? There's money to be made everywhere. Take you, for instance. Look at you. You're a young buck. What are you, like 37? I'm joking. How old are you?
I'm 26.
With your genetic makeup, you're not putting on too much weight. I think you could sell those little lady eggs of yours and make quite a profit online. But I wouldn't wait too long. Next month, those would go down big time, especially if you keep eating the way you're eating. I gotta take off. Time is money.
Are you serious?
Yeah. Hey, look. Can you get the check on this? I left my wallet in the car. I don't like to carry around bulky things. It slows me down.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
It's time to trade smart, post PDT rule elimination. Now, traders of all account sizes have more flexibility than ever before. With rapid order entry and bracket orders that let traders manage entry, profit target, and stop loss, all in one ticket. Tasty Trade.
What is going on, everybody, and welcome back to Risk and Reward. Today's Thursday, just a day before SpaceX IPO, going to be one of the largest IPOs in history, so we're excited for it. Before we get into everything, what's going on, brother Gus? How are we doing today?
Doing good. I'm chuckling looking at the broadcast here because you got the shorter chair today. Jermal was complaining about having to sit next to me in the slightly shorter chair yesterday, and I think we have the same thing going on today. I'm a little taller than Errol, but I am not actually this much taller than Errol. How the perspective is making it look right now. But no, I'm a happy camper. I'm very happy that I jumped into Rocket Lab yesterday when I did. I actually put a lot of thought into deciding exactly which space company I was going to attack and who I thought would see the most benefit. But as it turns out, you really couldn't have been wrong. Intuitive Machines, Redwire, Rocket Lab, ASTS, Planet Lab, all up today. So made a good move there, and we're already
There's a lot of hype heading up into SpaceX IPO tomorrow.
Yeah, absolutely. And it just seems, I guess I was just one day ahead of the broader steam coming into these space stocks. So yeah, happy to have caught that when I did. And yeah, just looking forward to the IPO tomorrow. Obviously, the main catalyst of the week.
100%. I know SpaceX dropping tomorrow. I know they're not going to be releasing the options until potentially next week, Tuesday. So you've been taking a little bit more exposure, at least to the industry, using some of those other names like Rocket Lab and whatnot. So nice to catch a wind of volatility there for sure.
Yeah, absolutely. And as I've said before, I do think it'll move up pretty quick off the IPO. But yeah, I don't really want to get involved right at IPO, and you got to go full shares. Yeah. Liquidity is all weird. It's tough to get
a lot of uncertainty for sure.
Yeah, it's tough to get involved right when these companies IPO. So I'm content to just take the exposure where I'm able to find it with good liquidity in the options market, and then into next week, perhaps I'll look to attack some SpaceX options.
Yeah, looking forward to it. Really looking forward to tomorrow. We'll see how the volatility kicks into the market. As for the overall market, VIX is finally above 20 right now. We're trading at about a 21.92 on volatility. And I mean, I'm excited about it. I know we've seen a little bit of a pop coming into this morning that we kind of been selling off again, but I like how things are getting a little bit back to normal in terms of volatility in the directional market that we've seen in ES and NASDAQ. And another thing that's been kind of brushed under the rug in terms of volatility is, have you taken a look at some of these metal products like silver and gold?
I haven't paid attention to the metals at all, but yeah, that's quite the slide.
Yeah, I remember you had some short delta on a few months ago in that silver product, and we're finally making new lows. So the Bitcoin chart, some of the metals, oil, a lot of these charts are looking very similar, but oil definitely making some new lows on the day. And last night we traded a little bit of oil. It was nice. We were able to scoop up a couple $100. At that same time, sometimes I'll sit there and I'll do some journaling for the trades. And as I'm journaling, I'll recognize a potential opportunity. And that's typically when I'll take a trade outside of normal market hours. And then I'd seen another opportunity on NASDAQ, and then I gave back $100. So we netted about $100, but in hindsight, I was like, should have just stuck with the gold. But with that being said, a little bit more opportunity there. And those are some shorter term trades, but maybe we look to get on some out of the money put spreads, maybe get a little bit of long delta on. Right now in the metals, I would rather be sitting long than short. And that's how I'm kind of shaping up there. But there's a lot of volatility on a lot of names across the board. I know SpaceX is taking up all the hype, but the opportunities are there.
Yeah, and I mean, as it pertains to the broader macro environment, the metals just continue to make no sense. I mean, it feels like it's been, well over 6 months now since the metals have made sense to me. But in times of inflationary concerns, you would think that people would rotate into metals. Yeah. That's what's supposed to happen. And inflation was one of the headlines that we saw yesterday. Concerns circulating around that, and the metals just stayed down. I mean, SLV up a little tick today, but nothing considerable. And yeah, obviously way down off the highs and slid yesterday. So yeah, interesting juxtaposition happening there with the metals just. Yeah, no, like I said, for the last 9 months, the metals have not behaved the way that you would expect metals to in any sense of the word.
Not at all, because to your point, on the contrary, as inflation was going lower, we were straight ripping, to the upside, continuously putting in new highs in silver, platinum, copper, and especially gold. And now that we're looking that inflation seems to not be going away as we thought it would, the metals are making newer lows today. So yeah, that doesn't make too much sense. A little bit of a disconnect there.
Yeah, and I mean, definitely sheds light. There was lots of lots of discussion about how at the peak of the metals run, physical metals had become rather illiquid. Silver was at 110 an ounce, and people are saying, "Oh, I went to the bullion shop today, and they offered me 80 an ounce. Like, this is criminal."
Right.
But this just sheds light on why the physical metals buyers understand that they can't actually pay market price when things get that elevated. Because all of a sudden, even if they were paying 80 when it was at 110, now they're stuck holding the bag at 57.
Yeah.
And, what are you supposed to do?
That's a really good point. Not too much going on my end, and then I'm curious to see what you got going on as well. QQQ, so far, this position's been working out decently well. We have a little bit more time on there, a little bit of short delta. We had sold an out-of-the-money call spread. We have about 36 days left till expiration, so we're not going to do too much in here. We're down a little bit on the day because of that initial rally we've seen this morning. And I think it's going to be a little bit. It's a little bit of a waiting game right now. It feels with the broader market and the SpaceX IPO coming towards this end of week, and it'll be nice to get a little bit more clarity because this is one of the first times we've truly seen a change in behavior or even sentiment, however you want to put it, in these indexes that we've been looking at from last Friday when we had that 1,200 point sell off. So I mean, after ripping about 6,000 points to the upside, it's definitely fitting to get a little bit of a pullback, a little bit of consolidation. But it'll be interesting to see if we head lower from here, or if maybe we rebound back to the highs.
That works.
Rebound back to the highs. That works too.
Yeah, reback bound.
Speaking of
rebound putback, OG
rebound
Nobi.
This man read my mind. Took it right off of my lips. That's exactly what I was thinking of. How do you feel about that game last night?
Yeah, that was insanity.
Yeah, I mean, how do you give up? I didn't get to watch the entire game, and not to go too far off course. How do you give back 30 points? What broke down with it?
The shooting just fell apart. I mean, they were shooting unsustainable well in the first half, but you didn't expect it to come apart the way that it did. But
it was record 3-pointers in the first half, right?
Yeah,
14 or something.
I mean, it was largest halftime lead in NBA Finals history. And then, all of a sudden, I mean, the Knicks had to go on a 50-20 run. Is ultimately what wound up happening. And
I mean, you can play good offense, but where's the breakdown? How do you allow that to happen? So I didn't get to watch the game, but just seeing the highlights, I was caught off guard.
Yeah, it was incredible, and just the whole. I think it was really poor management. I mean, Mitch Johnson could definitely take some blame. The shooting was bad, but the game management could have been better as well. But congratulations to the Knicks. If you're a Knicks fan out there,
shout out to the Knicks.
Insane game, and I see it as a virtual impossibility that the Spurs are able to pull this off.
That's nuts. That's nuts.
After that type of blow.
We'll circle back around to it. I don't know. Maybe they're going to have to put in another historic record by coming back down 3-1 in the NBA Finals after blowing a 30-point lead in game. What was that? Game 4 or 5?
Yeah, game 4.
Game 4. So with that being said, we'll see how the Knicks affect this market here. We'll see how SpaceX affects this market as well. But
and I think that's an interesting point that you draw with how SpaceX will affect the market, because there's been lots of discussion and from me as well about how the SpaceX IPO will affect Tesla.
Right.
I think that's an interesting conversation in itself. But I think that some of the principles that you talk about with how it may affect Tesla could be applied to the rest of the broader market as well, because obviously this isn't an instant inclusion in the S&P 500. I'm sure that probably will happen quickly, but they're not going to move on that immediately.
Yeah.
And furthermore, the question really becomes, are people going to put a bunch of new money into the market to buy SpaceX, or are they going to reposition out of other things? Because if the substitution effect comes into play, there's a chance that SpaceX could have this parabolic IPO and it just doesn't quite drag the rest of the market up, to those, I mean, not to the same extent, but up along with it, if the rotation just comes out of other companies. What a world would it be if all of a sudden, if SpaceX is up, 70% tomorrow and the S&P 500 is down a tick?
That'd be insane. I'd be like, okay, everybody definitely rolled out of the S&P 500 and rolled some dough into.
Yeah, and I don't know that's. I mean, I would say that there's a non-negligible chance of that. I don't know that I think that that's a likely outcome, but it's an interesting question of where will that money come from?
Yeah.
What type of impact will it have on the broader market? Hello to all of our friends in chat. What's
going on, guys?
Mr. Pillows, Stan, Ranch, Ace Ventura. Good to see all of you. The pet detective himself in our chat right now. But it's and it's just I'm just excited to see what happens.
I'm excited too.
And as I've said, I think I'm more excited to try to short SpaceX at the top, and I might get burned on that. I mean, like I said yesterday, I tried to short SanDisk at 800 and 900 and 1,000, and it just kept going. So
I will say this market environment is really unique, though.
It is.
It's not every year. It's not every decade. We even have names like Intel, AMD, Nvidia, Micron, SNDK, like you just mentioned. It's not every year we have multiple names putting in record numbers on a continuous basis. So, I mean, I would say it's not even a normal market environment, but I think the volatility is definitely good to take advantage of.
Yeah, I've talked about this plan over and over for months and months too, but I would like to acknowledge as well that like I'm not married to it. I mean, SpaceX has to do some crazy things to the upside for me to want to get short. If it moves
100%.
If it moves remotely responsibly, and I mean by that I mean anything inside like I don't know. I mean really 30%. I'm not going to be looking to short that. It's going to take like it has to be up. I don't know, north of 100% is like where I would start to get excited, where I would start to feel like there's no way that this price can hold.
Right.
Because I do think that hype could drive it up a considerable amount and hold it there.
And my kind of thing is, especially around the sentiment of SpaceX, I've been curious, what is the rush for getting into SpaceX? Like, this is something that's crossed my mind a couple of times over the last week or two. Like, what is the rush? Like, even if you miss the initial hype, if you're somebody that's trading, maybe you want to take advantage of that volatility, but like, what is the rush in getting inside SpaceX? Because it's very common. We see IPOs or just any underlying for that matter have a significant pullback or just any normal pullback. So why not just wait for the pullback, get long if it's something you're going to hold long term? I was just never, I was a little bit curious about what the hype is in terms of trying to get in instantly or right away.
Yeah, I think that's
speculation.
I think that's incredibly well put, and it lends itself to the point that I've made a few times over the last few days, which is that this is not pre-split Tesla at $17. This is not Apple IPO at $10 before all these splits, because it's coming in at 1.75 trillion already. If you want to have orders and orders of magnitude of growth, and I mean to the tone of 50x, of 100x, you have to be getting in on the ground floor of a company that nobody is really counting on in that way. Yeah, everybody is counting on SpaceX in that way. Potentially, like I said, I mean, if SpaceX goes to 10 trillion, there might be a 5x there for you in the next decade. Like that could be possible. But this is not this is not the ground floor, something that's going to 1000x.
Yeah,
it's we're talking about a $250 company. That's literally what it would take to 1000x for you. So it's just you have to keep all that in check. And I think that you make a great point of there might not be any giant rush to try to get in right at IPO. To FOMO trade into it at $200.
Maybe I'm wrong. Maybe it goes to 300.
Sure.
And that's the low for the next 5 years. And I'm like, bro, we never got the discounted price we wanted, but I'm willing to take that bet.
Yes. Yeah, I'm inclined to agree.
But no, before we get going here, I know there's some long delta we might try and throw on in gold. I think we're going to utilize GLD. I know there's GOLD that we could get into, but we're going to use gold, look at some of these options prices, and maybe just get on a little bit of long delta, nothing too aggressive. Maybe your textbook out of the money put spread that we'd sell, $5 wide, collect $3 of the width, and call it a day on there. But I think the given sell-off we've seen in the metals is definitely warranted a little bit of long delta, especially given that inflation isn't even nearly where we really want it right now too. So maybe even capitalizing off a pop of that. But the market's not making too much sense. So we'll get on what we can.
Yeah, definitely agree with you there. I like the idea. I saw Mr. Pillows in chat say my SLV short put is way in the money. I don't know what to do with it anymore. How in the money are we talking? What's way? I'm curious. But yeah, to always.
What are you working with?
That's the danger of the naked short puts. Is it's easy to get caught holding the bag, but boy, is it glorious when you don't.
Absolutely. You telling me? No, looking at the put side over here, looking at 36 days to expiration. The July 17th cycle in GLD, looking at selling the 370s, maybe buying the 365s. I know that's a little bit aggressive on the deltas. That's a 43 delta that we're selling there. But we can collect a third. We can collect about $1.69 right now. $1.66 is where we don't really want to go under. And I just see that this mid price just jumped up to $1.77. So we can see that the markets aren't super tight, but I think they're tight enough for us to get on a decently structured risk to reward out of the money put spread that we can sell here. So I think I'm comfortable with this. Earlier today, I did look at the zebras. It was a little expensive. It took about $3,000 to $4,000 worth of buying power to put on a long zebra. I don't know if we really want to lock up that much capital in an underlying that we're not fully convicted in, just because I do think there's a little bit more air that can come out of some of these metals. But again, just for more of a shorter term move, given the aggression of the sell-off in the metals, it'll be nice to get a little bit of long delta on just for the short term. Maybe 7 days, maybe 14 days, we get a little bit of a pop, take it off, roll that into a different trade. So that's what we're going to be looking for right here.
Yeah, I definitely agree with that thesis. I'm deciding how I want to attack it. I'm going to go SLV as the product. Just kind of more comfortable with SLV for reasons I can't really quantify. I don't know. It's just I just prefer it to GLD. It's always kind of been that way.
Yeah.
I'm having two schools of thought here. One is like exactly the thesis that you just outlined. could this just be the bottom for the next month? We're starting to see a little bit of green come through here, and is it worth just attacking the monthlies, slightly out of the money the way that you're choosing to here? But then I have another school of thought going that's like, well, do I go into the end of the year? Like, do I give this a lot of time? But I don't know. I mean, if you really zoom out, and again, I mean, I say this pretty much every time we talk about the metals, but we're at 57, and before the insane, I'm talking SLV here, is at 57. Before we started the insane run to 110 late summer last year, we were at mid 30s. So in a macro context for silver, we're still very elevated. I mean, we're still 50% above those pre-run levels. So at the same time, it's like, is the end of the year even a realistic time horizon, or could it come down because we would still be elevated above those previous levels?
That's a really great perspective you bring up, because as we just zoomed out over here, it's almost laughable, right? And I mean, it is interesting. I do think there's a little bit more air to come out of some of these metals, but I do also think we're on the backside of the move. Like, I do believe that the top was put in. So regardless of what kind of run we have to the upside, I think we will continuously see new lows until we get repriced to where some of these products should be at. So that kind of even goes against my thesis a little bit there too, right? I'm over here getting long, but I'm saying that I do believe the top is in. But again, given the aggression of the recent stalls, it'd be nice to capitalize on that. But it's a great point. Something you got to keep in mind. Like Gus said, we were trading at 44. I mean, the high before the breakout was trading at around 48, and the low off of that was 40. So we've never seen this kind of volatility in silver in quite some time.
Yeah, and I mean, and $9 on 48 is like 18%.
Yeah, it is.
It's a
percentage-wise, right? It's even crazier.
Especially for a metals product. It's like these things aren't supposed to have that type of growth. So, I think all of this, I've led myself to just doing the same expiration cycle as you. I'm going to go right at the money. I'm going to play the 56.5, 57.5, 36 DTE, July 17th.
Never would have thought we'd have fun trading some of the metals. I never would have thought these would be the commodities in the metals that we would be continuously trading with.
It's funny.
Handful of opportunity.
People are always like, "Oh, I'm getting older. I'm so excited about my new vacuum."
Yeah.
That's how I feel about this. Like, I got long bonds, long silver in my portfolio right now. And I'm like, I love these positions.
I seen a couple gray hairs pop in my head. I'm like, that's pretty fitting with trading some of the bonds there. Speaking of bonds, curious to see where these been at. Let's check out TLT. Are you still in that bond position? I know it went really. Are you? There we go.
We've
still been rallying a little bit there.
We hilariously bottom ticked.
We did bottom tick.
I mean, like
13th of March. Let's go to it. Let's see.
Yeah.
No, it was the 19th of May.
Yeah.
I got my times warped.
Yeah, May 19th.
May 9th. We did bottom.
I mean,
bottom ticking the bonds. That's the new product we're going to be getting into.
Could not have bottom ticked any better. It's a good thing we did, because there really has been not a considerable move to the upside on bonds, but we caught it so perfectly that I have an 84.85 short put vertical here, which was just slightly in the money at the time that I put it on. We've moved just through that 85 level, and we've been holding there. Occasional dip back below 85, but feeling pretty confident about this.
That's hilarious.
Bonds obviously not a traditionally volatile product. So, I'm feeling okay. I have 36 days left on these, but we
did bought that off the momentum to the downside in bonds. Bonds.
I mean, this is like legit a top 5 bottom tick that I've ever had. I mean, we caught like the bottom.
I am a little bit jealous, I will say, because after this third day, that aggression on the first 2 days, and then we gapped up. We tried to pull back a little bit, and then we closed at a new day high. After that, I was like, I got to get out of this zebra. You know what I mean? Because it happened so quickly. So I do wish I had a little bit of long delta still sitting in there. And in our lost friend Rivian, how's Rivian been? I know Rivian, that was near another bottom tick. It's looking, it's Rivian.
Rivian stuff.
It's Rivian stuff right there.
It's doing Rivian stuff. Yes, I do still have on. I put on those shorts against my deeply long Rivian position.
Yeah.
Those are 7 days to expiration. I have a short call spread at 19.5, 19. So need it to stay under 19 until next week.
There we go.
Thursday next week. I feel fine about that at this time. Rivian is scary. If there's a company that can go from 15 to 19 in 7 days, I mean. One day.
This company doesn't consolidate.
Yes.
It just goes up and then it just goes down.
It's just in this channel all the time. So perhaps I wasn't aggressive enough with my time horizon on those. We'll see. I'm going to continue holding that up. Well, I don't know. It's such a weird one. I'm going to I will trim half of this actually, because these were super cheap and I have 10 of them. So if I'm presented with the opportunity to scale out, it feels like it would be irresponsible to not. So I'll give that a shot. We'll take off half at half profit. That feels fair to me.
Yeah. This is definitely the underlying to be managing your trade in momentum, whether that's to the upside or downside. because I know on a larger time frame, we're kind of trading within that channel there. But man, when we look at some of these highs and when we look at some of these lows, I mean, we put in a distinct low, and then we're pretty much rallying in the opposing direction on both ends of the spectrum there. So not much time to make too many decisions really on a product like this. I mean, it's a momentum one.
Oh yeah,
within its channel.
It just moves so quick, but man, the channel. I've been screaming from the rooftops about this. The Rivian channel for the last 3 months now, and here we go again.
Yeah.
Goes up perfectly. I mean, it's every time goes up. Test 18, test 19, rejects, comes down. Test 14, test 13, goes up. It's hilarious, and I wish I would have jumped on it sooner, but I am happy that I caught the short side of this one against all my longs. What's going on, Grumpy Mike? Good to see you. Mr. Pillows, the SLV short puts are at 68. Yikes. Yeah, I agree with E-Media's sentiment. Might as well just take the shares and hope for the best at this point.
What was that one on
provided that you
SpaceX?
can tolerate that with your buying power, huh?
What was that, SpaceX?
SLV.
Oh, SLV.
Yeah, the short puts we were talking about earlier.
Gotcha.
Mr. Pillows follows that up with, I'm debating if I should upgrade my Robo Vacuum to one of the ones that also mops. I will say, Mr. Pillows, yes. I have one of the ones that also mops.
Oh,
and I
really?
love it. Yeah.
Oh, wow.
I actually have two. I have a mop one and a vacuum one.
Yeah.
If you could get an all-in-one, that would make more sense, but I figured out it was cheaper to chop it. Also, the vacuum one was a gift.
So these things really, they roll around your floor.
Yeah.
Is it set on a specific time? Do you get to set the time that it does? Is it just...
No, it'll run on its own, but you
Okay.
can, it goes around without mopping and maps your whole place first.
Okay.
And then you have like a map in the app, and then you can like select specific areas and say mop this. That's like how I keep it off my rugs and stuff, because the mop.
Oh, right.
It would mess stuff up. But yeah, for the kitchen, the hardwood areas, it's nice.
In-person word of mouth, especially when it comes down to in-person reviews from somebody you know, is very powerful. Because now I'm actually interested in that, because I always saw it always kind of seemed a little bit kind of gimmicky to me. And now that I've heard 2 positive responses from that, I might have to check it out.
Yeah, the mop ones, I hear they're a little more finicky. I got lucky with mine. The brand escapes me right now. I have a Eufy vacuum one. I like it okay. There are nicer ones out there, but it's good for the budget. But yeah, they're I recommend. We have the robots, guys. We're living in the future. Let's use them.
Just like Terminator.
Yeah. VIX, interesting spot here. We are down on the day, but creeping back up as the market comes down a little bit. I started to say at the open today, to myself that, man, the VIX just really can't manage to stay elevated in this environment. It's so strange to me, but we are creeping back up a little bit there.
We're trying to.
But yeah, it's just, and I mean, VIX, it never stays super elevated for long, but it looked this morning like we were all of a sudden just going to reject straight back to 18 or something. And I was going to say, wow, it
is. And I mean,
VIX has just been an interesting topic in general over the past, a few months, and as we were running up, and all of a sudden we started to see those little increases in VIX to the upside, which I'm complainer number one that VIX doesn't move more when we're going up like that. So I was happy to see those come through. Yeah, it's an interesting spot, and I mean, long-time viewers of the show know I love to get short VIX anytime it gets over 25 and just wait, and that's been a pretty profitable strategy for me. In the long run, but just not really presenting an opportunity for me to do that.
No, I hear you. I do think if we end up making lower lows, especially in something like QQQ, the indices, S&P 500, these kind of things, which I think it's very warranted. I don't know if this was going to be the bottom over here on Tuesday, but if we do happen to take out Tuesday's low and we make lower lows, I could imagine that VIX is going to have a great opportunity of spiking above, Tuesday's high on volatility, which was sitting at 23.22. So I think that if we continue to make newer lows, we could see it in an aggressive fashion. We could get more momentum to the downside, just because, again, it does feel that the overall index was sitting on the top of a hill, just given how much these things have rallied in such a short amount of time. So if we ever get any type of shakeup like that, I mean, I'm sure you're going to have so many opportunities to sell some premium at 24, 25, 26, 27. I mean, if we get up there, hypothetically, if we were to take out Tuesday's low and if the bottom is really in, but we'll see what we get.
I'll do it blindly.
Yeah, absolutely. Yeah.
You know me, VIX.
I mean,
VIX over 25, I'm closing my eyes and
volatility.
Take my money.
Yeah, that is one nice. I mean, volatility is mean reverting. The data does support that. The data doesn't support that price is mean reverting, but it does support that volatility is mean reverting. So.
Yeah, the only time I have not done this was during the Iran situation and that whole run up, and you can see it clearly on the chart here. Early February through the end of March, this whole thing, it was like unclear whether that whole situation was going to end. We kept getting fake out headline after fake out headline, and it made it really tough to time. So I did decide to sit on the sidelines for that one. This, to me, this downward action that we're seeing now feels much more temporary. Like this is just the market breathing a little bit, taking a healthy dip before we push a little bit higher. We've seen over and over that the bears just can't.
Well, my question
really
would be
seem to force it down intraday. The bulls always come through and wind up saving it a little bit. So this I would be much more comfortable if VIX jumps over 25. Just hopping in here.
No, it is a great point. I mean, especially the aggression of the sell-off. I know even March of 2020. Not that this is even a crash by any means. I don't even mean to compare it to the crash of 2020, but a lot of times those bottoms are put in on very sharp moves to the downside. So again, we will see what we get. But I'm curious, what is the normal pullback in something like QQQ, considering, we rally from March 30th, we're trading at 574, trading at 701. I mean, you could argue that a healthy pullback is 640.
Yeah.
You could argue, because I mean, we're still going to be up on the year, even if we get a pullback of that extent. But I mean, I'm not hoping that the market gets taken to the woodshed, but definitely always prepared for any opportunity the market does present.
Yeah, and I've been getting at the same thing on SPX throughout this entire run. It's like, if all of a sudden SPX is back at 7,100, everybody's going to act like the sky is falling, when the reality is that we spent 6 months saying, please go over 7,000, and it just never would. And so then, all of a sudden we get this giant run, and everybody expects 7,500 to be the new normal, but there's no such thing as infinite growth. The market must breathe. It's a healthy thing to happen. I'm not alarmed until we are below previous all-time highs of 7,000 like we have to get below 7K for me to really start feeling like we could throw around the C word.
No, I hear you. That's a great point you make there. And I mean, especially with SpaceX finally IPOing. I mean, it's been SpaceX headlines for the last 30 days. I know this month we're only like a week and a half into this month, but it's been everything about SpaceX IPO. I'm really curious to see how it affects the overall market and how investors behave, once that does happen. So market feels like it's sitting on a teeter saw right now, but we'll see what we get.
As am I, and I'm probably going to wind up with a play on Tesla by the end of the day here as well, and kind of in tandem with my Rocket Lab play. So I'll decide what direction I'm leaning short at this time. I will post it in the follow feed, whatever I land on. But that's awesome. That's kind of my closing thought here.
Cool. I guess that's not going to be anything else top of mind for today. We'll see how SpaceX really pans out. And then lastly, I think it's a really good point that you bring up. I'm curious to see how Tesla kind of behaves around those, because it is kind of trading on Elon a little bit there, or they want to even make those pay packages in the first place. So anyways, with that being said, guys, we appreciate you taking your time to hang out with us today. We will be back here with some of the SpaceX IPOs. We'll be watching from a distance. I will at least. Hope everybody else is doing well. Be sure to stay tuned for more coming on next. We'll catch you guys next time. Peace.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at tastylive, joined by who I think is perhaps only our second repeat guest here on the show. Rick Rule is once again with us. He's the founder and CEO of Rule Investment Media. Rick, welcome back.
Pleasure to be back with you. Thank you.
Rick, I've saved all kinds of hard questions for you since our last conversation, and I wanted to go right to the dollar and gold, which we explained last time, how it has been that since the beginning of this war in Iran, we've had, of course, an inflation scare, and against that backdrop, interest rates have come up. And so, contrary to what people might have thought, episodically, the dollar is up because there's been a reach for liquidity and higher rates, and gold is down because things have sold it to gain that liquidity and gain exposure to those rates. I want to keep that conversation going. Obviously, this inflation scare is now impacting the broad range of markets. We're seeing it in stocks. We're seeing it in all manner of asset classes. And I wanted to see if, in your mind, this is an input into the larger gold conversation. Obviously, people have looked at gold as something of a value hedge against fiat currencies being hampered by tremendous levels of debt across most large governments, not just the U.S., certainly, and not just Europe, certainly. And so I wonder if this kind of inflation, in your mind, in that it inflates the debt away to some extent, if that hurts the long-term case or changes the long-term case in any way for gold and precious metals and kind of physical value as a counter to fiat in general?
I think a study of history would suggest that fear of the decline, or in certain cases the decimation, of purchasing power held in fiat instruments has been responsible for most gold moves over the last 1,000 years. People attribute all kinds of attributes to gold. What one finds is that, as an example, other forms of fear, war, political unrest, things like that, have a near-term impact on gold, but they seem to have a negligible long-term impact on gold, except sometimes for participants like refugees, the Jewish community, the Vietnamese community. Those people had a different use for gold. It wasn't speculative, it wasn't investment, it was survival. But for most people, in less dire circumstance, the primary motivation for gold is to shield one's savings from the depreciation in the purchasing power of the currency. It's important to note, as a student of fairly recent history, that is to say my lifetime, that reaction to inflation takes place over longer periods of time. As a very young man, I began to notice and become interested in inflation literally in high school. In 1968, I began reading what are now regarded as Austrian economics or hard money books. And I would suggest to you that although inflation was a topic on people's minds, that the investing public didn't really begin to react to incipient inflation till 1972. In other words, there was a hiatus between the point in time when academics and politicians described inflation and the time that people began to react to it. During that 5-year period, as an example, a hamburger at McDonald's went from 20 cents to $1. By the next year, with the Arab oil embargo, the price of gasoline went from 25 cents to $1. In 1968, 1969, 1970, despite the fact that we were undergoing inflation, investors' expectations of the future were set by their experience in the immediate past. And the 1950s and 1960s have been very good times. People were extremely optimistic. You're probably too young, but your older listeners will remember things like the Nifty 50, which is to say high growth stocks that did extraordinarily well. When your anticipation of the future is set by your experience in the past, and your experience in the past 2 decades is rosy, you don't react to negative stimulus as well. So it took probably 5 years for the population to react to incipient inflation. And I think the same circumstance is happening today. Exactly the same circumstance. We have lived through what I believe is the most benign economic climate in human history in the period 1982 to 2022. People's expectation of the future is set by their experience in the past, by the dips. Believe government inflation numbers like the CPI. If you believe in the CPI and you believe that the destruction of your purchasing power is clipping along at 2.5 or 2.6%, then current interest rates seem very adequate. You know, the 10 years yielding 4.4, you're getting over 100 basis points in real yield if you happen to believe in the CPI. My problem is I don't. I believe that the CPI is better characterized by Mike Maloney as the CP lie. I believe that the deterioration in the purchasing power of the U.S. dollar, marked by the basket of goods and services that I consume, suggests that the destruction of my purchasing power is proceeding along at an 8 or 9 or 10% clip. That presents a very different picture. If you're making 4.4 in a currency that's losing value at, say, 9, you aren't making 4.4. You're losing 4.5. It is when that realization becomes more widespread that gold really performs. Gold is viewed by many people right now, after a 50-year hiatus, as an investment class or a speculative class. I would argue that 1,000 years of human history teaches us that gold is a liquidity class or an insurance class. And right now, people don't feel the need for insurance. My suspicion is, unfortunately, that feeling will change.
Well, I think you make a very clear distinction there, and it echoes what we talked about last time as well, that when we say that the dollar is set to underperform, we're not talking about underperforming against other fiat currencies. No. We're talking about underperformance against hard assets, and fiat currencies as a grouping underperforming against hard assets. And typically that conversation is presented as, oh, well, governments will try to inflate away this debt, but we don't need them to try. We have the inflation here. And so I think the next kind of natural question is, well, gold is having a bit of a hangover here after an incredible rally last year. One thing you've talked about recently that hasn't been caught up in this macro narrative is uranium as another kind of vehicle for sort of expressing a view on physical assets and the kind of value storage that is. Break that down. What's the conversation with uranium?
Well, I need to start by saying in most commodities, the easy money has been made. The easy money occurs when a commodity goes from being hated. It doesn't need to go to being loved. It just needs to go to being unhated. When uranium was at $20 a pound, although it took the industry $40 a pound to make it, so the price had to go up, it was a hated commodity. The move from $20 a pound to $85 a pound means that the easy money in uranium has been made. It also means, however, I think looking forward, that the sure money is in front of us. Why do I say that? Well, for several reasons. The most obvious reasons is that the world needs more power of all kinds. All kinds. Global power demands, global energy demands are set to double by 2050. And we don't have the capacity to produce that much energy. We just don't have that much. Energy will be rationed by price. Nuclear power is extraordinarily reliable baseload power. And importantly, in today's political discussion, it's baseload power that doesn't generate carbon. It isn't the same as burning coal and burning oil. Uranium has, in 5 short years, gone from being a pariah to being a politically correct commodity, which amuses me greatly, frankly. The thing that's really changed with uranium, though, Ilya, was and is the conflict in the Gulf. It has been 50 years since the world cared about energy security. If you dial all the way back to 1973 and the Arab oil embargo, that form of energy insecurity stimulated, as an example, the French to build what is now the 4th largest nuclear fleet in the world. It stimulated the Japanese to build the 3rd largest nuclear fleet in the world. The impetus for that was energy security. Energy security ceased to be a concern for 50 years, but is suddenly a very relevant concern. Uranium is the only fuel on Earth that has enough energy density that the Japanese, as an example, could, if they had sufficient reactor capacity, store enough uranium to power the entire country for 5 years in one uranium storage facility. You can't store that much oil or that much coal or that much natural gas. You can't build that big a battery. The only material that can give energy-short nations, Korea, Japan, China, for that matter, Taiwan, Singapore, energy security is nuclear. The only one. And the big thinkers of the world are beginning to come to understand that. And I think ordinary citizens are beginning to understand it too. That's very important. We are right now producing less uranium than we consume. And 2 things are impacting demand. One is that the Japanese are now speeding up in earnest the restart of the plants that were closed as a consequence of Fukushima. This isn't demand that's going to occur 10 years from now. This is demand that's going to occur 10 months from now. A very different circumstance with regards to pricing. It also is part of a broader trend to nuclear plant construction. Even nations that forswore nuclear, in particular Germany and the United States, are learning that if they are to fund their existing economies, never mind data centers, that they need reliable, inexpensive baseload power, and their voters would prefer that power to be non-carbon generating. I would suggest that the biggest unsung beneficiary, if there is ever beneficiaries of a war, would be uranium with regards to the Gulf conflict. People think of oil, they think of gas, they think of nitrogen, nitrogenous fertilizer, sulfur, helium, all things that move through the Straits of Hormuz. They don't think about the geopolitical attractiveness of a form of energy that gives a country energy security. And there is no other form of energy that gives a country energy security.
Well, I think that's a really important insight here. It's sort of the next step in the conversation where you say, okay, well, today it's a story about a bottleneck. But a year from now, 2 years from now, 3 years from now, there will be some kind of resolution of this bottleneck this way or that, but countries will have learned that they live in a different world now. I think you made the point last time we spoke that the 40 years that were there sort of through the Volcker disinflation almost right up to COVID is a very different period than what we're entering now. Certainly deglobalization and inflation and thinking about kind of the disillusion of U.S. enforced norms would suggest that countries need to start thinking about things like energy security in these kinds of terms. In expressing a view on uranium, because I think, obviously with gold, it's easy. There's any number of ways you can gain exposure, from physical to ETFs to futures. Same thing for silver. What's the vehicle for exposure to uranium in your mind?
There are several. I think for most people, the lowest risk exposure to uranium is to buy something called the Sprott Physical Uranium Trust. Note here conflicts of interest. I'm the largest shareholder of the manager. I'm not an officer. I'm not a director. I'm not an employee. I'm just a beneficiary. The Sprott Physical Uranium Trust is a deposit receipt representing physical ownership of uranium at 4 facilities worldwide. Uranium is one of those commodities that one is well advised not to try to buy and store at home for fairly obvious reasons. So the best form of physical ownership is, in fact, certificated ownership, and by far the most liquid of those vehicles is the Sprott Physical Trust. If someone wants to take a bit of operational risk, I would suggest that the highest quality uranium producer in the world is the Canadian domiciled Cameco, the symbol CCJ on the New York Stock Exchange and the Toronto Stock Exchange for your Canadian listeners. Highly liquid, really a full cycle uranium shop, all the way from producing uranium to enriching uranium to, by now in its engineering group, building uranium mines and processing facilities for others and generating power. The third that people might want to look at is Kazatomprom, which is the largest uranium producer in the world, formerly a large position of mine. I've sold my stock because of middle management defections. Middle management defections that I didn't understand. And I have a hard and fast rule. If there's a risk I don't understand, I sell the stock. There are also a range of uranium speculations, but I'd prefer not to talk to your viewers about those. They require a lot of work to be a responsible holder. And I've found with 50 years of experience that many audiences love the name but aren't prepared to do the work to prepare themselves to own the name. So we're going to leave the speculative ones aside, I think.
And that is perfect. How do you feel about an ETF like URA and sort of ETF type exposure?
For a lot of people, it's probably appropriate. I'm old school. The idea that somebody, including my former employer, Sprott, constructs an index that has probably 50% of the stocks in it being stocks I wouldn't otherwise own. The idea that I have to pay somebody a fee to construct a portfolio that I normally wouldn't own for free is problematic to me. I realize that most of your listeners have lives. They have kids or grandkids. They like to garden. They like to read. They like to do things with their life other than study uranium juniors. And for them, the ETF is probably appropriate, if inelegant.
And there we have it, folks. Rick, I have, of course, 1,000 more questions for you, but we're just going to have you back to get to those. Tell the good folks where they can get more from you.
I'll give them incentive. Anybody who cares what I have to say about natural resources and wants to personalize it, including, by the way, uranium juniors, can go to my website, ruralinvestmentmedia.com. There, if you list the natural resource stocks that you own, I will personally review that portfolio and rank it 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments have any value. Please, as a sidebar, I know yours is a trading community, no crypto, no tech stocks, natural resource stocks only. The other thing I would suggest to your audience is if you care about natural resources, a conference, which I personally believe is the finest natural resource conference on the planet, takes place July 6 through 10. Not surprisingly, it's called the RULE, Natural Resources Investment Symposium. If you go to rulesymposium.com, you can learn more. The physical conference is sold out, but you can, if you wish, attend the conference from the comfort and convenience of your own home via live stream, rulesymposium.com. By the way, ours is the only conference I know of, live or otherwise, that has an unconditional money-back guarantee. If you attend the conference and think for any reason whatsoever, you being the sole judge, that we didn't deliver full value for your money, email me. I'll give you your money back. Nobody else I know in investor education maintains ironclad money-back guarantee. We've done it for 30 years now. I'm delighted to say we've had to refund about 0.1% of the tuitions that we've charged over 30 years, but that guarantee is your guarantee that we're confident our content at rulesymposium.com can make you money.
And there you have it, folks. If that doesn't explain why Rick is here explaining things to us, well, go check that stuff out and you'll find out too. Thank you, Rick.
Always a pleasure, Ilya. Thank you.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at tastylive, joined by a very special guest, founder and CEO of Azuria Capital and the purveyor of pretty charts on social media. Mr. Tavi Costa is with us, direct from Brazil, I would imagine. Welcome.
Thank you. I'm actually in Denver right now, but thank you very much. Looking forward to this conversation. Yeah.
I have Brazil questions for you, but we'll get there. First, let's talk about something that I think we're both watching very, very, very closely, and that's the situation in gold. Because what a day to have a chat about what's going on there. Now, obviously, you've been quite bullish, and we've had quite the pullback recently, and it's been a little bit different this year versus last. Last year, it seemed like gold just could not be bothered with things like interest rates and the dollar. Whatever they were doing, it was just relentlessly marching higher. And since the start of this Iran war, we've kind of seen gold reconnect with past influences. So the war starts, we get an inflationary shock through oil, and the rise in rates ultimately ends up being bad news for gold. The dollar rallies, and you get this kind of more classic gold dynamic where fiat is up, interest rates are up, gold is the foil. What are you thinking here? Does this, I mean, obviously long-term questions of sort of why you might want to own gold structurally are what they are, and there can be a debate there. But near term, what does this feel like? Does this feel like we have more weakness here, or are you still looking at this as a buying opportunity?
Well, to be very clear, I've owned a core position of gold and gold miners in my portfolio recently. have really added to copper exposure in a significant way, with the idea that copper is, in my view, in a somewhat of a price discovery phase, and that copper miners, if you look at the chart relative to gold stocks, they have been really kind of work in a upward channel, historically speaking, and copper miners were more attractive than gold miners. Now, I'm saying this because recently, and I think if anybody that bothers to follow my my stuff, I've been very vocal here recently that I think that we're seeing the process of a bottom in gold prices, and there's plenty signs of that, in my opinion. Today's action doesn't change anything. Of course, nobody wants to step in before a bloodbath like this, but it's a good lesson of none of us are smart enough to know when things will turn. But I think as an investor, you gradually get your feet wet. And yesterday I had a little bit. Today I had a little more, and I see no problem doing this. Luckily I've got liquidity from dividends and other things that I get on a quarterly basis. I was lucky to have plenty of liquidity here. I think this is a great opportunity. I don't think we see many of those throughout gold cycles, that gold falls this much in such a short period of time, and everybody just flips from ultra bullish to just hating the metal. It's just part of the game. I mean, just get on with life and, lean on conviction, buy things that you think are high quality, know what you're buying. And that's the secret of investing, in my 2 cents. If I would put out there. But has the thesis changed? No, of course not. I mean, what changed here? I mean, central banks are not going to buy gold anymore? Really? If that's the thesis, that's nuts. I mean, that's just crazy. Or that the Fed is going to embark in a crazy hiking, environment for the next year or so, and we're going to go back to 2021, and we're going to see rate hikes of magnitude of maybe 5, 6, 7 times. Is that what people think? That's nuts. I mean, that's crazy. Look where we are in interest payments to GDP. We can't even hike 25 basis points probably. So I think that narrative is way overblown. That's what's causing this issue. Of course, the sell-off has been caused by the hiking and the hawkishness of the Fed being priced into markets, the energy space. But even that is down. So, anyways, I just think that's just there's a lot of holes in that narrative, and when you see things like that, you have to act. I think that we'll see in maybe even as short of a month or 2 months a big change in the narrative here.
Okay, let's take a look at sort of the mechanics of doing that. So obviously, if you have conviction that this is a pullback and not a change of course, and I think, looking at a gold price chart, it's not difficult to see that there is a lot more rallying than there is going the other way here in terms of a structural advancement. Obviously, gold has done tremendously well. In fact, part of the reason why it looks like central banks are holding so much gold, even though they're not buying very much of it, is a price effect. The value of their gold reserves has tremendously increased because of this rise in prices, and sort of the architecture of that rise seems pretty well intact. I mean, if you thought gold, as I've kind of thought about it, as a reflection of deglobalization and people wanting a kind of non-sovereign unit of value, none of that has gone away. In fact, it's become more acute, not less. So if you have this sort of core thesis and say, okay, well, I think this is a pullback, I think it's a discount. How do you approach structuring the trade for staying power? Are you looking at options? Are you looking at futures? Are you looking at maybe getting exposure through gold miners rather than the underlying? how do you weather this, and how do you put it on for staying power?
Yeah, I don't think you put all your capital all at once at all. What I do is I just gradually invest in things, and I have a list of companies that I love. And there's companies that are more on the senior side and companies that are more rifle shots in smaller businesses. In situations like this, I'm not adding to my small businesses because they're kind of in their own world, to be honest. And if we see a change in prices, in gold prices in the next, call it, month or two, kind of and I'm right. Let's say we are in the process of bottoming, and we see a bottom here near soon, and things are very different in 2 months from now. Then I would suspect that the seniors and the developers are going to rally much more, and so I've been adding and looking to add into that side of things mostly. And today the beauty of it is that the seniors have really, declined. I mean, you have a Nico down over 35 to 40%. No, I started buying when it probably hit 27%, if I recall correctly, was when I started buying Agnico. And to me, it was like, wow, that's awesome that I can buy this company, incredible business with great assets at a nearly 30% discount. And now we're at 35% or so. Who cares? I'll buy more. Hecla, similar situation. Hecla's down over 50% now. I started building a position on that. So all these kind of Newmont is another one that is down substantially. So there's different types of pullbacks. In this pullback, you're seeing a lot of high quality names that have declined substantially that, if we do see a bounce, could actually come back very strongly. So I'm interested in those. I'm not even going down or going up on the risk curve and taking developers because as much as these seniors in these sort of ads that I've been doing, just because these things have been so volatile recently that, what a great opportunity. So that's sort of where I am playing this, not through options. I don't do options in that my usual core positioning sometimes, but most times it's usually a hedge. This is a core position, so I've been just putting cash to work into these things. And Hecla down 12% today. I added to Hecla. But it could be down another 10% tomorrow, and I'll gradually put in a little bit more. And so that's, until I build a position, and then you can just kind of move forward with that way. And keep, who am I to say, but I would say that the wealth I've created in my life, majority of it has been through situations like this, where I personally don't mind days like today. I think there's a part of me that hurts, of course, and then a part of me that it's excited. In fact, I think with markets when silver was at $100 an ounce and pushing higher and higher and got to 120, obviously, but there's something inside of me that kind of, I don't know, it's a bit scary when you have your aunt and your cousin asking you questions about silver. There's nobody asking me that question right now, and which excites me. I go through the weekend looking at charts and thinking about what do I need to do. What a great time to be spending time in that, really thinking about what are the best quality. Like today, what am I spending time with? Yes, I'm looking at all my list of favorite companies. I'm building a whole model that I've been building for the last few months or so to look at these things. And I'm trying to make sure I'm not missing anything in terms of quality. And I'll tell you another thing that I'm doing as well. I'm getting ready to launch a fund as well in the space. And so I'm spending a lot of time there. So yeah, and it's exciting to see a market like this at a moment to launch a fund. I mean, that's exactly what you want. Maybe it's going to be
hard.
hard.
Assets on discount if you're going to launch a fund.
I mean, what the heck? I mean, it's going to be harder to raise money. Of course, it's always hard to raise money, but it's going to be harder to raise money in situations like this. Much easier when everybody's excited, but what a moment to be stepping into this. And so, yeah, I'm, trying to get my ducks in the row to act quickly here, but maybe I'm going to be late to the party a little bit, but we'll see.
You probably are going to take a similar tack. I promised a question on Brazil. I've been long for the better part of a year and a half. I think, and I'm doing it in a very simpleton kind of way. I'm just looking at EWZ. I'm not looking at individual companies, but I've been rolling this position and building it and growing it since we basically got the turn last year. And obviously, we've had something of a pullback here more recently, and it looks like maybe some political fuzz locally is getting in the way. Yeah. How do you feel about what's happening there, and more broadly in Latin America? Because I think that has been a very exciting region to start building positions in. I know I've been very bullish. I've looked at things like ILF. I've looked at just as a regional proxy, I've looked at Colombia and Mexico and Argentina, but focusing on Brazil and maybe just Latin America as a region with an opportunity here for something structural. What are you seeing there, and how are you looking at this pullback?
Yeah, I have a few themes in my mind that I'm paying attention to. Some of them, like I think of the world as, in that sense, just trying to simplify. Green light means, I want to accumulate. Red light means obviously I want to trim or sell or get out of my position. And orange line just means I just want to let things play out. I would say that across the themes that I'm watching, there's a few that are really on the green side right now. I just mentioned gold miners. Definitely think that that's the case. But another one is, you just mentioned, it's actually Brazil. Latin America overall until today was really diverging. There were some important divergences happening where you had Mexico, Colombia, I think even Argentina was diverging from Brazil as well. And Brazil was really selling off. And so when you have a sell-off, here's my approach to it, and I think that's my suggestion, is, think about it. Why is this being caused? So in Brazil's situation, the reason for the divergence is because in the political race that we're seeing, there's Lula and there's another person who is Bolsonaro's son. His name is Flavio. And Flavio had a few issues recently here with the release of a tape where he was having a conversation with a banker that was involved with Lula's, and not involved, but in a corruption scandal, but also involved with the parties and other parties. And it's a whole mess, political mess, the whole situation. Mm-hmm. And they learned that he was taking money from them for a movie that was going to be made about his dad. Well, then he loses popularity. Everyone is asking their questions about, what are we doing here voting to this guy? He's the second person on the race that was actually beating Lula in those last few weeks or so. And then all of a sudden he loses momentum. And the market obviously sees this as an issue, because if you're playing the elections potential shift, now you're in trouble, because, we just started to lose the race now to Lula. Lula gains momentum and everyone says, all right, welcome to communism and let's sell Brazilian equities. That's basically what's going on. And then you have a new person now coming in. His name is Renan, and he's, gaining momentum now. Not enough to challenge anybody, but it's certainly gaining momentum. But that also takes away momentum from Bolsonaro's son. And so that's also a problem. And so it's not good. And so here's the way I'm approaching the situation. For me, investing in Brazil was never about elections. Okay, never. Do I know that elections will have an impact on prices of things I'm buying? Yes, of course it will. No, I'm not stupid. Of course it will. But I need to be mindful of that. Why? Because we're going to see these types of fluctuations that we're seeing, and they don't change the fundamental story, right? It does not change the fundamental story. If the main reason why you bought those assets was nothing to do with elections, and elections is causing the discount, well, then that's a discount that you should be taking advantage of. That's the way I'm approaching this. I think it would be a plus if the elections shift in our favor and we see things changing positively, and we see a change in the guards in terms of the political leadership. I think that would be a positive for markets and for the economy. But I can't guarantee we're going to see that, and so I'm not relying on that at all. So I do think it's a very significant opportunity here in the markets. Brazil is something I've been spending a lot of time on as well. A lot more time than I was spending on gold miners. I wasn't expecting the gold miners to completely fall apart here recently. I thought we would see some more of a gradual move that would allow me to put the gold miners into the green light. But obviously this whole thing happened, and I have to change my short-term plans and also consider that I should be buying some of these gold miners too. So yeah, I was prior to this building a position on some new Brazilian names that I'm watching, which I'm not necessarily ready to share yet, but certainly I'm looking for mid cap. The problem with Brazilian equities right now is that you're playing the easy game, which is just buying the ETF. And bless your heart, and I hope it goes well. I think it will, but I'm just trying to, when I really like a theme, I try to go deeper and try to understand, like, can I get more asymmetry somehow? And the problem with Brazil today that not a lot of people are talking about internationally is that a lot of companies are getting out of the public markets, and the options you had years ago to invest in this in the country are being diminished, and so it's becoming harder and harder to find great companies with volume that you can buy as an ADR, because they're just going away. And so I have to be extremely selective on what I'm looking to acquire. And my issue with DWZ and others is simply because we have a very significant exposure to oil in that ETF. And oil to me is one of them that was maybe at a red light 2-3 weeks ago, and it's merging to a orange line or a yellow line that I'm just watching closely here. And it could turn into green here soon as well. And then now I have all my themes in green, and I have to just buy everything. But that's not the case yet. So I'm watching closely that one. And so I'm more interested in consumer businesses, banks. I'm interested in some mining companies too there. Not trying to overlap too much with what I have already in the mining space in Latin America. But really, truly just seeking of, good companies in the country that could perform well in this if my whole thesis plays out. So there's going to be plenty of things to be doing here. For those that have never gotten exposure to Brazil, this is, I think, a very important opportunity. And I would say that, this has been a very important trade of mine, at least in the last 2 years as well. It's been a very good trade. And, things were ahead of themselves not too long ago. I was fortunate to trim some of that in my portfolio. Not enough, obviously, but I definitely trimmed some. I definitely trim a lot of energy over the last 2 months, which financed a lot of my purchases in the copper space recently. So I hope I'm not sounding too complicated, but that's sort of what I have in mind. And I think the Brazilian space is really attractive right now.
Very interesting. I'm obviously watching very closely, thinking maybe it's the Tarcísio De Freitas, maybe it's somebody else, but it does seem like there's a regional shift away into a sort of Malay-like direction, or at least Malay-adjacent kind of feeling in a lot of countries that want to liberalize and grow. And so I'm interested in the entire region, but we could talk about this for ages and ages, Tavi. Let's stop right here and tell the good folks where they can follow you, as I do, because they really are very nice charts, and I recommend everybody has a look. But tell the folks where they can get more.
Yeah, they can find me on Twitter at Tavi Costa, and recently I've been sharing more in-depth thoughts on Substack, where I just go deeper into how I think about positioning, how I think about expressing those ideas, not just about a pretty chart, which I like it too, but going deeper because I got a lot of questions as well. Okay, great chart. How do, what do I do with this? And so that's sort of the plan with Substack, is that just elaborate further and go deeper into this is how I would think about investing in if I was looking at this chart as an attractive way of putting capital to work. So Substack would be the place. LinkedIn, I also share things there. Just look for my name, Tavi Costa. And yeah, that's it. Those are the areas. And hopefully soon we'll have a website for the funds and share more about that as well.
Beautiful. We certainly hope you'll come back here and continue to enlighten us. Tavi Costa, everybody, thank you very much.
Thanks for having me.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at tastylive, joined by a very special guest, founder and CEO of Azuria Capital and the purveyor of pretty charts on social media. Mr. Tavi Costa is with us, direct from Brazil, I would imagine. Welcome.
Thank you. I'm actually in Denver right now, but thank you very much. Looking forward to this conversation. Yeah.
I have Brazil questions for you, but we'll get there. First, let's talk about something that I think we're both watching very, very, very closely, and that's the situation in gold. Because what a day to have a chat about what's going on there. Now, obviously, you've been quite bullish, and we've had quite the pullback recently, and it's been a little bit different this year versus last. Last year, it seemed like gold just could not be bothered with things like interest rates and the dollar. Whatever they were doing, it was just relentlessly marching higher. And since the start of this Iran war, we've kind of seen gold reconnect with past influences. So the war starts, we get an inflationary shock through oil, and the rise in rates ultimately ends up being bad news for gold. The dollar rallies, and you get this kind of more classic gold dynamic where fiat is up, interest rates are up, gold is the foil. What are you thinking here? Does this, obviously, long-term questions of sort of why you might want to own gold structurally are what they are, and there can be a debate there. But near term, what does this feel like? Does this feel like we have more weakness here, or are you still looking at this as a buying opportunity?
Well, to be very clear, I've owned a core position of gold and gold miners in my portfolio recently. Have really added to copper exposure in a significant way, with the idea that copper is, in my view, in a somewhat of a price discovery phase. And that copper miners, if you look at the chart relative to gold stocks, they have been really kind of work in a upward channel, historically speaking. And copper miners were more attractive than gold miners. Now, I'm saying this because recently, and I think if anybody that bothers to follow my stuff, I've been very vocal here recently that I think that we're seeing the process of a bottom in gold prices, and there's plenty signs of that, in my opinion. Today's action doesn't change anything. Of course, nobody wants to step in um, before a bloodbath like this. And but it's a good lesson of none of us are smart enough to know when things will turn. But I think as an investor, you gradually get your feet wet. And yesterday I had a little bit. Today I had a little more, and I see no problem doing this. Luckily I've got liquidity from dividends and other things that I get on a quarterly basis. I was lucky to have plenty of liquidity here. I think this is a great opportunity. I don't think we see many of those throughout gold cycles that gold falls this much in such a short period of time, and everybody just flips from ultra bullish to just hating the metal. It's just part of the game. I mean, just get on with life and, lean on conviction, buy things that you think are high quality, know what you're buying. And that's the secret of investing, in my 2 cents, if I would put out there. But has the thesis changed? No, of course not. I mean, what changed here? I mean, central banks are not going to buy gold anymore? Really? If that's the thesis, that's nuts. I mean, that's just crazy. Or that the Fed is going to embark in a crazy hiking, environment for the next year or so, and we're going to go back to 2021, and we're going to see rate hikes of magnitude of maybe 5, 6, 7 times. Is that what people think? That's nuts. I mean, that's crazy. Look where we are in interest payments to GDP. We can't even hike 25 basis points probably. So I think that narrative is way overblown. That's what's causing this issue, of course. The sell-off has been caused by the hiking and the hawkishness of the Fed being priced into markets, the energy space. But even that is down. So anyways, I just think that's just there's a lot of holes in that narrative. And, when you see, things like that, you have to act. I think that we'll see in maybe even as short of a month or 2 months, a big change in the narrative here.
Okay, let's take a look at sort of the mechanics of doing that. So obviously, if you have conviction that this is a pullback and not a change of course, and I think looking at a gold price chart, it's not difficult to see that there is a lot more rallying than there is going the other way here in terms of a structural advance. And obviously, gold has done tremendously well. In fact, part of the reason why it looks like central banks are holding so much gold, even though they're not buying very much of it, is a price effect. The value of their gold reserves has tremendously increased because of this rise in prices, and sort of the architecture of that rise seems pretty well intact. I mean, if you thought gold, as I've kind of thought about it, as a reflection of deglobalization and people wanting a kind of non-sovereign unit of value, none of that has gone away. In fact, it's become more acute, not less. So if you have this sort of core thesis and say, okay, well, I think this is a pullback, I think it's a discount. How do you approach structuring the trade for staying power? Are you looking at options? Are you looking at futures? Are you looking at maybe getting exposure through gold miners rather than the underlying? How do you weather this, and how do you put it on for staying power?
Yeah, I don't think you put all your capital all at once at all. What I do is I just gradually invest in things, and I have a list of companies that I love. And there's companies that are more on the senior side and companies that are more rifle shots in smaller businesses. In situations like this, I'm not adding to my small businesses because they're kind of in their own world, to be honest. And if we see a change in prices, in gold prices in the next, call it, month or two, kind of and I'm right, let's say we are in the process of bottoming and we see a bottom here near soon, and things are very different in 2 months from now, then I would suspect that the seniors and the developers are going to rally much more. And so I've been adding and looking to add into that side of things mostly. And today the beauty of it is that the seniors have really, declined. I mean, you have a Nico down over 35 to 40%. No, I started buying when it probably hit 27%, if I recall correctly, was when I started buying Agnico. And to me, it was like, wow, that's awesome that I can buy this company, incredible business with great assets at a nearly 30% discount. And now we're at 35% or so. Who cares? I'll buy more. Hecla, similar situation. Hecla's down over 50% now. I started building a position on that. So all these kind of Newmont is another one that is down substantially. So there's different types of pullbacks. In this pullback, you're seeing a lot of high quality names that have declined substantially. That if we do see a bounce, could actually come back very strongly. So I'm interested in those. I'm not even going down or going up on the risk curve and taking developers because as much as these seniors in these sort of ads that I've been doing, just because these things have been so volatile recently that, what a great opportunity. So that's sort of where I am playing this, not through options. I don't do options in that my usual core positioning sometimes, but most times it's usually a hedge. This is a core position, so I've been just adding, putting cash to work into these things. And Hecla down 12% today. I added to Hecla, but it could be down another 10% tomorrow, and I'll gradually put in a little bit more. And so that's, until I build a position, and then you can just kind of move forward with that way. And keep, who am I to say, but I would say that the wealth I've created in my life, majority of it has been through situations like this, where I personally don't mind days like today. I think there's a part of me that hurts, of course, and then a part of me that it's excited. In fact, I think with markets when silver was at $100 an ounce and pushing higher and higher and got to 120, obviously, but there's something inside of me that kind of, I don't know, it's a bit scary when you have your aunt and your cousin asking you questions about silver. There's nobody asking me that question right now, and which excites me. I go through the weekend looking at charts and thinking about what do I need to do. What a great time to be spending time in that, really thinking about what are the best quality, like today, what am I spending time with? Yes, I'm looking at all my list of favorite companies. I'm building a whole model that I've been building for the last few months or so, to look at these things. And I'm trying to make sure I'm not missing anything in terms of quality. And I'll tell you another thing that I'm doing as well. I'm getting ready to launch a fund as well in the space. And so I'm spending a lot of time there. So yeah, and it's exciting to see a market like this at a moment to launch a fund. I mean, that's exactly what you want. Maybe it's going to be hard.
You want assets on discount if you're going to launch a fund.
I mean, what the heck? I mean, it's going to be harder to raise money. Of course, it's always hard to raise money, but it's going to be harder to raise money in situations like this. Much easier when everybody's excited, but what a moment to be stepping into this. And so, yeah, I'm, trying to get my ducks on the roll to act quickly here, but maybe I'm going to be late to the party a little bit, but we'll see.
You probably are going to take a similar tack. I promised a question on Brazil. I've been long for the better part of a year and a half. I think, and I'm doing it in a very simpleton kind of way. I'm just looking at EWZ. I'm not looking at individual companies, but I've been rolling this position and building it and growing it since we basically got the turn last year. And obviously we've had something of a pullback here more recently, and it looks like maybe some political fuzz locally is getting in the way. Yeah. How do you feel about what's happening there and more broadly in Latin America? Because I think that has been a very exciting region to start building positions in. I know I've been very bullish. I've looked at things like ILF. I've looked at just as a regional proxy. I've looked at Colombia and Mexico and Argentina. But focusing on Brazil and maybe just Latin America as a region with an opportunity here for something structural. What are you seeing there, and how are you looking at this pullback?
Yeah, I have a few themes in my mind that I'm paying attention to. Some of them, like I think of the world as, in that sense, just trying to simplify. Green light means, I want to accumulate. Red light means obviously I want to trim or sell or get out of my position. And orange line just means I just want to let things play out. I would say that across the themes that I'm watching, there's a few that are really on the green side right now. I just mentioned gold miners. Definitely think that that's the case. But another one is, you just mentioned, it's actually Brazil. Latin America overall until today was really diverging. There were some important divergences happening where you had Mexico, Colombia, I think even Argentina was diverging from Brazil as well. And Brazil was really selling off. And so when you have a sell-off, here's my approach to it, and I think that's my suggestion, think about it. Why is this being caused? So in Brazil's situation, the reason for the divergence is because in the political race that we're seeing, there's Lula and there's another person who is Bolsonaro's son. His name is Flavio. And Flavio had a few issues recently here with the release of a tape where he was having a conversation with a banker that was involved with Lula's, and not involved, but in a corruption scandal, but also involved with the parties and other parties. And it's a whole mess, political mess, the whole situation. Mm-hmm. And they learned that he was taking money from them for a movie that was going to be made about his dad. Well, then he loses popularity. Everyone is asking their questions about, what are we doing here voting to this guy? He's the second person on the race that was actually beating Lula in those last few weeks or so. And then all of a sudden he loses momentum. And the market obviously sees this as an issue, because if you're playing the elections potential shift, now you're in trouble, because, we just started to lose the race now to Lula. Lula gains momentum and everyone says, all right, welcome to communism and let's sell Brazilian equities. That's basically what's going on. And then you have a new person now coming in. His name is Renan, and he's, gaining momentum now. Not enough to challenge anybody, but it's certainly gaining momentum. But that also takes away momentum from Bolsonaro's son. And so that's also a problem. And so it's not good. And so here's the way I'm approaching the situation. For me, investing in Brazil was never about elections. Okay, never. Do I know that elections will have an impact on prices of things I'm buying? Yes, of course it will. I'm not stupid. Of course it will. But I need to be mindful of that. Why? Because we're going to see these types of fluctuations that we're seeing, and they don't change the fundamental story, right? It does not change the fundamental story. The main reason why you bought those assets was nothing to do with elections, and elections is causing the discount, well, then that's a discount that you should be taking advantage of. That's the way I'm approaching this. I think it would be a plus if the elections shift in our favor and we see things changing positively, and we see a change in the guards in terms of the political leadership. I think that would be a positive for markets and for the economy. But I can't guarantee we're going to see that, and so I'm not relying on that at all. Um, so I do think it's a very significant opportunity here in the markets. Brazil is something I've been spending a lot of time on as well. A lot more time than I was spending on gold miners. I wasn't expecting the gold miners to completely fall apart here recently. I thought we would see some more of a gradual move that would allow me to put the gold miners into the green light. But obviously this whole thing happened and I have to change my short-term plans and also consider that I should be buying some of these gold miners too. So yeah, I was prior to this building a position on some new Brazilian names that I'm watching, which I'm not necessarily ready to share yet, but certainly I'm looking for mid cap. The problem with Brazilian equities right now is that you're playing the easy game, which is just buying the ETF. And bless your heart, and I hope it goes well. I think it will, but I'm just trying to, when I really like a theme, I try to go deeper and try to understand, like, can I get more asymmetry somehow? And the problem with Brazil today that not a lot of people are talking about internationally is that a lot of companies are getting out of the public markets, and the options you had years ago to invest in this in the country are being diminished. And so it's becoming harder and harder to find great companies with volume that you can buy as an ADR, because they're just going away. And so I have to be extremely selective on what I'm looking to acquire. And my issue with DWZ and others is simply because we have a very significant exposure to oil in that ETF. And oil to me is one of them that was maybe at a red light 2-3 weeks ago, and it's merging to a orange line or a yellow line that I'm just watching closely here. And it could turn into green here soon as well. And then now I have all my themes in green and I have to just buy everything. But that's not the case yet. So I'm watching closely that one. And so I'm more interested in consumer businesses, banks. I'm interested in some mining companies too there. Not trying to overlap too much with what I have already in the mining space in Latin America. But really, truly just seeking of, good companies in the country that could perform well in this if my whole thesis plays out. So there's going to be plenty of things to be doing here for those that have never gotten exposure to Brazil. This is, I think, a very important opportunity. And I would say that, this has been a very important trade of mine, at least in the last 2 years as well. It's been a very good trade. And, things were ahead of themselves not too long ago. I was fortunate to trim some of that in my portfolio. Not enough, obviously, but I definitely trimmed some. I definitely trim a lot of energy over the last 2 months, which financed a lot of my purchases in the copper space recently. So I hope I'm not sounding too complicated, but that's sort of what I have in mind. And I think the Brazilian space is really attractive right now.
Very interesting. I'm obviously watching very closely, thinking maybe it's Tarcísio de Freitas, maybe it's somebody else, but it does seem like there's a regional shift away into a sort of Malay-like direction, or at least Malay adjacent kind of feeling in a lot of countries that want to liberalize and grow. And so I'm interested in the entire region, but we could talk about this for ages and ages, Tavi. Let's stop right here and tell the good folks where they can follow you, as I do, because they really are very nice charts, and I recommend everybody has a look. But tell the folks where they can get more.
Yeah, they can find me on Twitter at Tavi Costa, and recently I've been sharing more in-depth thoughts on Substacks, where I just go deeper into how I think about positioning, how I think about expressing those ideas, not just about a pretty chart, which I like it too, but going deeper because I got a lot of questions as well. Okay, great chart. How do, what do I do with this? And so that's sort of the plan with Substack is that just elaborate further and go deeper into this is how I would think about investing in if I was looking at this chart as an attractive way of putting capital to work. So Substack would be the place. LinkedIn, I also share things there. Just look for my name, Tavi Costa. And yeah, that's it. Those are the areas. And hopefully soon we'll have a website for the funds and share more about that as well.
Beautiful. We certainly hope you'll come back here and continue to enlighten us. Tavi Costa, everybody, thank you very much.
Thanks for having me.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at tastylive, joined by a very special guest, founder and CEO of Azuria Capital and the purveyor of pretty charts on social media. Mr. Tavi Costa is with us, direct from Brazil, I would imagine. Welcome.
Thank you. I'm actually in Denver right now, but thank you very much. Looking forward to this conversation. Yeah.
I have Brazil questions for you, but we'll get there. First, let's talk about something that I think we're both watching very, very, very closely, and that's the situation in gold. Because what a day to have a chat about what's going on there. Now, obviously, you've been quite bullish, and we've had quite the pullback recently, and it's been a little bit different this year versus last. Last year, it seemed like gold just could not be bothered with things like interest rates and the dollar. Whatever they were doing, it was just relentlessly marching higher. And since the start of this Iran war, we've kind of seen gold reconnect with past influences. So the war starts, we get an inflationary shock through oil, and the rise in rates ultimately ends up being bad news for gold. The dollar rallies, and you get this kind of more classic gold dynamic where fiat is up, interest rates are up, gold is the foil. What are you thinking here? Does this, I mean, obviously long-term questions of sort of why you might want to own gold structurally are what they are, and there can be a debate there. But near term, what does this feel like? Does this feel like we have more weakness here, or are you still looking at this as a buying opportunity?
Well, to be very clear, I've owned a core position of gold and gold miners in my portfolio recently, have really added to copper exposure in a significant way with the idea that copper is, in my view, in a somewhat of a price discovery phase. And that copper miners, if you look at the chart relative to gold stocks, they have been really kind of work in a upward channel, historically speaking. And copper miners were more attractive than gold miners. Now, I'm saying this because recently, and I think if anybody that bothers to follow my my stuff, I've been very vocal here recently that I think that we're seeing the process of a bottom in gold prices, and there's plenty signs of that, in my opinion. Today's action doesn't change anything. Of course, nobody wants to step in before a bloodbath like this, but it's a good lesson of none of us are smart enough to know when things will turn. But I think as an investor, you gradually get your feet wet. And yesterday I had a little bit. Today I added a little more, and I see no problem doing this. Luckily I've got liquidity from dividends and other things that I get on a quarterly basis. I was lucky to have plenty of liquidity here. I think this is a great opportunity. I don't think we see many of those throughout gold cycles, that gold falls this much in such a short period of time, and everybody just flips from ultra bullish to just hating the metal. It's just part of the game. I mean, just get on with life and, lean on conviction, buy things that you think are high quality, know what you're buying. And that's the secret of investing, in my 2 cents, if I would put out there. But has the thesis changed? No, of course not. I mean, what changed here? I mean, central banks are not going to buy gold anymore? Really? If that's the thesis, that's nuts. I mean, that's just crazy. Or that the Fed is going to embark in a crazy hiking, you know, environment for the next year or so, and we're going to go back to 2021, and we're going to see rate hikes of magnitude of maybe 5, 6, 7 times. Is that what people think? That's nuts. I mean, that's crazy. Look where we are in interest payments to GDP. We can't even hike 25 basis points probably. So I think that narrative is way overblown. That's what's causing this issue, of course. The sell-off has been caused by the hiking and the hawkishness of the Fed being priced into markets, the energy space. But even that is down. So, anyways, I just think that's just there's a lot of holes in that narrative, and when you see things like that, you have to act. I think that we'll see in maybe even as short of a month or 2 months a big change in the narrative here.
Okay, let's take a look at sort of the mechanics of doing that. So obviously, if you have conviction that this is a pullback and not a change of course, and I think looking at a gold price chart, it's not difficult to see that there is a lot more rallying than there is going the other way here in terms of a structural advancement. Obviously, gold has done tremendously well. In fact, part of the reason why it looks like central banks are holding so much gold, even though they're not buying very much of it, is a price effect. The value of their gold reserves has tremendously increased because of this rise in prices, and sort of the architecture of that rise seems pretty well intact. I mean, if you thought gold, as I've kind of thought about it, as a reflection of deglobalization and people wanting a kind of non-sovereign unit of value, none of that has gone away. In fact, it's become more acute, not less. So if you have this sort of core thesis and say, okay, well, I think this is a pullback, I think it's a discount. How do you approach structuring the trade for staying power? Are you looking at options? Are you looking at futures? Are you looking at maybe getting exposure through gold miners rather than the underlying? How do you weather this, and how do you put it on for staying power?
Yeah, I don't think you put all your capital all at once at all. What I do is I just gradually invest in things, and I have a list of companies that I love. And there's companies that are more on the senior side and companies that are more rifle shots in smaller businesses. In situations like this, I'm not adding to my small businesses because they're kind of in their own world, to be honest. And if we see a change in prices, in gold prices in the next, call it, month or two, kind of and I'm right, let's say we are in the process of bottoming and we see a bottom here near soon, and things are very different in 2 months from now, then I would suspect that the seniors and the developers are going to rally much more. And so I've been adding and looking to add into that side of things mostly. And today, the beauty of it is that the seniors have really, declined. I mean, you have a Nico down over 35 to 40%. Now, I started buying when it probably hit 27%, if I recall correctly, was when I started buying Agnico. And to me, it was like, wow, that's awesome that I can buy this company, incredible business with great assets at a nearly 30% discount. And now we're at 35% or so. Who cares? I'll buy more. Hecla, similar situation. Hecla's down over 50% now. I started building a position on that. So all these kind of name, Newmont is another one that is down substantially. So there's different types of pullbacks. In this pullback, you're seeing a lot of high quality names that have declined substantially. That, if we do see a bounce, could actually come back very strongly. So I'm interested in those. I'm not even going down or going up on the risk curve and taking developers, because as much as these seniors in these sort of ads that I've been doing, just because these things have been so volatile recently that, what a great opportunity. So that's sort of where I am playing this, not through options. I don't do options in that my usual core positioning sometimes, but most times it's usually a hedge. This is a core position, so I've been just putting cash to work into these things. And Hecla down 12% today. I added to Hecla, but it could be down another 10% tomorrow, and I'll gradually put in a little bit more. And so that's, until I build a position, and then you can just kind of move forward with that way. And keep, who am I to say, but I would say that the wealth I've created in my life, majority of it has been through situations like this, where I personally don't mind days like today. I think there's a part of me that hurts, of course, and then a part of me that it's excited. In fact, I think with markets, when silver was at $100 an ounce and pushing higher and higher and got to 120, obviously, but there's something inside of me that kind of, I don't know, it's a bit scary when you have your aunt and your cousin asking you questions about silver. There's nobody asking me that question right now, and which excites me. I go through the weekend looking at charts and thinking about, what do I need to do? What a great time to be spending time in that, really thinking about what are the best quality. Like today, what am I spending time with? Yes, I'm looking at all my list of favorite companies. I'm building a whole model that I've been building for the last few months or so, to look at these things. And I'm trying to make sure I'm not missing anything in terms of quality. And I'll tell you another thing that I'm doing as well. I'm getting ready to launch a fund as well in the space. And so I'm spending a lot of time there. So yeah, and it's exciting to see a market like this at a moment to launch a fund. I mean, that's exactly what you want. Maybe it's going to be hard.
Assets on discount if you're going to launch a fund.
I mean, what the heck? I mean, it's going to be harder to raise money. Of course, it's always hard to raise money, but it's going to be harder to raise money in situations like this. Much easier when everybody's excited, but what a moment to be stepping into this. And so, yeah, I'm, trying to get my ducks in the row to act quickly here, but maybe I'm going to be late to the party a little bit, but we'll see.
You probably are going to take a similar tack. I promised a question on Brazil. I've been long for the better part of a year and a half. I think, and I'm doing it in a very simpleton kind of way. I'm just looking at EWZ. I'm not looking at individual companies, but I've been rolling this position and building it and growing it since we basically got the turn last year. And obviously we've had something of a pullback here more recently, and it looks like maybe some political fuzz locally is getting in the way. Yeah. How do you feel about what's happening there, and more broadly in Latin America? Because I think that has been a very exciting region to start building positions in. I know I've been very bullish. I've looked at things like ILF. I've looked at just as a regional proxy. I've looked at Colombia and Mexico and Argentina. But focusing on Brazil and maybe just Latin America as a region with an opportunity here for something structural. What are you seeing there, and how are you looking at this pullback?
Yeah, I have a few themes in my mind that I'm paying attention to. Some of them like I think of the world as, in that sense, just trying to simplify. Green light means, I want to accumulate. Red light means obviously I want to trim or sell or get out of my position. And orange line just means I just want to let things play out. I would say that across the themes that I'm watching, there's a few that are really on the green side right now. I just mentioned gold miners. Definitely think that that's the case. But another one is you just mentioned, it's actually Brazil. Latin America overall until today was really diverging. There were some important divergences happening where you had Mexico, Colombia, I think even Argentina was diverging from Brazil as well. And Brazil was really selling off. And so when you have a sell off, here's my approach to it. And I think that's my suggestion is, think about it. Why is this being caused? So in Brazil's situation, the reason for the divergence is because in the political race that we're seeing, there's Lula and there's another person who is Bolsonaro's son. His name is Flavio. And Flavio had a few issues recently here with the release of a tape where he was having a conversation with a banker that was involved with Lula's and not involved, but in a corruption scandal, but also involved with the parties and other parties. And it's a whole mess, political mess, the whole situation. And they learned that he was taking money from them for a movie that was going to be made by his dad. Well, then he loses popularity. Everyone is asking their questions about what are we doing here, voting to this guy. He's the second person on the race that was actually beating Lula in those last few weeks or so. And then all of a sudden he loses momentum. And the market obviously sees this as an issue because if you're playing the elections potential shift, now you're in trouble because, we just started to lose the race now to Lula. Lula gains momentum and everyone says, all right, welcome to communism and let's sell Brazilian equities. That's basically what's going on. And then you have a new person now coming in. His name is Renan, and he's, gaining momentum now. Not enough to challenge anybody, but it's certainly gaining momentum. But that also takes away momentum from Bolsonaro's son. And so that's also a problem. And so it's not good. And so here's the way I'm approaching the situation. For me, investing in Brazil was never about elections. Okay, never. Do I know that elections will have an impact on prices of things I'm buying? Yes, of course it will. No, I'm not stupid. Of course it will. But I need to be mindful of that. Why? Because we're going to see these types of fluctuations that we're seeing, and they don't change the fundamental story, right? It does not change the fundamental story. The main reason why you bought those assets was nothing to do with elections, and elections is causing the discount, well, then that's a discount that you should be taking advantage of. That's the way I'm approaching this. I think it would be a plus if the elections shift in our favor and we see things changing positively, and we see a change in the guards in terms of the political leadership. I think that would be a positive for markets and for the economy. But I can't guarantee we're going to see that. And so I'm not relying on that at all. So I do think it's a very significant opportunity here in the markets. Brazil is something I've been spending a lot of time on as well. A lot more time than I was spending on gold miners. I wasn't expecting the gold miners to completely fall apart here recently. I thought we would see some more of a gradual move that would allow me to put the gold miners into the green light. But obviously this whole thing happened and I have to change my short-term plans and also consider that I should be buying some of these gold miners too. So yeah, I was prior to this building a position on some new Brazilian names that I'm watching, which I'm not necessarily ready to share yet, but certainly I'm looking for mid cap. The problem with Brazilian equities right now is that you're playing the easy game, which is just buying the ETF. And bless your heart, and I hope it goes well. I think it will, but I'm just trying to, when I really like a theme, I try to go deeper and try to understand, like, can I get more asymmetry somehow? And the problem with Brazil today that not a lot of people are talking about internationally is that a lot of companies are getting out of the public markets. And the options you had years ago to invest in this in the country are being diminished. And so it's becoming harder and harder to find great companies with volume that you can buy as an ADR because they're just going away. And so I have to be extremely selective on what I'm looking to acquire. And my issue with DWZ and others is simply because we have a very significant exposure to oil in that ETF. And oil to me is one of them that was maybe at a red light 2-3 weeks ago, and it's merging to a orange line or a yellow line that I'm just watching closely here. And it could turn into green here soon as well. And then now I have all my themes in green and I have to just buy everything. But that's not the case yet. So I'm watching closely that one. And so I'm more interested in consumer businesses, banks. I'm interested in some mining companies too there. Not trying to overlap too much with what I have already in the mining space in Latin America. But really, truly just seeking of, good companies in the country that could perform well in this if my whole thesis plays out. So there's going to be plenty of things to be doing here for those that have never gotten exposure to Brazil. This is, I think, a very important opportunity. And I would say that, this has been a very important trade of mine, at least in the last 2 years as well. It's been a very good trade. And, things were ahead of themselves not too long ago. I was fortunate to trim some of that in my portfolio. Not enough, obviously, but I definitely trimmed some. I definitely trim a lot of energy over the last 2 months, which financed a lot of my purchases in the copper space recently. So I hope I'm not sounding too complicated, but that's sort of what I have in mind. And I think the Brazilian space is really attractive right now.
Very interesting. I'm obviously watching very closely, thinking maybe it's the Tarcísio de Freitas, maybe it's somebody else, but it does seem like there's a regional shift away into a sort of Malay-like direction, or at least Malay adjacent kind of feeling in a lot of countries that want to liberalize and grow. And so I'm interested in the entire region, but we could talk about this for ages and ages, Tavi. Let's stop right here and tell the good folks where they can follow you, as I do, because they really are very nice charts, and I recommend everybody has a look. But tell the folks where they can get more.
Yeah, they can find me on Twitter at Tavi Costa, and recently I've been sharing more in-depth thoughts on Substack, where I just go deeper into how I think about positioning, how I think about expressing those ideas, not just about a pretty chart, which I like it too, but going deeper because I got a lot of questions as well. Okay, great chart. What do I do with this? And so that's sort of the plan with Substack is just elaborate further and go deeper into this is how I would think about investing in if I was looking at this chart as an attractive way of putting capital to work. So Substack would be the place. LinkedIn, I also share things there. Just look for my name, Tavi Costa. And yeah, that's it. Those are the areas. And hopefully soon we'll have a website for the funds and share more about that as well.
Beautiful. We certainly hope you'll come back here and continue to enlighten us. Tavi Costa, everybody, thank you very much.
Thanks for having me.
Jim Schultz here for Calculated Risk. And don't forget, before we get started, the best ways you can help us are by liking the video or subscribing to the channel. Either one of those really helps us out a lot. So this is it. One of the classic tasty strategies, the short strangle. I mean, it's pretty much classic for any option seller out there, but we certainly use it all the time here at Tasty. And what do you do with a short strangle? You sell a put below and you sell a call above, right? Same underlying, same expiration. You're really selling premium on both sides of the market, really wanting the stock to just kind of meander around and not really do too much. There's no prediction, there's no direction, there's no needing to be right about where the stock is going. You're really trying to tap into the non-directional elements and non-directional metrics of time and volatility. Let the positive theta take over, let the negative vega take over, and that is how a short strangle is structured. So here today, in a couple of seconds, I want to hop in and let's break one down. So before we hop into the platform, let's lay down an even stronger foundation. Why do we like short strangle so much? Why do we like short premium so much? Let me count the ways. But specifically related to a short strangle, in a market that's governed by unpredictability and randomness, man, it can be really, really difficult to know where the stock market is going next, to know where Netflix is going next, and to know where the S&P 500 is going next. It might even be, dare I say, downright impossible. And therein lies the beauty of a strategy like a short strangle. You're selling that premium on both sides. You've got the theta decay working for you on both sides. And so in a market that is bouncing around randomly and is quite unpredictable, you don't need to know where the stock is going, right? You typically have a very wide profit zone setup. You can typically sell a put pretty far below where the stock is and sell a call pretty far above where the stock is. And as long as the stock stays between your strikes, you're in really good shape. You don't really need the stock to do anything special. You just kind of need it to not rip your face off, because it's been said before, and I don't know who said it, but man, it's a catchy little jingle that sticks with you despite your best efforts. For every gimme, there's a gotcha. So what's the gotcha with a short strangle? Well, it's undefined risk. You don't have long legs that are capping your risk. You don't have long legs that are capping your downside on either side of the market. So if you want to tap into the high probabilities of a short strangle, that's the price of admission. If you want to tap into the unfiltered Greek exposure of a short strangle, that's the price of admission. And if you want to tap into the easier adjustments that you can make down the road, that is the price of admission. So all right, now that we have a foundation set, let's hop into Tasty Trade. Let's show how to set up a short strangle strategy. So I am inside of my Tasty Trade platform, and I've got Starbucks pulled up, mostly because autumn has forced me to pull up a Starbucks. But if you take a look at Starbucks, you go into the July cycle with 39 days to go. Typically, when it comes to order entry on all of our short premium trades, we like to be around that 45-day marker. So the monthly cycle closest to 45 days is going to make the most sense. The nice thing about Starbucks is it's only a $95 stock. And so we're not dealing with a stock or an index that's 200 or 300 or 500. So this is going to be an easier trade to fit into, even a modestly sized portfolio, as we'll get into here in just a couple of minutes. Okay, so we've got our expiration set. One of the next things you want to make sure to check is where is the implied volatility rank on that stock. And generally speaking, we like to be around 30 or higher. And so Starbucks is a little bit shy of 30, but for the purposes of this illustration, we are already too far in to turn back now. So Starbucks is going to be our choice. Again, typically looking for about 30 or higher, but 29, 30, if it's good enough for government work, it is absolutely good enough for us. So when we go into the July cycle with 39 days to go, now I'm generally going to be looking at what type of delta am I looking to choose for my actual strategy. And generally speaking, with a strangle, we like to live right around the 16 delta marker on both sides of the market. Now, with Starbucks, you have $5 wide strikes. You don't have the dollar wide strike increments that you might have in an index like SPY, IWM, QQQ, but those are obviously much higher priced instruments, so it's harder to do that with a modestly sized account. So I did want to choose a stock like Starbucks in all seriousness, because it's going to be something that a lot more traders can fit into their portfolio. So let's just choose, like if I chose maybe a 26 delta on the put side, it's a little higher than we would typically like, but it's okay. And then maybe I choose a 17 delta on the call side. I'm going to sell the put and I'm going to sell the call. Again, I'm collecting premium on both sides of the market. So if I delete those circles, I go in and sell the put, sell my 90 put, and then I sell my 105 call, you can see I'm going to be able to collect about a $2.30 credit for this short strangle. And again, you can toggle the strikes up and down to kind of form fit this strategy to the way that you want to trade. Maybe you like to take less risk, so you move the strikes out and you collect even less. Maybe you're okay taking more risk, so you bring the strikes in and you collect even more. Again, it's gimmies and gotchas. It's pros and cons. It's an exchange between, your probability of profit, which you see right here, and your credit collected. Like right now, I kind of like the 90-105, but if I wanted to increase my probabilities even more and I'm willing to give up some credit, I can move my 90 strike down to the 85. Now my pop just jumped to 76% and my credit is $1.43. Again, this is for you to decide. You have to blaze your own trail forward through the forest. I like the 90-105, but you can toggle this around to customize it to fit your account size, your experience level, your preferences, your risk tolerance, all those different things. Again, understand that the credit that I collect is going to be the maximum profit. And so, I'm collecting about $2.34. That means my maximum profit is going to be $233 or $234 as the market is moving around, because the maximum profit here is showing you on a total contract basis, whereas the credit that I'm collecting is on a per share basis. And then, of course, you've got the probability of collecting 50% at any time over the life of the trade. We've got a little bit of positive delta. The extrinsic value is going to map to the credit that I collect because I'm selling out of the money options. My theta is going to show me how much I'm collecting per day in terms of daily decay. We've already covered the maximum profit. The maximum loss is negative infinity, which that is certain to twist up a couple of knickers out there. But in order for that to happen, Starbucks would have to print positive infinity. Is that a zero probability event? Not theoretically. Is that a zero probability event practically? I think it is, but you have to draw your own conclusion. But lastly, for the buying power, typically we like to live between 3 and 7% of our account size when it comes to our buying power on an undefined risk position. Now, in this account, this is the From Theory to Practice account, we have right now around 34, maybe 35,000 in the account. So this is only, about 4% of the account size. So from a position sizing standpoint, this fits a lot of the criteria that we would look for an undefined risk position. So for you out there, if you're considering, this trade or any other trade when it comes to undefined risk, I would say 3 to 7% is going to make a lot of sense. So if you want to do this trade or a trade similar to this one, $1,300, you're probably going to want to have at least $20,000 in your account. You could maybe eke by with like 16, 17,000, but just to keep a nice round number for my round number bros that might be watching the show today, I'm going to say 20,000 or more is probably what you want to have to put on this undefined risk strategy or one similar to it when it comes to a short strangle. So those are the key elements that you want to watch out for or be on the lookout for or understand when it comes to setting up a short strangle. Now, how do we manage the trade from here? Well, let's go ahead and let's pick that low-hanging fruit right off the tree. Managing winners. Generally speaking, 50% of max profit is going to be our default setting. Now, if it overperforms in just a couple of days or like a week or what have you, and you're already at 20% really quickly or 25% really quickly, then go ahead and take it off early. Like, that's absolutely not going to hurt you. Like, there's nothing wrong with that whatsoever. You're doing better than you thought you would do at that time, so take that capital and redeploy it somewhere else. I generally like to stick with my 50% of max profit target because I already feel like I'm managing my winners aggressively. My losers are going to be bigger. That is the game that I'm playing, and that is indeed what I'm signing up for, but I want to make sure I'm getting more juice out of the orange on the trades that work. But you could make a really good strategic case for managing the ones that overperform early a little bit earlier. All right, that's the winners, but that's the easy stuff. What about the losers? Well, that is actually a multifactorial thing. And so, just to build in a wee little bit of drama into the Calculated Risk series, you're going to have to stay tuned for a future episode where we will talk about managing losers on a short strangle. And so I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started today, the best ways you can help us are by subscribing to the channel or liking the video. Both of those things really help us out a lot. So let's say you're looking at a stock and it's selling for $500, and you decide, man, I want to sell some premium in here. I want to do a little something to get some decay working for me, so I'm going to sell a strangle. So you sell a 450, 550 strangle, 450 put and a 550 call, and let's just say that you pick up $5 on the strategy. Okay, so that means that your break-even points are 445 on the downside and 555 on the upside. All right, let's say a couple days go by. It's pretty early on in the strategy's life. And all of a sudden, the market moves and the stock moves and it runs all the way up to your break-even point on the upside. And you look at your P&L and you're down money. You look at your P&L and it's red. And you're like, that doesn't make any sense. I thought that was my break-even point. What is going on? That's what I want to unpack here today, and let's dive in. So this type of scenario happens all the time, right? You put on some strategy, you sell some premium, what have you, the market starts moving, it gets close to your break-even point. It happens early in the life of the trade. All of a sudden, you're losing money, and you're not quite sure why. Well, the main reason why that we're going to unpack over the course of the next, 4 to 6 to 19 and a half minutes is that your break-even point, when you look at like a fixed graph or you look at like some P&L diagram, that break-even point, that is at a fixed moment in time. That break-even point is associated with expiration only. The break-even point prior to expiration is a moving target. The break-even point prior to expiration is not necessarily that same point that you see on a graph that's showing your P&L, like you're looking at a long call, you're looking at a short call, you're looking at a long put, you're looking at a short put. When you measure the BEP on those type of graphs, that's all pointing forward to one moment in time, expiration. And so the reason why that break-even point at expiration is not your break-even point today or tomorrow or early on in the trade's life is simply because when you have a stock that moves closer to one of your short strikes, when it starts to test or threaten one of the short strikes on your strangle, the extrinsic value in the options is building up. The extrinsic value in the options is increasing because remember, the at-the-money strikes have the greatest extrinsic value. And so when you sell the strangle, like all is quiet, all is well, everybody's happy, nobody's getting hurt, you have but you have little extrinsic value in the options because they're both out of the money. So the extrinsic value is low on the options because they're both really far away from where the stock is. But if that changes and the stock begins to move, now the extrinsic value begins to build up. Now the extrinsic value begins to increase in those options, and specifically the one option that is being tested. And when you sell a strangle, or really any short premium strategy, but specifically with a strangle, you are neutral, right? You really want time to go by. You really want the calendar to just tick away. And if this happens early in the position's life, where it's only been a couple of days or a week or even a week and a half, and all of a sudden the stock really moves on one side or the other, there hasn't been enough time for the theta to really work down and kind of beat down that extrinsic value that's in the strategy. And now all of a sudden the delta effect of the stock's movement is going to overwhelm the theta that you've built up to that point. So now to really cement this home, let's pop into Tasty Trade and let's take a look. Okay, so I am inside of Tasty Trade. I've got Tesla pulled up here in the trade page, or on the option chain, I should say. If I open up the July options with 45 days to go, let's open this guy up and let's just examine the option chain, because the first thing I want to make sure that we all understand is that extrinsic values increase as you get closer to the at-the-money strike. So for instance, if I look at, you've got Tesla at about 420 right here. If I look at my 420 strike on either side of the market, right, look at the extrinsic value of a 355 put. That's really far away from where the stock is. That's really far out of the money. Well, look at a 370 put. It's a couple dollars more. Look at a 385 put. It's a few dollars more than that. And look at a 395 and a 405 and so on and so forth, all the way up to the at-the-money strike. Do the same thing on the call side. If I'm looking at an out-of-the-money call, I've got a 465, which is as far as I can go here on my screen. My extrinsic value on this 465 call is $13. Well, if I move closer to the strike, closer to the stock with my strike selection, the 455 strike is about $15.80, so about $2.50 more. The 440 strike is over $20, so another $5 essentially gets tacked on to the extrinsic value. And so when it comes to extrinsic value, hopefully you can see it is increasing as you get closer to the at-the-money strike. Now, right now, this is just a static scenario. We're just looking at, one moment in time effectively. The same principle is going to happen if I were to put a trade on and then the stock begins to move to where my strike is getting closer to the at-the-money strike. The same principle is going to apply. The extrinsic value in the strike that I selected on entry is going to increase. Case in point, let's say I sell this 370 put, and it has $7.75 of extrinsic value now. I sell this today, and then let's say tomorrow or the next day or even just a week later, Tesla goes down significantly. So Tesla is dropping. It's 400, it's 390, it's 388, whatever. The extrinsic value in this 370 put, it's not going to be 775 anymore. It's going to be $12 or $15 or $19 or some number above where it was when you put the trade on. Also notice, sticking with Tesla, just to kind of make our work here a bit simpler and cleaner, notice again that the at-the-money strike has the highest extrinsic value. So if I delete everything that's on the screen, you can see my 420 strike on both sides of the market. On the put side, it's $25.50. That is greater than the out-of-the-money puts or the in-the-money puts. On the call side, it's almost $28. That is greater than the in-the-money calls. That is greater than the out-of-the-money calls. Again, the at-the-money strike is going to command the highest extrinsic value. And lastly, I wanted to go ahead and pull up the curve view here just so you can see a visual representation of that short put at the 370 strike that we were referencing earlier. You can see obviously if Tesla rallies, that's going to be good. If Tesla goes down, that's going to be bad. And then here's my break-even point. It's going to effectively be my 370 strike minus my credit collected, so somewhere around 362 or 363. You see that right there. You can see the x-intercept where the graph crosses over the x-axis. Well, again, that point, that break-even point, that's static. That's fixed. That's for the third Friday in July. That is not for a week from today. That is not for tomorrow. That is not even for 2 weeks from today. Because again, the extrinsic value is going to fill up in the options, and it's almost certainly going to lead to at least temporary losses on the position, because when you sell options, you want extrinsic values to go down. If they move higher, that is working against you. Okay, so hopefully everything with break-even points and break-even point losses before expiration clicks a little bit now. Like you understand that, okay, that break-even point, it's one moment in time. It's at expiration. If my stock actually approaches the strike on my position too quickly, I can expect to have losses on that position. That's not an error. You didn't do anything wrong. The markets didn't do anything wrong. That is just the way options are priced because the extrinsic value is working against you. But again, remember, as long as the option finishes out of the money, that's what you want. It can even finish at the money if you like living on the edge. That's also going to be okay because it's moving towards a point where the extrinsic value is going to go away and you're going to be okay. But before that, temporarily, like in the interim, if extrinsic values are moving higher, that is going to work against you, and that is going to cause your break-even point at expiration to not necessarily be the same as your break-even point today, tomorrow, or next week. I hope that helped. I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started, the best ways you can help us are by liking the video and subscribing to the channel. Either one of those things really helps us out a lot. So as premium sellers, theta is the thing that pays the bills. Theta is the thing that we are banking on every single day. But if you've been inside the Tasty ecosystem for any length of time, you've been watching the shows, you've been in the archives, what have you, you may have noticed we actually put a cap on how much theta we want to carry in our portfolios. And you might naturally be wondering, Jim, that doesn't make any sense. Like, why wouldn't I want more theta? If my theta is paying the bills, I want more theta so I can pay more bills. I want to make this easier on myself. So why are we putting a cap on our daily decay? And that's what I want to talk about here today. So let's go. So theta literally gives you the dollar amount of extrinsic value that you can expect to come off of that position or your portfolio, depending on what you're looking at, for the next day, for the next 24-hour period. So if you're looking at a position that has a $10 theta, that's telling you that for that position, you can expect from the simple passage of one additional day, $10 in premium from that position. You can expect the option price to go down by $10. Obviously, as an option seller, I want the price to go down. As an option buyer, I would want the price to go up. But theta is always causing that downward pressure on option prices, causing them to slowly but surely move lower and lower. And similarly, if I was looking at the whole portfolio, maybe my total portfolio theta is 80. That's telling me all the positions I have in my portfolio, whether it's 3 or 30, whatever it might be, those all amount to $80 worth of daily theta for the whole kit and caboodle, for the whole portfolio. That's telling me what the next day is worth. So if it's 80, it's $80. If it's 200, it's $200. If it's 1,250, then it's $1,250 just from the next day passing. Now you might hear that and you might think, man, that sounds incredible. Well, it sounds incredible because it is incredible. It is literally the thing that draws almost every single one of us premium sellers to selling premium in the first place. However, it's been said before, for every gimme, there's a gotcha. And so I've got the passage of time working for me. I've got the calendar going by working in my favor. What is the gotcha? What is the cost? Well, theta is also a measure of risk. That's because to build up any appreciable amounts of theta in your portfolio, you're going to have to expose yourself to some undefined risk strategies. I mean, sure. I mean, I would love it if we could get where we're trying to go just selling vertical spreads. I mean, I would love it if we could get where we're trying to go just selling iron condors. But the reality is to actually hit, meaningful theta numbers and meaningful theta levels in your portfolio that are over maybe 0.1%. That's kind of the minimum boundary that we typically look for. If you're going for 0.2 or 0.3 or 0.4 of 1%, at any point in any set of market conditions, you're going to have to expose yourself to undefined risk strategies. Let me show you exactly what I mean inside of Tasty Trade. So I'm inside of my Tasty Trade platform. I've got Apple pulled up, which is obviously one of the most active, most liquid stocks in the entire world. Let me open up the July cycle with 43 days to go. And let's just compare a defined risk strategy with an undefined risk strategy. So let's just take a simple short put spread and then a short put. So a short put spread, of course, is going to be defined risk, and a short put is going to be undefined risk. So a short put spread in Apple, which is a great strategy. It's a fine strategy. It's a great way to learn how to play the upside. It's a great way to play the upside even if you're an inexperienced trader. It gives you that defined risk, which is not without merit, of course. But look at what happens when I try to build up theta by using a defined risk strategy. So if I sell, let's say I sell a 305, 300 put spread. So if you look at the theta on this strategy, you can see I'm only bringing in about 60 cents of theta, which again, I mean, 60 cents is 60 cents. So it's not completely insignificant. But when I look at, the simple fact of my decay per day, that's 60 actual cents. That's not 60 option cents. That actually means, $60. That's actually 60 actual cents when it comes to the theta that I'm going to collect from this short put spread in Apple. So again, do I have time working for me? I do. Do I have some positive decay in the portfolio in this position? I do. But is it a significant number? It is not. Is it economically significant? I would say no when it comes to this position in isolation. But look at what happens if I delete that. Look at what happens if I turn this into an undefined risk strategy. So let me get rid of my 300 long leg. So now I only have a 305 short put. Now, of course, a lot of things have changed about the position. You now have effectively undefined risk. It's a lot more buying power. Of course, it's not an apples to oranges or apples to apples comparison. It's probably not even an apples to oranges comparison. Maybe like an apple to some kiwi. But if I look at this 305 short put, look at the theta on this guy. Now I'm bringing in over $10 per day. So again, if you've got, let's say you've got a $30,000 portfolio, right? You're trying to get to 0.1%. That's $30 in daily theta per day, right? I would only need 3 of these to get where I'm trying to go when it comes to selling puts, whether it's Apple, Netflix, SPY, IWM, Bank of America, whatever it is, you're going to get where you're trying to go a lot more quickly using undefined risk. But again, it's undefined risk, right? I'm obviously exposed to outlier moves. I'm obviously exposed to potentially some crazy things happening in this stock or in the market. Whereas with defined risk, I don't have to worry about that. With defined risk, I know that my worst case scenario is known on entry. I know it can only get so bad. And similarly, let's look at an iron condor and a short strangle. There's going to be 2 neutral strategies. The iron condor is going to be the defined risk version, and the short strangle is going to be the undefined risk version. So let's say I sell a 295, 290 put spread, and then I sell a 330, 335 call spread. So this is an iron condor. This is a very classic, right around the expected move, only $5 wide. Again, we could talk about narrow iron condors. We could talk about wide iron condors. There's a million different ways that we could go with this. But look at the theta on this iron condor. Now, it's a little bit more than the short put spread, which makes sense because we're selling both sides of the market. So now I've got $2 a day. So now if you're thinking I've got a $30,000 portfolio, it's like, okay, I mean, I could maybe get there with just iron condors, and maybe you could, right? Again, I'm not saying it's impossible, but when it comes to, thinking about getting where you're trying to go with, appreciable amounts of theta, look at what happens when I get rid of my legs on the iron condor, and now I just have a short strangle on. My theta becomes nearly $20 per day. So you can see it's significantly more. You can see I'm able to get where I'm trying to go a lot more quickly. Now, again, you've got much more buying power. You've got infinity signs for maximum loss and things like that. So this is certainly a longer discussion to kind of get into all the elements that are going on here. But again, what are you exposed to now? You are exposed to more risk. Like now I have unlimited risk. I have undefined risk. So I can't get away with just doing as many of these as I want, because if I do that, then I'm going to be way overexposed. My unit risk is going to be way too high. And if I do happen to walk into an outlier, if I do happen to walk into a situation where something crazy does happen in this stock or in the market, then that could put me really in a bad spot and really put me in the alerts. And so this is why when it comes to our daily theta numbers, we like to live somewhere in the range between 0.1% and 0.5%, and we don't just leave it uncapped on the upside. Even as amazing as theta is, we have to do it within reason. So hopefully now it makes a little bit more sense why we have the ranges that we have. Why we don't just leave our theta numbers uncapped and just get as much as we can and just go after as much as we can. Because theta, or anything else in the market for that matter, doesn't exist in a vacuum. Like, it's not just about decay. It's not just about having time working for you. It's also about risk. It's also about how many units am I exposed to. It's also about, how much buying power am I utilizing? I mean, where's my capital allocation? Like, what is my directional risk? I mean, it's obviously a multifactorial puzzle that we're all trying to piece together, day by day. But when it comes to theta, hopefully now it makes a little bit more sense why we cap our theta at 0.5%. And I'll see you guys next time.
What's up, everyone? Mike here with another episode of Options in Action. If you haven't seen this yet, we're basically taking old whiteboard videos, looking at concepts and strategies in real time with the tastytrade platform and giving it kind of a more advanced edge to it. So we've talked about call options, put options, options premium. So far, we're talking about expirations today. So options expirations are pretty self-explanatory. It's when your option either expires out of the money and loses all of its extrinsic value, or it expires in the money and either has intrinsic value or not. So looking at different options expirations, I think is pretty easy in terms of like how I approach it now. I look at different things and I analyze different strategies, but almost always I'm going to the monthly expiration cycles. And there's a reason for that. If we look at the Tasty platform here, we can see that the platform does a really good job of organization in terms of shading different colors. So the darker shades that you're seeing here with the W on the left-hand side is the weekly expiration. We're looking at Salesforce right now. They have earnings after the close. And then the lighter shades have different colors there, and that is for the regular monthly expirations. Another really nice thing if you're trading futures is the futures expirations are super well organized as well. So futures contracts have different contracts that have different prices. So for example, the E-mini S&P 500 M contract, the M6, you can see the last price here, 75.27. All of these options expirations settle into this last price, the M. When you see a new last price here, 75.87, that signifies a new contract for the S&P 500 E-mini futures contract here. So the ESU6. So really great expiration organization here where you can see if you're trading calendar spreads or diagonal spreads within this M contract, they all settle to this contract itself. So 21 days out, you're all going to be trading in this M6 contract, and you can see this listed here on the left side as well. And then on the U contract, we got a bunch of expirations here. But going back to CRM, I think when it comes down to it, almost always I'm trading the monthly
regular monthly expirations, which are the third Friday of every month. And the main reason for that is that's where the liquidity is, right? You have plenty of people trading this, whether it's a retail or institution, doesn't matter. You can see there's plenty of open interest and volume within these expirations here. And if I change this one to volume, you can see thousands of contracts traded today. Salesforce isn't the most widely traded company, but they do have earnings, which is keeping it nice and active today. But one thing I wanted to point out with different expirations is if I'm trading a regular strategy like 30 to 60 day strategy, I'm going to go to the monthly cycle. I wouldn't get hyper fixated on 45 days or 35 days, whatever your trading strategy is. I'd much rather be in a 50-day cycle a little bit further out in time that's a regular monthly versus going to the 36 day. And we can see this here if we just look at the bid-ask spread on the 170 strike. You've got about a 45-cent wide bid-ask spread here, not too great. But when you go to like the July 2nd and you look at the same strike, this is now a $1.20 bid-ask spread. So not only does it get a lot worse in terms of width between the bid and ask spread, which means you don't really know where you can trade this in the middle. It's going to have a hard time getting filled at a fair price here. You only have 12 open contracts and 17 have traded today in this 36-day cycle, where the 170 strike in the 22-day regular monthly contract is a 30-cent, 40-cent wide bid-ask spread. But you've got 10,000 open contracts, 700 traded today. So much more liquid, and you're going to see this across the board. If you're sticking with the regular monthly cycles, you're doing yourself a service in terms of making sure you're sticking with the liquidity of that market and giving yourself a fair chance at a nice mid-price fill if you're getting in and out of trades quickly and easily. The next thing I want to talk about here is the difference in implied volatility versus time value when you break down extrinsic value. So it doesn't matter what you look at. It could be an E-mini futures market. It could be CRM that has earnings today. It could be Apple that doesn't have earnings for a couple months. You're going to see much more implied volatility value in the near-term cycles relative to the back-month cycles. And Salesforce here is a great example. So $14 implied move for earnings, only 2 days to go. All of this extrinsic value that you're looking at here is basically implied volatility extrinsic value, because there's only 2 days left, right? There's no time value associated with this options expiration. After the earnings announcement, all this premium that's far out of the money is going to go to zero. That's not necessarily the case for a 50-day cycle or an 80 cycle or a 114-day cycle. You can see there is, even though the implied volatility is lower in these further dated cycles, you're looking at 51%, 50%. You've got 24 points in July, 30 points of an implied move in August, 36 in September. So I really like that you can see the extrapolated implied range based on the time in the expiration and the implied volatility reading. It really helps you understand that you've got way more implied volatility value in the 2-day cycle relative to July or August. So when I'm strategizing using expirations, and again, this is a heightened example because we have earnings after the close, where if Salesforce did not have earnings, maybe this would only be like a 2 or 3 point implied move relative to 20 in July. But you've got so much implied volatility value here, 146% IV and a 14-point implied move. If I'm strategizing and let's say I'm trying to buy delta further out in time, the further out in time I go, the lower the implied volatility is and the less implied volatility contraction I'm going to be at the mercy of for this earnings announcement. So if you're buying options, I always like to say you get what you pay for. If you're buying options in a near-term cycle, you're buying super high implied volatility value, not great for long-term success. If you are buying further out options that have a lower implied volatility reading and much more time associated with them, much a higher probability of success there, because you've got 2 months, 3 months, 4 months for you to have that directional move if you're trying to have that trade work out in your favor. So buying options, I'm almost always going to be past this 50-day cycle, closer to 80 if I can do it, unless I'm doing, a near-term earnings strategy where I'm selling a 2-day, buying a 9-day, something like that. But earnings trades, that's really the only exception in terms of where I'm not going to a monthly cycle. That's really what I'm getting at here is if I'm selling or trading an option in a weekly cycle, it is almost always because I'm trading earnings. Otherwise, I'm going to June or July or August because that's where the liquidity is. And even if you look at something like Apple, that doesn't have earnings for quite some time, you can see much lower implied volatility across the board, but you still have a heightened implied volatility value in a 22-day versus a 51-day. If we look at the 300 strike put, for example. So the June cycle has 22 days to go. The July cycle has 51 days to go. June has less than half of the time remaining on the expiration cycle, but the option price is not less than half. And that's really where you get to see the heightened implied volatility in the near term relative to the longer term. So again, June at 22 days with a $3 premium here at the 300 strike, and then you go to the 51 day, more than twice the amount of time, it's not twice the amount of premium here. You should be seeing something a little bit more if these implied volatilities were similar or linear, I should say. So again, implied volatility super high in the near term cycles, and then it trails off pretty dramatically as you get further out in time. The further out options expirations are going to have a lot more time-based extrinsic value compared to the near term ones. And I'm always strategizing around that with diagonal spreads, calendar spreads, crab trades, what have you. So yeah, I think really expirations, pretty simple, but I'm almost always sticking with the monthly cycles unless it's a binary event that I'm trading, like an earnings announcement. Those earnings announcements and binary events that might not be earnings announcements are still going to bring more and infuse more liquidity into those near-term weekly cycles. But other than that, I'm sticking with the monthlies, keeping it simple, going where the liquidity is so I have narrow bid-ask spreads and managing the trades from there. Let me know how you're trading these options expirations, though. I really like the organization on the tastytrade platform, especially for futures, because futures options settling to different contracts can be a little confusing unless you're looking at the Tasty platform where you have it nice and organized. But let me know in the comments below. Please like this video, subscribe to Tasty Live, and we'll see you on the next episode of Options in Action.
Welcome to Trading Trends. I'm Ilya Spivak, head of Global Macro here at Tasty Live, joined by a very special guest, Don Duretz, with us. He's the author of the great book, How to Invest in Gold and Silver, a complete guide with a focus on mining stocks, and the publisher of goldstockdata.com. Don, welcome.
Yeah, Ilya, thanks for having me on.
We're watching a situation where the stock market seems kind of decoupled from what everything else is doing. All of the other markets still seem kind of concerned about what's going on with the war in Iran and the price of oil. So we see that's still elevated. We see that gold and silver reacted negatively to that because interest rates went up and bonds sold off. The stock market continues to surge to record highs, seemingly oblivious to all of it. How does that fit into your thinking? And how does that fit into the idea that the thing to be doing as a longer term investment is to be stacking exposure to precious metals?
Well, you know, I've been doing interviews like this for a while now. And as we get closer and closer to my thesis, it just becomes so obvious that I can kind of see where we're going here. It's becoming more and more obvious, if you will. But it's complex to unpack it and explain it in 5 minutes, because this has really been building for 40 years. Mm-hmm. And so I think one of the easiest ways to understand this is just looking historically at what stock markets have done. I mean, if you go back to the 1920s, where you had that big run in the 1920s, followed by a 20-year bear market, pretty much. I mean, just a massive. And then you had the same thing happen, 80s and 90s. You had this massive run, especially the 90s. And then you had the correction in 2000, and it lasted a decade. And now we've had another 15-year run. And what's the outcome going to be? for me, it's very obvious you're going to get a protracted bear market. And nobody seems to be expecting it. But these bull markets, they always end in euphoria, which is exactly what we have. For instance, if you look at the last two, 1929 and 2000, those both ended in euphoria. Everybody, "Oh, this is great, we're all making money," kind of thing. And then boom. And that's exactly what's happening here. And I really feel that this is different than 1929 and 2000. And the reason why it's different is because in both of those eras, in both of those periods, the U.S. was the global leader. The U.S. was basically positioned in had a very strong position. In other words, the U.S. dollar was not at risk at those two periods, not even close to being at risk. And the bond market wasn't fragile. So it was a completely different. This one, we're actually going into a bear market in the top when the U.S. is losing. This is where it gets really complex, and you kind of have to know history. It's losing its position in the world geopolitically. And so when you combine that geopolitical risk with the U.S. economic risk, and the middle class is basically getting rug pulled here through this MMT, modern monetary theory, where we just use debt to expand the economy. Well, guess who's the loser is in that? The middle class is a loser in globalism, and it was the loser in financialization of the economy. And so we're basically building to a head here where the U.S. economy is going to falter. And when it falters, it's going to be worse than 1929, as bad as that was. Because in 1929, we had the ability to get out of it, to climb out of it, to basically everything kind of stayed intact, if you will. This time, we're not getting through this one. I call it the Humpty Dumpty crash. There's going to be no putting this one back together again. Now, the reason why I'm in gold and silver is because gold is the winner here. When everything goes down, you have $250 trillion in assets that are at risk between stocks and bonds. 100 trillion in stocks, 150 trillion in bonds. They're both at risk. Well, if those assets are at risk, where do people move their money to? And gold is the obvious answer. Gold is the winner here. So the gold miners, the silver miners, and silver, they're just along for the ride. That's not the story. The story is gold. The story is the bond market. I want to finish with this, is that we've gotten to a point now where people can't see this, but it's becoming the elephant in the room. So the Fed was supposed to have a dual mandate of price stability and full employment. Well, that's gone. That's out the window. That no longer exists. Even though they say it is, they're lying through their teeth. Because the elephant in the room now, whenever they have a Fed meeting, is how do we ensure that nothing burns to the ground? How do we ensure? So they're basically, the only thing they care about now is stability. It's not about full employment or inflation. They could have solved the inflation problem at 2%. Very easy to solve it. You just don't print any money. Inflation is a monetary event, but they've been printing. They don't care. The reason why is because they realize that what's more important is the stability, right? Literally the stability of the economy. So it's not full employment. That's an assuming assumption that you have stability. So now right now, when Warsh has his meeting, they're not, what I'm about to say, they're going to ignore in the room. They're going to ignore the elephant. The elephant's over there, but they're not going to talk about it. If Warsh was honest with them, but he can't be honest, because if he's honest, then it'll leak, and if it leaks, he'll sound like a complete idiot. So he can't tell the truth. We're in an era where you can't be transparent, because if you're honest and transparent, you get attacked, because people attack what they don't understand. So if Warsh was honest, if he sat down in the room and he go, okay, people, we have a big problem here. we have to make sure, we have to ensure that the stock market doesn't crash, and we have to ensure that the bond market remains stable. And that's his job, literally. That's the elephant, those two issues. We got to ensure that the stock market doesn't crash and the bond market doesn't become fragile. But he can't say it out loud. And so that elephant is just going to keep getting, every meeting that they have is just going to keep getting bigger and bigger and bigger. And at a certain point, somebody in the room is going to go, okay, the stock market's down 5%. What are we going to do here? So it's about clown world because we can't tell the truth. We can't be honest. Somebody yesterday on Twitter, they posted a list of 20 items where nobody's went to jail. There's 20 things and nobody went to jail on all 20 items. And we know that all 20 of them, people are breaking the law. We live in clown world now. And so the Fed has become clown world as well. And again, the only thing that really matters right now is stability in the stock market, stability in the bond market. Everything else is noise. And gold is going to be the eventual winner. We can see where this is going. The Humpty Dumpty crash is coming.
So I want to explore that as a premise. So I think the central kind of idea, if I can parrot it back from the book, is we have this significant threat to the system from debt expansion and monetary easing and declining confidence in fiat currencies, and that what this creates is the architecture for the next big precious metals market, the next precious metals bull market. And the way that you get ready for that is a diversified kind of layered approach to creating exposure that starts with safer assets, and those are your bigger allocations. And in the framework, that's physical gold and silver. And then as you kind of move up the risk curve, there's a certain pyramid type of structure where, let's say, the riskiest might be miners that don't have output yet, discovery companies. And in the middle is sort of big miners, then junior miners, then it goes from there. And sort of the closer you are to companies that are big, stable, and have actual output, the lower the risk. And the further you go out to kind of the deeper you get toward the prospecting side of things, the smaller the allocation and the riskier that space. You've also talked about the sweet spot being somewhere in the middle. So a kind of a mid-tier operator that offers kind of the best balance of risk reward. The first sort of idea I wanted to ask you about is, in this world that you're describing, where you have this kind of hard reset, I think you've described it as a kind of monetary reset. How do you, and you've also stressed exit strategy, sort of knowing where you're going to get out of these things, because as you've described, metals have bull markets and bear markets, and the bear markets are long. So how do you approach, in this kind of a reset world, monetizing these ideas, which is to say, if we get a hard reset, and you've talked about even something like the United States devolving into smaller polities and things like this, do we still have regulated, functional stock markets and the ability to take money and take profits on these ideas if they're in public securities rather than physical metals? Do we need to wait for that, or is the idea to anticipate before that happens and to trade the speculation of that scenario?
Okay, I'll unpack that. There's about 5 questions in there, but I wrote down some notes. So starting with the strategy. So for me, it's a lot like Michael Burry in 2005. he basically saw that the housing market was going to burn to the ground. And he basically said, okay, what strategy am I going to use to maximize my profit? And he basically went after the worst of the worst. And then if you watch The Big Short, he basically went after the best risk reward, and he called it a certainty. And it turned out he was right. And for me, kind of that real high risk reward, that kind of the meat that he went after is what I call a sweet spot. And so you want to ignore kind of the low alpha, which is the top 20 majors, your ETFs, and your royalty plays. Now you're going to get three baggers from those. I use them for diversification. Those are kind of like the base of my pyramid. But that's not where I'm going to make my money. The only reason why I own those is because I don't know when the reset occurs. I don't know if it's going to be in 6 months or everything in 5 years. So I got to have a foundation. So I use those stocks as my foundation, my base, which those have less volatility, but they still have three bagger upside. At least three bagger upside, in my opinion. And then the meat right in the middle, if you will, is undervalued producers and high quality developers. And that's kind of where you want to be. That's where you want to be 60, 70, 80% of your portfolio for me is those really high risk reward stocks. And then the very top is your exploration or options. And I think you can just ignore those. You don't need them. In a bull market, I believe they just go after the real juicy high risk reward, your undervalued producers and your high quality developers. And my portfolio right now is pointing to a seven bagger. When I started doing this, I said my goal is a five bagger. And I'm always conservative, and I'm like Burry. So Burry, I'm sure when he looked at his numbers and he looked at it, he basically, and it turned out, you can project out kind of what you're going to get. One of the question was, when do you leave? Well, for me, I'm not going to climb to the top of the mountain. There's no reason to. So right around a seven bagger, I'll be out. But if it's really juicy, if it's still really frothy, but you have a lot of momentum, maybe I'll stick around for 8, 9, maybe. But I probably won't. I'll probably exit early. But now, Burry, as soon as he basically, once his plane landed, he got out. He didn't wait. And so some people, and I've thought about this, about leaving early, because he left early. As soon as he started making money, he was out. Whereas Mark Baum, he waited another year before he got out. And so some people are going to wait longer than others. I'll be in the middle of those two guys. I won't get out early. I won't get out late. But you don't want to. You do want to be careful. You want to wait. I've told people, when do you begin to exit? This is a key question you didn't ask. When do you begin? You don't begin to exit until it gets frothy. Now, what is froth? Froth is basically your PE ratio. So if you look at the current stock market, we have froth. We have froth up the yin-yang. The Price-Shiller PE is at 42. The all-time high is 44. And so you have froth there. So that's how you can tell. It is the PE ratios. I don't use PE ratios. I use free cash flow multiples. And the free cash flow multiples right now are in single digits for your producers, for both gold and silver, single digits.
I had to rewatch that market measures from this morning, Bodacia. Our raid really distracted me. I was like, get away from me, uncontrollable fire.
I told you, Tasty Grax, you can't plunder with headphones on. Light pillaging, maybe.
Sometimes I'll hide in a gross peat bog in the middle of a raid, just so I don't miss market measures.
I'm only recently comfortable admitting this, but I think I trust market measures more than I trust my savage hell horse, Arbitrageur.
God, I forgot to tell you guys that I slaughtered a horde of conformerons this morning. Did the whole terrifying row of severed heads on pikes as a warning thing, but you never know with those idiots.
Okay, thanks for the heads up.
Ha ha ha! Goblets of hot blood for everyone.
Nice.
Thanks, you guys.
Normally I hate puns, but that one was okay.
of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform. Being able to see graphically where your profit and loss zones are. Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better. In fact, I've never seen anything like it in any corporation in the United States.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
And this is From Theory to Practice. Welcome to the show today. Welcome to the broadcast, man. Welcome to the Thursday edition of what it is that we're trying to do. Welcome to the Taco Thursday edition of what it is that we were trying to do, guys. We did it. We won the U.S.-Iran war for the 13th time, and this guy is over. And by over, of course, I mean it's just getting started. So welcome to the show. I am glad that you are here. If you're watching over on the Tasty Live Network, I would actually bounce on over to YouTube because you can join the conversation and join the discussion, and you can pop into the chat that has recently been opened and communicate with your brethren who are also watching the show. Man, you can celebrate if you're a bull, you can commiserate if you are a bear, but we're all here. We're doing it together. We got to get through this thing together. So drop your questions for me down in the chat because remember, guys, you've got one job today. PTA. You got to pump that algo. So questions, comments, stories, and jokes, drop them all in there. I want to know. The algo is dying to know so we can push this stream out to more folks. So Matt, bring us into the market. Ooh, baby. There you go. EMI S&P's up 90 on the day. You got the risk-free instrument, also known as the NASDAQ Futures Extremely High Risk product, up 662 on the day. You got the Boomers up 764. You got the Russell 2000 up 67 on the day. You got bonds up a full point. You got notes up 16 ticks. Got oil down $2. Got UB40 rallying up a little bit over a point. Got gold up 45 after being down like 45 or 60 or 70 last night. or whatever. We'll take a look at all this stuff in the next couple of minutes. Got British Pounders up, got the Euros up. Volatility futures are really not down that much, only down 80 cents on a day like today. I would have expected it to be down more, but volatility futures are hanging in there with a wee little bit of a bid. And then you got the VIX, the old VIX. You got this guy down 248 on the day, down to 1974. So, hey, guys, it could be worse, man. I mean, it could be worse. I mean, just last week, was it a few days ago, whatever? I mean, the VIX was like 13, 14, no, maybe not 13. Like maybe 14, 15. Let's take a look at this, actually. If I go to a chart of the VIX, it was, what was the low print? Oh, wait. It was 15 and a half. 15.20, I guess, about a week and a half ago. It sure felt like it was a lot lower than that. It felt like 13, 14, but it's like, man, we all got lulled to sleep. And by lulled to sleep, I mean, we were walking around with some pretty soiled underoos most of the time a few weeks ago. And so we got used to that. And then, volatility drops off the table down to 16, 17. And it's like, man, like, don't even get me out of bed. Like, what am I even doing here? Like, wake me up when the VIX climbs back above 20. And so here you go. The VIX is above 20. Well, maybe it's a little bit under 20 now. But that's what happens when the E-mini S&Ps are up a hundo on the day. And so if we look at a little bit of action, let's go ahead and, what do we got? A little daily chart? Okay. Now let's go to, let me see here. If I do, let's just do it. Look at that. Now that is a 5-minute candle. Look at that thing, man. So this morning, right? I mean, E-mini S&Ps were down to, they were 72.63. So we're 100 handles off of that. But even going back like last night, they were lower, I think, right? Yeah, like last night you had them down to, I don't know, 72.32, so about 130 points lower. It wasn't that crazy, I guess. If I thought that it was crazier, it kind of felt like maybe it was crazier. But a similar story for the NASDAQ. I mean, you've got a couple of green 5-minute bars right there, kind of some final boss candles right there. Like that's kind of like, that's like Fire Bowser, man. That's like Bowser's Fury right there. I mean, my son, Eli, he's got a Nintendo Switch, loves to play it, and it's like super fun. Bowser's Fury is one of his favorite games. And Bowser comes to play, man. Like he's not messing around in Bowser's Fury. Like this isn't like 1992 Mario, where it's like I just got to jump over, a couple lakes of fire and get by one of those chain things or whatever, and I beat him. It's like, no. Bowser's Fury, he's coming with like, he's got Natty Light Ice. He's got banana daiquiris. He's got banana natties like ready to go. Like he is 100% like just locked and loaded to take you down. But anyway, those are some pretty serious 5-minute bars right there. And then, last night, the NASDAQ was, same thing. it was down to 28.2. So it's just a quiet 1,000 points off the bottom. Was there ever a doubt? Taco Thursday, again, it's allowed. You can read the Constitution for yourself. Taco Tuesday is obviously your go-to. It's obviously going to be your default setting. But a little Taco Thursday makes some sense. It's when you start getting into like a Taco Friday, like a Taco Wednesday. That doesn't really make sense. If for no other reason, it's just not very feng shui. And so, but Taco Thursday, it's got a nice little jingle to it. And so anyway, there is your market commentary. For us here in the portfolio, obviously we're getting smashed to pieces on the MES trade, which makes sense because it's up 90. And so I'm like, we should have taken this guy off yesterday. Like, again, we should have taken this guy off yesterday. We got the move that we wanted, blah, 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 blah. But again, guys, remember, the rear view mirror is doing quite well for itself, right? The rear view mirror is doing exceptionally well for itself in terms of its ability to know what to do when. In terms of its ability to say, hey, you should probably do X or probably do Y because it kind of knows what's already happened. And so, unfortunately, we can't trade like Biff from Back to the Future. Like, we've got to actually walk into this thing kind of not knowing what's going to happen. Like, we've got to actually walk into this thing with a little bit of uncertainty. And so, because of that, it's like you go into a day like yesterday, really nice move, brought the position back for sure. But yeah, it's, obviously not an amazing day for us, but it's okay. It's all right because we've got, MNQ is doing fine. This is our strangle. We're now a little bit in the money on the call side, but that's fine. We'll just kind of let it cook and come back and check in on this guy, for the coming days and weeks and what have you. The content's not going to write itself, guys, right? We need something to talk about. And so MES and MNQ, there's your commentary on those guys. Amazon up a little bit, short put spread, nothing to talk about there. I do want to talk about Microsoft a little bit though, because this is a broken wing butterfly. You've got Microsoft down $9 today. That's quite surprising. With the NASDAQ up so much today, Microsoft down $9. Wow. Netflix down 80 cents. Wow. Let's look at, if I go to, let me look at the Mag 7. What are the Mag 7 again? So hang on, let's keep track. Don't ruin it for me in the chat. I want to see if I can figure this out myself because I mean it's all imaginary, so I don't normally keep track of it. But Mag 7, Apple, obviously, Amazon, obviously. So Apple up $4, Amazon up $1. Makes sense. Who else? Let me just go down the list. They've all got to be on the default watch list, I would imagine. Google, obviously. You can go Google or Google with an L. It doesn't matter. Google down today. That's very surprising. So we've got 3. And then we've got Meta and Microsoft, right? 4 or 5. Both down. Wow, this is crazy. Netflix is 6. And then is Tesla the 7th horseman there? It's got to be, right? Netflix down, Microsoft down, Meta down. And then you've got Tesla up $11 today. So wow, this is kind of a dispersion day where you have, kind of the index doing one thing and you have the individual components, at least the main drivers of the individual components doing another thing. I mean, what is AMD doing? AMD up $25. Okay, there you go. What is NVIDIA doing? Okay, NVIDIA up $2. Okay, that makes sense. Okay, so there is, there's the drivers of the train right there. And there you go. And so anyway, I'm really surprised that some of the, the leaders, when we think about the NASDAQ, are really kind of some laggards here today. But yeah, okay. So Microsoft down $9. So what are we going to do with our butterfly? Okay, let's talk about this. So we got a 405, 400, 390 butterfly. Now I talked about this recently, in terms of when you think of a butterfly, it's 2 vertical spread. I'm not going to unpack all those because we just did this like I think it was earlier this week, Monday or Tuesday. So you can go back into the archives because your boy needs that watch time. So give those guys a look. But basically, if you pin the short strike, you get maximum value out of both spreads. That's why it's so advantageous to do that. So I'm not going to unpack all that. However, right now, let's remember a broken wing butterfly is the defined risk version of a ratio spread. So, when you do a ratio spread, you would basically just do, let me grab, let's just grab a magenta. Let's mix it up. You guys aren't ready for this. I'm barely ready for this. Let's do a little lavender. Is that some lavender? Maybe some lilac for you guys? I mean, that's something right there. Do a little purple on the screen. So a ratio spread would be a 1x2, right? That's, of course, going to be an undefined risk strategy. If you want the defined risk version of a ratio spread, then you go to a 1x2x1, right? You obviously butterfly it off, but you have the skipped strike in there that's going to allow you to collect a credit. So it kind of has that ratio spread similarity to it when it comes to bringing in some premium on order entry. Okay, think about how we would normally adjust a ratio spread. We would, if we're doing a put ratio spread, just to keep it really, really similar. If I have a put ratio spread on and it's not working, so what does that mean? Not working means the stock is down. The stock is down. It's below my extra short put strike. That's the scenario where I'm going to lose money. I'm not going to lose money if the stock rallies. I'm not going to lose money if the stock sits still. All my risk is to the downside. Now, of course, with ratio spreads and broken wing butterflies and whatever, all your risk is to the downside, but your greater profit potential is also to the downside. So again, lots of flexibility and some added layers of complexity when it comes to a strategy like this. But not working means the stock is down. Okay, if the stock is down, again, I'm still talking about a ratio spread right now. If the stock is down, how am I going to manage that? Well, I'm typically going to look to take out that long put spread, that vertical spread component, that bearish component, when it reaches about, let's say 75 to 80% of its maximum value. So if I had a $5 wide spread in there, I'm looking at $3.75, $4. I'm looking to maybe take it off. I may wait even longer, but it's rare that it would be earlier than that because that is giving me some protection against continued moves lower. And so once I take that guy off the books, all I'm left with is the extra short put. Like all I've got is that extra short put, which is usually fine, but I just want to be thoughtful and strategic with when I take that guy off. Okay. What about the defined risk version of all of this? Well, it's essentially the same from the standpoint of if Microsoft keeps going down or stays down here, I'm going to be looking to take off that long put spread for somewhere near maximum value. Now, because I have, this extra leg in the mix, this extra long leg that's way down there, that's going to kind of slow the process down. That's going to be a little bit of a stick in the mud when it comes to when I'm able to do that. So I may have to either A, wait longer, or B, take it off earlier. So maybe I can't get 75 or 80%. Maybe I'm taking it off at 65 or 70%. That's a little bit low, especially given the fact that, let's not forget, this is defined risk. So even if I'm completely wrong, even if I'm totally wrong on the strategy, my maximum loss is known. It's fixed. As long as I don't go in and jank with the strikes, as long as I don't go in and start fiddling around with, strike widths and, risk parameters and layering in additional tranches and whatever else. Like I know what my maximum loss is. So if I don't do anything at all, I know what my maximum loss is. And on entry, I was okay with that. And so that is a very powerful advantage. And we want to remember that when it comes to, our defined risk strategy. So that's generally how I'm thinking about this. I'm not really going to do anything until I'm able to get, let's say, at least 70% of value out of that long put spread. And of course, if we get to 21 days, we'll deal with that if that happens. But in terms of based on the actual price action, based on how the stock is actually moving today, that's how I'm thinking about it. And that's kind of the, that's the pathway forward through the forest, as I like to say. And so those are my Microsoft thoughts. Starbucks, look at Starbucks, man, up $3. Of course, it's up $3 today. We sold our call yesterday, so it had to be this way. It could not be any other way. This is the only way that it could be. We sold a 105 call, and you can see that we're down about $1 on that call. Now, this is, again, when you have a cover call on and the stock rallies, this is still a good thing for you because look, I'm up $300 on the stock. I'm down $100 on the call. And so I'm in a situation where, I'm still net up a couple $100. So this is still a really positive thing. And so I'm not in a situation where, I need to necessarily do anything or change anything. Like I'm in a really, really good spot. So anyway, when it comes to Starbucks, this is a great day for us. This is a really, really good day for us. And so that is a little bit of Starbucks commentary. And then obviously Snapchat. I'm surprised they're still doing it. They're still out there. They're still a solvent company. And then XLE, we sit tight. That's a strangle. We just let that guy cook. And that's pretty much it. What I want to do today, though, let's do a couple of new trades. And so I think we have, if I'm not mistaken, do we not have Adobe earnings tonight? I think we have Adobe earnings tonight. And I see you guys in the chat, man. Look at you guys. Man, I appreciate you guys. Look at Daniel Perkins in the house. Sam L is here. Too Much Delta is here. Man, Superstar is here. What is up? Yes, Superstar, you are my number one fan. And by number one, I mean you may not be in the top 500, but you're here. And I appreciate you because you are helping our efforts to pump the algo. So thank you there, Superstar. I appreciate you maybe more than most. And so Emmett Morrison, thank you so much for being here. Argent Purr is here. The Preston is here. Man, Daniel Perkins, I think I already said Daniel Perkins. Griffin Jones is here. Sebastian is here. Saturday night in the house. What's going on? Jared Kramer, Rets Media. Man, the core position. You guys are showing up strong, man. You guys are showing up and showing out. All right, let's go into, actually, let's go to Disney first. So I was kind of thinking, let's do a little something in Disney. I was going to do something in Apple. Maybe we'll do that again. Maybe we'll do something tomorrow in Apple. But Apple, well, let me just go to Apple really quick. It's our show, right? We can do what we want. So if I go to Apple and it's 36 days to go, right? I was thinking about doing something in it because the IV rank is really nice. The IV rank is really nice, 42. I can do something in the July cycle before earnings. It's like everything's kind of checking out. I'm checking a bunch of boxes. But I really wanted to take advantage of the volatility spike with some undefined risk. Like I really wanted to take advantage of this with something that was naked so I would have more exposure to volatility contraction, more exposure to positive theta. But Apple, of course, $300 stock, it's going to be more challenging for me to fit this into my account size. Working with approximately 35,000. It's like, okay, I want to keep the buying power probably under 3,000, probably more like 27, 2,800 on the top end. So if I go in here and I sell like a 30 delta put, you look at the buying power, that's almost $5,000, right? So I look at this buying power, that's pretty significant when it comes to, what I have to set aside to hold this position. And it's like, all right, that's probably going to be a little bit too big for my portfolio. Now, of course, one thing you can do when you're in a situation like this is you can move the put strike further out of the money. So if I move the put strike, further out of the money, like if I were to move it all the way down to like the 275, you're going to see my buying power is going to go down by essentially the amount of out of the moneyness that I gained on the position. And so I go from 285 to 275. I gained essentially $10 worth of out of the moneyness because that's additional buffer. That's less risk in the trade. Because remember, when you sell an out of the money option, your risk doesn't really kick in until the option's in the money. So the further you move the strike away from the at the money marker, the higher the likelihood that it's not going to go in the money. The higher the likelihood that's not going to get to that point. And so that obviously means there's less risk in the strategy. So oftentimes when you're selecting your strikes and you're moving things around, you'll notice if you move the strike by $1, your buying power, changes by $100. If you move the strike by $5, your buying power changes by $500. If you move it by $10, it changes by $1,000. And so you're going to see that relationship by and large all the time when it comes to undefined risk, because again, where you select and where you situate your strike has a direct relationship with the amount of risk that you have on the position. And so I kind of wanted to bring this up because even though it is a little bit too big for my account, I felt like we could still learn some things and kind of grab a couple of teachable moments from this guy before we kind of just put it out to pasture. So Apple, we're not going to do that, but let's go back to Disney. If I go back to Disney, let's see here. If I go to Disney and I go to July, you got Disney at $100. I could be in a situation where sell like an expected move strangle. So maybe I sell, the 95 strike put, I sell the 105 strike call. And everything about this trade checks out. The IV rank is not my absolute favorite. It could be a little bit higher. And so it's like, all right, if we're being really ticky-tack, it's like, okay, Jim, that's a little bit too low. I'm not going to fight you on that. I'm not going to fight you on that at all. But the probability looks pretty good, 61%. The P50 looks pretty good, 78%. Your delta is pretty neutral. Your theta is, $7. Your maximum profit is $255, right? That's obviously going to be my total contract profit. The credit that I collect on entry is a per share profit. And so my total contract profit is $256. My per share profit is $256, but it's per share. Total contract is $256. My buying power effect is $1,500. So now we're talking about, this is like 4% of the account. Right. And so that's not too bad when you think of a position sizing, range that we typically, like to live between 3 to 7%. It's like, all right, we're kind of hugging the lower end of that range right there. So that's pretty nice. Maximum loss, of course, is negative infinity, which if you are brand new to the show, that is literally negative infinity. And if you are brand new to the show, welcome aboard. You're thinking, Jim, you are crazy, man. Like, why are you doing something that literally has an infinite possible loss associated with it? Like, that's what that means. That means that it is theoretically possible that we reach a state in this position where we are in a position of never not losing money. We are actually in a state of being where we are always continuously losing money. There is never a moment where we are not losing money. That is what infinity means. And so in order for us to achieve a negatively infinite loss, what would Disney have to print? It would have to print positive infinity. Now, look, I've been to Disney. It's pretty fun. Like, I've been to Disney, and they got a good thing going down there. But is it enough to get an infinitely large stock price? I'm going to say no, but you have to draw your own conclusions when it comes to that. So I don't necessarily deem the practical risk in this position to be infinitely large, but you have to understand theoretically it is infinitely large. And so if I go into Disney here, though, yeah, let's ship it, man. We'll do a little strangle. There you go. Got filled at 255. There you go. Perfect. All right, let's go to Adobe now. So now we go to Adobe, ADBE. I think it's tonight, right? Adobe's tonight. Yeah, June 11th. We go in here. Oh man, this is great. Guys. I see you guys, man, in the chat. You guys are doing it. Joel James just showed up. Grumpy Mike is here. And I appreciate you guys so very much. And so, you guys are funny. And so, did a calculated risk today. You'll know when you see the striped shirt. I think they're airing them the same day now. So I don't know. They might have your boy in the primetime slot. I might be in the infomercial slot. Like, I don't even know. I can't keep track. But I actually did a calculated risk about expecting move butterflies, it was kind of weird because I wanted to do it. I was like, all right, I'm kind of in the mood to talk about expecting move butterflies. Like, let's do it. Let's set it up, whatever. But then I realized, like, halfway through the video, I'm like, this is not the perfect time to do an expected move butterfly because there aren't really that many earnings. And you guys will, watch the video. You'll see, like, I was like, there's not really any earnings. I didn't even really see Adobe. I think I mentioned it briefly, but I didn't really come back to it because I was kind of thinking about, like, the main heavy hitters, like your Googles and your Teslas and NVIDIAs and AMDs, blah, 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 blah. And so I probably should have went with Adobe. I ended up going with Google, and I just said, let's just imagine that Google has earnings tonight. So we kind of had to play with our imagination here on the calculated risk today, but definitely still give that guy a watch tonight because your boy is desperate for that watch time, man. Like, absolutely desperate for it. And so if I go to Adobe, we use the one-day cycle. Again, I'm not going to really try to reinvent the wheel. Adobe down $10 with the NASDAQ ripping. I mean, I see a recovery, man. I see a rebound coming tonight. I mean, can you guys see it? It's pretty clear to me. I mean, if I do a $20 wide expected move butterfly, let's take a look at this. Yeah, it's $4, man. It's $4. And we've got the Thursday going into Friday. So we're talking about 1% of the 1% of the account. Like we're talking about just over 1% of the account, right? And so it's like, all right, even if this doesn't work, which from time to time we miss a trade from theory to practice, it doesn't happen that often, maybe 4 out of 5 days in a given week. And so if you look at the 225.5, the 242.5, the 262.5, I mean, I really like the way this trade sets up. I really like the way this trade sets up a lot. It's super wide with the strike selection, as I talked about on the calculated risk today. And as you guys know, if you've been following my show for any length of time, the wider you go with your strike selection, I mean, the better it's going to be for you. The easier it's going to be for you to make money. The easier it's going to be for you to, kind of glean profits out of that strategy. And so, I definitely prefer the wider over the more narrow because I feel like it does give you, a lot more flexibility. So I kind of think we ship it. I mean, are we missing anything? I don't think so. I think it's shippable, right? 222.5, 242.5, 262.5. I think that's it. We try 405. We'll give it a shot. See what happens. Wow, we got filled right away. Got some good markets today. Get everything trading like water, man. We got filled on Disney right away. We got filled on Adobe right away. And so, nice, very nice. Okay, so we're playing Adobe to the upside. If you can't beat them, you join them. And then Disney's just a straight strangle play. And so we've got the portfolio getting populated again, which is good. We got a few more positions to talk about, which is good. And I think that's good. Let's get to you guys. And let's see what let's see where you guys are at. And so let's see. Shawshank, I see Shawshank at the end, says, does Fade Dr. J strategy work for Adobe? Let me tell you something about the Fade Dr. J strategy. It works for every stock. And it works across every sector. Like it is not necessarily married to one sector and not married to another sector. It is very much, polygamous in nature, right? I mean, it's tech, it's industrials, it's energy, it's whatever it needs to be. And so don't worry about, the Fade Dr. J strategy. It is safer than a UST bill with better returns, right? And so I have played Adobe very clearly to the downside. I'm not sure I can do any more for you guys. Like I'm trying, I'm searching. I'm trying to figure it out, but I'm pretty sure I'm maxed out in terms of what I can do for you guys. So anyway, Adobe to the upside. Best of luck. Best of luck to you guys. And so let's see. Where are you guys at? Can I surprise and delay somebody else? Let's see. I'm just trying to scan. We may just go back to. I see you guys talking about the World Cup. Here we go. Griffin Jones. What's going on there, Griffin Jones? I appreciate you. Trade idea. Sell a 12 delta. 45 days to go short put in NQ or ES. Well, I'll do MNQ or MES. I'm not going to shoot a McGavin here. Not live on the show. Stealth projects? You never know. But not here. And so let's see. If I go to MNQ, I've already got, let me see. I'll do MES. Just because we've talked about this a million times before too, but the markets in MNQ are they're pretty craptacular, man. It's very hard to get decent fills. It's very hard to get, fair pricing in there in those markets because they're super wide. And a lot of the time you just can't get a decent fill. You have to give up way too much in discovery to kind of get what you want to get out of the strategy. And so I kind of think it's going to be better to do MES. I don't necessarily, so I like the idea here, right? We're doing 45 days to go. I would probably do, I might do 50 days to go. This is a weekly option, but we're already in the 36-day cycle with our short call that's in the money, of course. I'm kind of thinking, let's go 50 days out. Just give us a wee little bit more of time, a wee little bit more time, I meant to say. And I'm kind of thinking, I don't want to do 12 delta. That's a little bit low for my liking, Griffin. And now again, if you really like something that's more conservative, I don't think it's too low. I think the 5 deltas and the 6 deltas and the 8 deltas, that's too low because you're not getting compensated. Now, again, it may feel like free money. It may feel like the paycheck trade. It may feel like selling options for income. Like I've heard it all. It's all rigmarole. It's all garbage, right? But it is a high probability trade. What is the gotcha when you're selling super low delta? Well, the gotcha is, your VAMA is super high at those levels. And VAMA, again, that is how Vega itself accelerates. And so that's why if you sell a 3 delta put or a 5 delta put and the market actually starts to head lower, it doesn't even have to get anywhere near your strike. You're going to start racking up losses really quickly because you're getting hit on the delta effect, you're getting hit on the Vega effect, and you're getting hit again on the VAMA effect. which is how Vega itself is accelerating. So it's kind of like how Delta has Gamma, Vega has Vama, right? And so I don't really like to sell those low Delta options because I feel like, it's not even nickels in front of the steamroller. Like you're getting pennies and they're not even American pennies. You're getting Canadian pennies in front of the steamroller. And so I'm like, I don't know, man. I don't really think I want to do this. And so 12 Delta would be fine, but I think I'm going to bring it in just a titch. Let's do, I'll do like a more standard 16 Delta. So what if I sold like a 68.75 and then I do like, we do like a 7,800. I mean, that's $90. The buying power is great. It's only $1,200, which is awesome. Your buying power is 90 points. Well, not $90, 90 points. And, everything there looks good. The probability of profit is 67%. And, everything there just checks out. Everything looks really, really good. I like the strategy. The IB rank is still super high, still over 50. And so this is a really, really good opportunity. Again, I talked about futures options on the skinny, the daily skinny on options, abstract applications. We did this just yesterday, talking about futures options and the buying power relief that you can get with those. It's really, really advantageous, especially if you're in an IRA. Like if you're trading in an IRA, which I'm going to say, just based on all the conversations I've had with you guys, which have been many over the years, I'm going to say 20 to 25% of you are trading in an IRA right now. I would say 1 out of every 4, 1 out of every 5 is actively trading in an IRA right now. And from firsthand experience, that has a whole different slew of problems and sticks in the mud and like different things that just make it really challenging. One of which is you don't get any margin relief when you sell a naked strategy, in like the equity option. So if I sell a put in SPY, I'm margined all the way down to 0. If I sell a put in Apple, I'm margined all the way down to 0. You can sell naked calls, which is great, but still the margin you're going to have to fork over for that is astronomical. And so what do we typically do? Well, you can buy a super, cheap, like junky out of the money option to limit that buying power, definitely. And that makes a ton of sense to go ahead and do that. But it's like, man, if you go to the futures options, which this doesn't make any sense at all. So if anybody knows somebody who knows somebody who knows somebody who like lives next to one of the regulators, like let them know this doesn't make any sense. Like, why am I able to sell a naked put in MES in an IRA and get a ton of margin relief, but I can't go in and sell a put in SPY? I can't go in and sell a put in XSP. Like, it just doesn't make any sense. And so, it's very similar to the PDT thing, but thankfully that's, long gone now. We should scalp like some Micron on the show or something. Like now that that's gone, we should just, go in for a couple shares of Micron. Maybe we'll do that like tomorrow or next week or something. That'd be kind of fun. But anyway, for MES, the buying power is great. And especially if you're in an IRA, you're going to see for yourself, it's a ton of relief, which is really, really awesome. So let's go in at like 89.50. And then that can be that. All right, let's do 88.75. Man, liquidity in MES is not that great. I'm really surprised that we have to chase it down so much. But sometimes it just happens. Wow, 88.25. Nobody. That's weird. Okay, we got filled. That's weird though. Still, even having to do it a couple times there, I'm a little bit surprised because Adobe mid-price, no problem. Disney mid-price, no problem. And then MES mid-price problem, that's kind of surprising. But again, markets move and things change. And so, all right, let's go ahead and let me see. Where are we at? Let's go to the beginning. My beginning peeps, man. Y'all been here since the beginning of the show. And I'm finally getting to you, man. That's my fault and that's my failing. I'm going to try to get better as we continue to grow and challenge ourselves and all those things. Ashvin is in the house. What is going on there, Ashvin? I appreciate you, my friend. Thank you so much for being here, being part of the show. And you are smack dab in the center of the core position. And so thank you so much there, my friend. I appreciate you. Point B is here. Wow, that reversal on the spoos was something crazy. It has to be Dr. J's Midas touch. I have the inverse Midas touch. So I'm not sure what that would be. Would that be like a Meineken touch? Would that be like is it Meineken? I was like, is it Meineken or Heineken? I was like, those are very, very different. But I think I have that, whatever that is. I've got that. And so Sebastian is here. What is going on there, Sebastian? Appreciate you. Danish Dynamite is here. Nothing better on this Taco Thursday than spending a little time with the best doctor in Tasty. Let's go. Yes, that's correct. And by best doctor, you mean the only doctor. That is correct. And so I think I might be. Well, there's probably, some PhDs on like the dev team and stuff that I don't necessarily know or haven't met or whatever. But in terms of like the network, yes, but that's because I'm the only one. And so Let's see. Griffin Jones is here. Point B. Doc, I have a strangle. Here we go. 130, 190. What should I do to the delta adjustments? Should it be when the buying power is breached? If yes, do I roll it or move the strikes within the same day? Great question. Great question. So here's how you think about this, in my humble opinion. So if the stock stays between your strikes, I wouldn't do anything. Stock stays between your strikes, do nothing. Just sit tight, go live your life. The strategy is working. Even if you're showing a negative P&L because of the delta moves, you're fine. And by fine, I mean, I'd keep at least one eye on that guy. But if it is still between your strikes, then that's actually good for you, right? Because remember, if you fast forward all the way to expiration, if it expires out of the money, then you're going to get whatever profit target you want. And so that's why I really like the do nothing strategy if it is between your strikes. Okay. If it hits one of your strikes, that's the first time when I think, okay, maybe now I potentially roll the untested side. So if the stock has gone down, you roll the call down. If the stock has gone up, you roll the put up. So you're kind of following the stock with the side of the strategy that is quote unquote, you're a winner. The strike being tested is not a bad time to do it. If you want to be really prudent with doing it, you want to be really aggressive with management, you want to, keep your directional bias under wraps and under control, then that would be the time to do it. I like to be a bit more patient, but that's more of just a styling thing. I don't know that it's necessarily better or worse. I mean, I like my strategy a little bit better. Otherwise, it wouldn't be my strategy. But if you want to adjust when the strike is hit, that's fine. The next marker, though, which is what you referenced there in the question stem, is the break-even point. So when the break-even point is touched, like that is also when you could consider rolling, the opposite side, the untested side. Now, how far do you roll it in? Well, I mean, typically look to control or cut direction by 30 or 50%. Like, I think that's a reasonable area. I typically like to cut it by about 30%. I'm a little bit less aggressive with directional cutting because I want to be positioned for if the stock does come back. I don't want to get whipsawed so quickly. I mean, we all get whipsawed from time to time. That's part of trading. That's what we're signing up for. I got it. But what can I do to potentially kind of get the best of both worlds? Like, I get some type of economically significant appreciable credit out of the roll by rolling in by, 30% on my directional cut with delta. But I don't roll so much that if the market does come back, now I'm in the hurt locker on the other side. And it's like, okay, that's kind of a tricky spot to be in. We've all been there. I've been there many times myself here on this very show. And so that's what I would do. I would roll the untested side on the break-even point. Now, as far as staying in the same cycle relative to, rolling out to the next cycle, I would use the time in the cycle to be your guide there. Like, I would use, if you still have, like right now, July with 36 days to go, still has plenty of time in my opinion. So right now, July with 36 days to go, plenty of time to go. And so I would just, if you're in that cycle, I would stay in that cycle. Once you get under 30, you start getting close to 20, then this is where, I would probably, consider rolling out to the next cycle. And so that's how I would think about the timing mechanism of it all. And that's what I would do. And so hopefully that helps a little bit. But Orgdenu's in the house. What's going on there, Orgdenu? I appreciate you, my friend. Hello, Dr. Jim. Why do you prefer to open a put position to correct the delta on your naked call like I did in MNQ? Isn't it better to roll up the call so you give the strategy a better chance to even with a little bit of a loss? Yeah, so I could roll up the call to make it more out of the money, right? And I would pay a debit to do that. It's not typically the preferred approach. Generally speaking, I don't usually like to fiddle around with the side that's being quote unquote tested or like the main driver of the strategy. And so like when I think about, like, for instance, if you have on like a poor man's covered call or a poor man's covered put, which is sort of like what I had on when we sold the put against that short call. It was kind of like a covered put, whether, it's a covered put with stock or it's a poor man's covered put with a long option. It was kind of like that other than the fact that we had the short call. So the delta was dynamic. And so it's obviously working against us now that the MNQ is down so much and we weren't really able to benefit from that down move. Now, again, on a day like today, it's helping us because the NASDAQ is up so much. But when it comes to that type of setup, I typically like to leave that main driver portion of the strategy alone. I don't typically like to move that around or kind of, fiddle with that guy. Whether it's the shares, whether it's the long put, or in this case, the short call, I'm going to leave that guy to kind of just sit tight and stay put. Then I'm going to potentially add the other side to kind of play for, a bit of the back and forth nature of the marketplace. And so when the market is going down, that's a good time to sell puts, in my opinion, whether it's against something else or it's just a standalone position, like that is a good time to sell puts. And so that's how I think about that. Hopefully that helps you a little bit. And so BBB Fine is here. What is going on there, BBB Fine? Argent 86 tackles every time the AI bubble wobbles. It's almost like that is the focus. I can't disagree with that at all. Sam L. Doc, your intern forgot to trade or Nemesis Oracle earnings. Wow, was that last night? Really? Down $19, maybe so. Hang on. Did they have? I mean, that's got to be it, right? I mean, there it is. Like, there it is. There's your gap. Don't even need a bloop. Don't even need to go to the bloop analysis. It's not necessary, right? It's very obvious what's going on here. And by that, I mean, it's pretty close to 50-50. And so if you look at, this gap right here, I would assume they had earnings last night. I don't know. I mean, I guess it would still be in the overview tab, probably. Oh, it's gone already. I scrubbed it out of existence. How about that? And so, all right. And so Oracle, yeah, I mean, they had earnings last night, down a bunch. It's so crazy, man. Like, again, can we look at a daily of Oracle? No, let's look at like a weekly. Hold on. If I go back a couple of years, look at that. Look at that. I mean, look at that. That is some nasty business, man. That is some nasty, nasty business. Like, Oracle went from 130, right, at the beginning part of 2025, up to 360, like before the end of the year, before the end of 2025. That's almost a 200% move. And we're not talking about some small biotech company in Silicon Valley nobody's ever heard of. Like, we're talking about Oracle, right? I mean, I think, aren't they in the Dow? Like, I think like they're one of the Dow components, Oracle. That's crazy, man. And so now it has basically round tripped itself all the way back down to essentially, I mean, it's come back a little bit now, but, just a few weeks ago, back in the beginning of the year, back in March, I guess, maybe a couple months ago, you had it back down around 140. That's crazy stuff, man. That's crazy stuff. Markets moving, things change, man. That is so, so true. And so, Clean Tigers is here. What's going on there? Clean Tigers, appreciate you. BBB Fine, earnings, RH and Adobe. So we did Adobe. I'm not going to mess with RH because I've only got a few minutes to go on. I'm going to see where a few more of you guys are at. Daniel Perkins is here. Dr. Jim, we've had some pretty big VIX readings recently. Has anyone double checked with? You got me. You got me on that one. I wasn't ready for that. Has anyone double checked with VIX HQ to see if those are real or not? I don't think so. But if you just go to, I think their Twitter handle is @VixTheFix. So if you go to @VixTheFix, then you will see whether or not we're able to count this print. Because again, like this print, can't count it. This print, can't count it. Right? So this one or this one, I think they're probably going to allow it. But again, don't take my word for it. Just go to @VixTheFix. And there you go. And so, yeah, good job there. Good job there, Daniel Perkins. Let's see. Nothing like one of your contacts coming loose while you're on air. So that's kind of fun. And so let's see. Sam L, more importantly, have you ever told us how you chose your kids' names? No, I don't think I have. We got a couple extra seconds. And so I got Penelope, my oldest, got Eli, Elijah, who's my middle, and then Amelia May, who's our youngest. So here's what's kind of interesting. So when Autumn and I, I'll share we don't have much time, so I'll just share the story about Penelope because it's kind of fun. So when Autumn and I were, when she was pregnant with Penelope, I really wanted to not know what we were having. Like, I don't ask for much in the marriage. And by that, I mean, I'm quite demanding actually. But I was really kind of adamant about this. I was like, hey, I really want to, I really want to not know, like, let's be a surprise. It's going to be so much fun, whatever. So we didn't know. It was awesome. So we're getting closer and closer and closer to having the baby. And we were super nervous because we had the girl name picked out. Like, we were dead set. Penelope, we loved it, like loved everything about it. But if it was going to be a boy, we did not know what we were going to name it. And so the leader in the clubhouse at the time was Solomon, because I thought it was a cool name. I was like, I want to have a son. I'll call him Solo. It's going to be amazing. It's got biblical roots. I'm like, I love that. And so we were like, all right, it's a great name, but we didn't really love it. Like in the moment, like, like sometimes you love it, you don't love it, whatever. So like we're in the waiting room, or not the waiting room, but we're in the actual, like, she's having the baby. And, I was kind of focused on her a little bit, but I was also like a little nervous. I'm like, I want a son, like really bad, but I don't know what I'm going to name him. Like, I think I'm going to buckle under the pressure and just call him like Brian or something, which Brian is an amazing name, but I'm just saying, like, it wasn't even on our radar, right? I'm going to be signing that birth certificate like Todd or something, which again, Todds, you guys are all amazing, but it just wasn't even on our radar. And so thankfully, the Lord blessed us with a young little Penelope Grace, and that was amazing. And then by the time we had Eli, we were like, yeah, no Solomon. We're going to do something else. But anyway, I digress. And so, but thank you there, Samuel. Point B, I see you in the house. Arjun Purr, you're here. Jared Kramer, what is up? Yeah, I don't know what happened at lunch, man. I have no idea. Clean Tigers, fake escalation this morning and fake de-escalation this afternoon. I can't disagree with that. At all. And then I see you guys, man. iPod Touch is here. What is up, man? iPod Touch, you told me you were coming back, man. I thank you so much for popping in. I understand your email. I understand it totally, man. But I appreciate you so much. So thank you for being here and being part of the crew. I appreciate you, man. And so iPod Touch is here. And so let us know, iPod Touch. We need your guidance. Even though my show is done, let us know. It looks like we may have tacoed the actual taco because we're going even higher. But I have to go. I got to run. If I can ever help you guys in any way, please shoot me an email. I'm jschultz@tastylive.com. Or we can connect on Twitter. I'm at jschultzf3. I would love to connect with you guys on there as well. But stay tuned. We do have Tim Knight coming up next with Trading the Charts. In the meantime, guys, trade them small, trade them heavy, and stay generous. We'll see you guys tomorrow.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day.
Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Hey, Tim Knight here. Well, I told you this would be an interesting week. A couple of big things going on. What is going on tomorrow, of course, is the big IPO. So we have about 44 minutes left to live in a world in which there's no ticker symbol called SPCX. So that's going to be big tomorrow. And tomorrow is going to be a day that we are all going to have to really be on our toes. Whether you're into SpaceX or not. I've requested my allocation. We'll find out, all of us will find out tonight sometime, like, okay, well, you're going to get this much if you want it. And I think we get like some short amount of time to say, okay, I'll take X amount. So that's looming. And good luck to anybody out there who's going to join me into the SpaceX IPO. And more immediate and unexpected, unscheduled, there, of course, was the surprise news about an hour ago that, we've got a peace deal. and the market exploded higher. This is not the first time a peace deal has been announced, but it's very odd to me because here, if on this program, when I started, and I said, "Hey, everybody, I'm in a generous mood. Email me your name and address, and I'll send you $500 in cash. I want to share the wealth." A lot of you would write me, and time would go by, and you would never get your money. And I would maybe a month later say the same thing again, and people would write me, but not as many. And another month I'd do the same. Another month I'd do the same. And after a certain amount of time, not only would people not email me their address, they would be angry and think I'm psychotic because I state something and it just doesn't happen. And I'm kind of wondering why the market keeps gobbling this up, because every time peace is announced, everything explodes higher. And it's always like, well, we'll be having a signing ceremony real soon now. Hasn't happened yet. I want it to happen because I'm so tired of this. I've said it so many times. The most embarrassing thing that could happen would be to sign a peace deal so we could get this game behind us. But we're still very much in the game. And personally, I think this is a bull trap happening before our eyes right now. And I'm treating it as such. But I'll be both bull and bear tomorrow because I'm hoping SpaceX has a terrific debut, and I hope to be a part of that. So let's get into the charts here on this rather odd day of ours. We're going to start with crude oil, which we never do, but it's down, not surprisingly. It's down 3.25%, down to 87. I'm quite worried also if people complain about $4 gas out here in the San Francisco Bay Area. It's about $6 or $7 for all kinds of government reasons. But it has come down a lot since the $120 type levels we were seeing. But the reaction obviously was very, very bearish for crude when the news hit. And then oil-related companies naturally are also falling. Here's XOP down 1.71%. Although all it's doing is working its way down towards support, which has been in place since April. It hits here and hits here and hits here and hits here. I guess at some point that'll break. It's quite cyclic, it seems. I mean, I imagine each of these instances is yet another peace deal was announced. So this is kind of the fourth big move down since we began this craziness. And the ES is up triple digits. And percentage-wise, it's weak. It's 1.52%. The NQ, the RTY are both up about 2.5%, about almost 3%. A very big day. But this is what I'm talking about with the bull trap. I've been pointing out the failed trend line. And this morning, if you joined us early, I was talking about the retrace pushing up against overhead supply. And so what's been happening here, and so here we are on Thursday. On Tuesday, on the ES, we got as low as this level. On Wednesday, we got as low as this level. And today, we got as low as this level. We're very range-bound now. Bang, bang, bang. And today and yesterday, we've been confined to this low here. And then on the high side, this blob of overhead supply. So we'll see if that holds or not. I mean, if it just like traipses right through, then, oh well. But at the moment, that's the real test that's going on. I have given up on one particular trade, and I did so very shortly after that news, which is old TLT. This is the bond trade. It'll probably still work out, I guess, but there's sort of a couple things that bother me about it. One, the chart's a mess. I mean, this chart for months this is just a stinking mess right here. And there's so many pretty charts out there that are easy to interpret than this, but this is just UGLY. It ain't got no alibi. The other thing is that today notwithstanding, it tends to move really slowly. And I just had enough. So I dumped my November TLT puts, took about like an 8% loss on that, and I'm done with it. So I had called it my anchor trade before, but no longer. I'm out of TLT. Over in Diamond Land, and this is another good example of what I think is this bull trap transpiring. This is a beautiful setup vis-a-vis that trend line. We fell hard yesterday. We closed right near the low. We opened strong today. We are rallying hard right now. We're up about 1.8%. Look where we're at right now. We are getting very close to the underbelly of that broken trend line. And I believe that I'm patterns are my life. I'm all about patterns. And the pattern that I've seen with this administration and these announcements is, and this is like the third time we've gone through this, but is 3 for 3, that when the rhetoric gets really boisterous, like they have had it, we're going to, whether it's like we're going to end their civilization, or we're going to bomb them back in the Stone Age, or you'll see things that people have never seen before, whatever bluster's going on, when that's really cranked up to 11, like tonight is the night, God help them all, that's when it's like, he's not going to do it now. It controls Z, that whole thought. Every time when it's really like, we're going to get, this is it, I've had enough, this is it, that's when it's not it. It's like, hey, you know what? We've actually signed a peace deal. And so that's what's happened this time. And like I say, people keep buying it. And I think an important reason that because of the timing was SpaceX. Because it's like, well, all right, here's the situation. Eat a bomb tonight, okay? Well, that's going to really kill the market. The richest man in the world and a close ally of yours is going to be none too pleased that his big debut has been marred by what could be an ugly day in the market. How about just pause this for a while? Just put it off. And I think that's what happened. So tomorrow is a huge day, biggest IPO in history. And no one wants to spoil the party for Elon. And it's like, all right, let's just put this on ice for a little bit. And that's what's happening. So we've got this big rally going on here, but this is a broken market right here. This is a broken pattern. And the closer it gets to this trend line without pushing past it, the more appealing I think it gets for a bearish position. So, into that speech. Here's EFA, which peaked way back here. And we're making a big lunge right here, but we have not even matched that prior price level. I came into the kind of lightish, like 90% committed, and I was wondering, well, is this too light? And I'm actually kind of glad for that, obviously, now, because I think the opportunities now at this moment are better than they were than this morning. And like I say, and I just can't emphasize this enough, tomorrow we're going to have to be on our toes, especially if you're monkeying around with SpaceX. It's going to be a very dynamic day, particularly since, like normally we get a 6.5 hour trading day. It's going to be kind of a 3-hour trading day. Basically, take 6.5 hours and subtract however long SpaceX doesn't trade. Because there'll be indications and chatter and rumors, but it's not going to open until it opens. And it could be deep into the trading day, and that's kind of when the day begins. And the first hour of that will be like unchecked pandemonium. So it's going to be a good week before like the dust is really settled. Here's EEM, the emerging markets. Same deal, folks. Look at that. We are coming up on not only the broken trend line, but also a price gap. That is so beautiful. Look at that. It's just a beautiful setup. In more normal news, remember back in the old days when it was just like earnings and stuff? We do still have that going on. Oracle announced yesterday. If you were watching that on a minute bar basis, that was a roller coaster. They announced, the stock exploded higher, then it collapsed. So we've been trading down on this today. It's down 9%. And obviously it's been a downtrend for a couple of weeks here. But that was our only kind of meaningful earnings report. I took profits on my Meta short. I think long term it's still a good short, but this short's been good to me, and I decided that enough is enough on this one. So I'm out of Meta. It's kind of a messy chart as well. I haven't traded Google like ever, I think, but I'll also mention that this too is sort of sporting the same kind of push up against resistance that market in general is. As far as Precious goes, Precious got some paddles to the chest based on this news. But again, bull trap. Look at this. This is GDX, the miners. Examine that entire block, which goes back to last year of the price activity. And so today we are rallying strong right to the bottom of that pattern. So, I don't think it's like, oh, well, the bear market in precious metals is over. I think this is a one-hit wonder. And so we're getting up to that big rectangle there. Here's gold itself, GLD, which has this beautiful price gap that was formed between Tuesday and Wednesday. And we're getting close to closing that gap. And big old right triangle pattern right there. This does not invalidate any of that. In fact, it affirms it. I might have mentioned in passing my kind of ongoing interest in palladium, but what's keeping me from buying it is the fact that, the charts I just showed you, Precious does not look done falling, and palladium itself has its own major resistance where that horizontal line is. So I'm not touching that. As you might imagine, there is precious little red on my screen right now. There's a few items that even in the face of this massive rally are still behaving themselves. One of them I mentioned a couple of days ago, H&R Block, HRB. This is down over 4%, so I like the way that's going. New one for me is Spotify, SPOT, which itself is down 2.7%. So there's others, but they're so minor in their movements, it's not even worth mentioning. The other big question with SpaceX debut is, what about the other guys? What about the other little rocket companies? What will they do? And I think a week from now, it'll be very clear whether they are coming along for the ride or if they're sort of like being cast away like an old lemon rind. We don't need those anymore. RKLB, Rocket Lab, is up almost 8.5%. Planet Labs is up double digits, up over 10%. Intuitive Machines, LUNR, is up 15.7%. So they're rallying nicely, but up against some pretty big drops they've had. And one last one here, AST Space Mobile, ASTS, up 11%. So a lot of double-digit percentage gainers today in anticipation of the big brother SpaceX coming along. So just to wrap up, SMH, the semiconductors, same deal. Broken trend line, big rally, getting close to that broken trend line. And there's room to roam here. We could still go higher. Could rally tomorrow, but kiss that red trend line, and that could be a very, very sweet opportunity. And then with the NQ, kind of the same idea. And in this instance, I would say Tuesday's high is kind of an important marker in terms of resistance there. So by the time I see you again, we should be able to type SPCX and get a quote for it. And it's going to be a very interesting day. And we'll close the week out with that. So I'll see you then. Bye-bye.
Let's make this quick. I got to get going. I make $4.97 every second that I work, and if I don't clear $145,000 by the end of the day, I'm going to go crazy.
Okay.
It's a cute dress. Where'd you get it?
Oh, thank you. H&M.
$23, 10% off sale.
That's pretty good.
Probably not worth more than $4 now. That's too bad. You got to be aware of these things. Everything has value.
Well, not everything has value.
Everything has value.
I am pretty sure I can name a couple of things that don't have value.
Go ahead, go for it.
Okay, caution.
5 cents.
Feebleness.
That's a sad one. $1.12.
I have a toughie for you.
All right.
What about us?
Me and you?
Yeah, did we have a price?
Yeah. 2 cents. We should have sold that one a long time ago.
2 cents?
Yeah, we could have made a lot of money on that one. Oops.
2 cents?
Yeah,
I wouldn't even pick that up off the street.
Exactly. I think that's more on you than it is on me. Lord knows I'm trying. Hey, you know what, though? There's money to be made everywhere. Take you, for instance. Look at you. You're a young buck. What are you, like 37? I'm joking. How old are you?
I'm 26.
With your genetic makeup, you're not putting on too much weight. I think you could sell those little lady eggs of yours and make quite a profit online. But I wouldn't wait too long. Next month, those would go down big time, especially if you keep eating the way you're eating. I gotta take off. Time is money.
Are you serious?
Yeah. Hey, look, can you get the check on this? I left my wallet in the car. I don't like to carry around bulky things. It slows me down.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Jermal, we are back. It's the final 30 minutes of the trading day, and what a day is unfolding now. S&P 500, 74.14, 135 points, 1.9% higher now on our screen. We've reversed all of the week's losses in basically the blink of an eye. It's been a quick rally here, Jermal. NASDAQ up 3.3% right now, scaling back, crawling back all of those losses that we had from a few days ago. The Russell is up 3% itself. President Trump saves the day again. We're not going to call it a taco around here. But apparently, despite promising to bomb Iran again, bomb Iran, we get a President Trump that says, no, actually, ceasefire is going to be signed next week. Bombing's off. So markets are loving this, Jermal. Volatility's coming in. The VIX, 3-month VIX spread, which earlier this week had flipped into backwardation, is now back into a healthy contango. I suppose that's the good news. Where to begin?
I mean, dude, it's gonna be hard to focus, okay, over the next couple of minutes because there's so many different things going on. I just saw oil. I forgot about oil. It was down to 85 earlier, but I think I want to buy. I want to buy a call spread here. Why not? It's been on and off and on and off again, right? So why not? That's something I was looking at earlier. But I gotta say, for those who watched the show this morning, they know what I was doing when right around the open. I bought a put spread in SPX. Why? Well, it looked like the market was going to be weak once again. It looked like it was going to be up in the morning and then fade once again. Whereas there's been this interesting thing, too, when we've done the show. Right after Tim Knight's segment, who was the biggest bear on our network, the market has faded, and we've noticed it. And so I bought a put spread. Why? Because I actually wanted to lose on it. Did I think I would lose the whole thing and I would make a ton of money by the end of the day? I didn't know. But the other thing I did while we were fading, and we did go to unched at one point in time in the day, we were down like 5 or 10 handles. We got around close, not too close, but not that far from the lows the other day. I bought some calendars, similar to what I did on Tuesday. Chris, dude, I actually don't trade that much near-term stuff. These worked out really, really well. So I bought next Friday, the 18th, or I should say Thursday, actually, to sell the heading into the Fed meeting. And when I tell you these things, absolutely, I mean, I bought
what are your strikes here?
So I bought we'll start with the 7,600. And it's interesting because I bought these the other day and I closed them all out. I did the same thing again and the same thing has happened. I mean, sorry if I sound a little giddy, but these are really fun. 7,600, buying
how many DTE?
June 18.
June 18 AM. You're at SPX?
Yeah. Regular, not AM. And SPX, yes. Okay. 7,600 Junes.
And you bought these calls or sold them?
Bought them. Bought those and sold June 16 calls. I did these for $2.50 this morning.
$2.50. What compelled you to put this on this morning?
Because we got back down towards lows that we did the other day.
And $2.50 is an easy trade. And with the idea that maybe by next week, we would probably have a move like we're having literally in one day today. It's really the idea. That's literally is that simple. I didn't expect it to happen today. This was like something that I was expecting by middle of next week. This was going to be looking good. And I turned $2.50 into $7.50. That's when I closed it. And I did a similar calendar for these 70. And I layered into these because, again, I bought a put spread in the near term, literally a 1-0 DTE put spread. And because thinking we were going to be weak today. But I went out next week and bought the 7600 calendar, the 7550 calendar. I paid $4.50 for that. And then when we dipped a little bit lower, I bought, and I had these orders sitting out. And eventually I paid $6.30. Sorry, no, I paid $6, I think, for the which calendar? No, I guess I just had those two on. So I had the 7600 calendar and the 7550 calendar, both buying the 18th, selling the 16th of June. And I had another calendar that I did the day before, which was the 7500 calendar. That's the one calendar that I held on to from Tuesday's market drop. Was the June 11 versus buying the June 12 calendar. Similar deal. So this was all just trying to calendarize these trades, thinking that the market would eventually slowly bounce back, right? We usually see elevator down and then escalator back up. And in this case, it was really an elevator down, elevator back up.
Oh, you're getting the bounce today and everything, really. It's also the big names here, by the way, that are helping this market out. The Mag 7s are up 1.2% here. Distribution is still apparent, and I think that's worth noting. RSP here, not that we're doing a lot of activity, but RSP, equal weighted S&P, could be looking at a close at an all-time high. If not today, maybe tomorrow. We're just on the doorstep. Beautiful looking chart, by the way, Jermal. One of my favorite looking charts right now. So if you want to be bearish stocks, I need someone to square the circle for me. Left shoulder head, right shoulder, neckline. We just fell back into it. Breakout, pull back to your 1 month. Former resistance, now support, and now we're turning higher. This looks like a little bit of a bull flag down here. So you're getting it in your RSP. You're getting it in your small caps today. The Russell 2000, likewise, up over 3% here. For all of its warts, the market is seeing a big relief valve thanks to oil prices coming in and this latest news. So usually the crap flies first. The companies that are teetering on the edge of bankruptcy, when they get breathing room, their equity becomes worth more than the big guys, of course. So this rally makes sense. You could see almost that there's short covering happening today because this thing is feeding itself right now.
Yeah, it does. I mean, and even in the last couple of minutes here, it looks like the market's just gapping higher. So there's definitely some short covering. You know, how much does the excitement around tomorrow's IPO play into it? I don't know. I mean, but I've had long deltas. I know you have too. And again, it's not really that near term stuff. It's really like these SPX calendars were fairly cheap. I mean, $2.50, $4.50. So it's not like I'm paying a lot of money, but there are other bearish positions that I put on more recently. Robinhood, I put on a bullish position. I'm sorry, I said bearish, but I mean, there are other bullish positions that I put on more recently and further out. That's one that I put on. I sold a put to finance buying 2 upside calls because this is one I feel like if the narrative changes a little bit in general around trading, around markets moving the way they have, around Bitcoin, this is one that's going to bounce purely just, you know, from the sake of the name and what they're connected to. So that's one that I've done more recently. A lot of the NVIDIA's one that I have calendar spreads on. Microsoft is still down, I think, on the day. So it's not like it's every single thing. Software is still struggling. Maybe
what
that's
about
on
Oracle?
the heels of. Yeah, I think that's probably right?
I feel like you got some splaining to do here, Jermal. I followed you into the trenches yesterday in this calendar spread.
In my defense, I said this was probably not going to go well. I did say that. You check the tape. Because, again, as I keep referencing, last week, HPE earnings, while its stock went up, you can look at the big red calendar, and it didn't play out well, right? And then on the heels of that, CrowdStrike and AVGO. So if I had to guess, if there was a tech name coming out with earnings tonight or tomorrow, I'm not playing upside anymore. I don't even into this rally. I don't care because now they've been faded into the rally.
Let's do that. Actually, there is one earnings report that may be of interest to folks, and it's a company. You got to excuse my voice. There was a sporting event last night.
Oh, jeez, here we go. You know what? You guys want amazing fortitude. All De'Aaron Fox had to do was hold the ball. Now, they always say, the one play at the end doesn't determine, even though it did determine your win. Those plays don't determine the win. Those plays just happen. There's a lot of stuff that leads up to that. But how crazy. I mean, amazing. Congrats, man. That's an amazing win. I know that was nuts. I know you went crazy.
I was thinking about it because Charles Barkley was like, this is the dumbest team in the history of civilization, talking about the Spurs. And I was watching, I may have rewatched the game again.
You definitely did.
In the third, the Spurs had 9 possessions in a row where they shot and missed threes.
Yeah, and they went fast.
In today's NBA, if you're going to go dribble down the court and chuck up a three in 4 or 5 seconds and you miss, and the other team is going to run right back down and hit those shots, a 29-point lead closes instantly.
Yeah, they rushed their shots big time. I mean, their youth showed for sure. Their youth is definitely showed in the playoffs. I think you saw it when I tweeted. I tweeted about not only that play, the thing last night, but also something game 2 Wemby. Their youth showed, and give the Knicks credit. They have the fortitude to be able to ride those things out. That's really the edge there.
Just surviving, keeping that powder dry, surviving. Jermal, what's not surviving right now is Adobe. It has earnings today. The market's up 3.5% in tech. It's the best day for semis since the rally began at the end of March. And Adobe is getting kicked in the teeth, down 5%. Ahead of its earnings report, is sitting at a 52-week low. Jermal, what do you even do here? Do you try to catch a falling knife with an 85 IVR? What's the plan?
I mean, I don't know. You know what's interesting? I mean, again, software names, most of them didn't do that great on earnings. CRM was the most recent one, and I think it ended up going, was it bad? I can't remember. One of them surprised me, I thought.
None of them were bad. I mean, even so, one of the issues that we're now running into, it feels like in the past 2 weeks, Alphabet has their offering. We hear from Oracle, of course, they want to issue more debt.
Right.
SoftBank
SMCI.
is trying, right? SMCI last night as well. And so all of a sudden, I mean, listen, that's good corporate governance from a certain perspective. If the market is devouring your shares and you're a CEO and you go, gee, it's like the company's not worth this much. This is out of control. We can't justify this price level. If people really want our shares, we should just do an equity offering, put some more cash on the balance sheets, right? And take advantage of it. And so share prices come off, but it underscores the whole purpose of this conversation. Financing and funding the AI infrastructure build out is becoming more costly, and it's causing perhaps dilution in the stock market for some stocks in particular.
Yeah, and I think that's what we've seen, like you said, in those names. So, this Adobe, man, I don't know. It looks like death. Do I want to play it? I mean, if I were to do anything, it would be calendars, but I don't know if I don't know which direction I would go. I really don't know. Like I said, I can't remember, man. It was it's on the tip of my tongue. One of the software names really surprised on earnings. Do you remember? It was one of the later ones. It wasn't Palantir. I don't think it was CRM actually.
Which is right back down to the lows with basically everything else software here, which has given up all of its gains that we saw at the end of June.
My point is they can surprise you is what I'm trying to get at here. And so, maybe this thing surprises you, but I don't know. Everybody keeps talking about how easy it is for AI to generate images. I mean, I feel like if there's one of them that's really in the square and the crosshairs of AI, it's Adobe. So it's like, why do I really want to play this thing to the upside? I don't know, Chris. What do you think? It was ServiceNow or Now, one of those two, rocketed it on earnings, I think.
We had ServiceNow had a jump here at the end of May, going into June. Snowflake had a pretty decent jump.
Yeah, that one definitely did. Yeah, that was the one that jumped big. It was trading like 190 before earnings. I played it to the downside and then boom, gap. That was the one I was trying to think of. That was the latest one to have earnings that surprisingly went up. Because I feel like Microsoft, CRM, those didn't do that great on earnings. But this one, Snow did. Yeah.
You know what? Maybe there's a different way to crack this. Because I'm looking at Adobe. It's a lot of idiosyncratic risk. I'm not a fan of catching a falling knife. This is just a terrible looking chart. If you're going to do anything here, you're basically looking for some sort of bearish exposure. Now down 5.4%. It was down, 4.9 a little while ago as we get ready halfway to the close here on last call. I'd rather look at IGV with its 96 IVR as opposed to Adobe's 85. it's an interesting chart insofar as we're kind of right back to where the market peaked back in March and April. And it's where maybe we've started to do a turn through the breakdown. And if we're catching ourselves here, it's right at that 50-day moving average. We've slipped through it a little bit. But that's more or less where we're finding our footing here. So in IGV then, I know that it's an options or earnings related play here, and I don't want to do 1 day. But out at 7, just below the current price, going out $1, 88.89, risking 7 to make 3. That's not a terrible idea. 64% probability of profit. Plus, it's an ETF, so we can scale this up a little bit. We can go in five contracts here just for the sake of this. $350 worth of buying power. All right, I'd rather take that swing than do it through Adobe today. Software hasn't had a great session, and that should alarm you when the market's having a historic session. Right?
I gotta say though, just being a little contrarian here, looking at how ugly the chart is, you could put some risk on in Adobe. You could do calendar call spreads. You could do 245, 250, 255. They're under $1. So there is that. And there is something to playing names when there's such bearish sentiment, play them to the upside and vice versa, right?
Do you know what the short interest is in Adobe?
I have no idea. But you know what? I think I'm going to put these on. I think I'm going to put it on.
Find that out here. Short interest ratio.
90 cents. Oh, I wanted 90 cents. That's 93. It's messing around with me.
Not that big. 4.6% of the float is short right now in Adobe. That's not, I would if this was like one of those 25 or 30% names that you see come around every now and again, and you had this big negativity in the sentiment, yada, yada, yada. But hey, that actually reminds me of something that Frank flagged for us today, Jermal, the AAII sentiment survey. Now, I know it's not the best thing in the world. It's like 300 old men sitting in a room responding to a questionnaire. At least that's what Helene Meisler says. She has other preferred surveys. But even within that, knowing that bias, the data can be used and I'll say manipulated in a way to glean information out of it. So one of the ways that I've used it, Jermal, over the years is when we have swings in excess of 15% over a 3-month period. When you go from bearish to bullish or bullish to bearish by that degree, net, it typically marks a top or bottom. What's really fascinating is that may have just occurred in this past week alone. The most recent AAII survey, 30.4% bears, down from 36.3%. That was bulls. 30.4% bulls from 36.3%. Bears, 47.7% from 37%. You got a 16% swing right there in 1 week. And now today, after we get the survey results out for the weekend of June 10th, it's the best day since the market began its move off the lows in March for your semis. The hated, everything is overvalued semiconductors.
I mean, yeah, man, that's kind of what I mean. And even when you look at a single name like Adobe and it's so bearish, maybe it does bounce for that reason. Similar deal. I mean, people turned really bearish fairly quickly here in the market. And I think that's why we're seeing this huge kind of short covering rally to the upside in the last couple of hours here.
So I have a position in SMH here that's on the follow page. It better be lucky than good. The idea here was when it was put on, when we started to break out, that we're going to hold the recent swing level. And if we do, then, we probably shouldn't dip much below 575, 570 or so. Obviously, the best laid plans of my cement often go awry. But Jermal, I'm a Knicks fan. This ain't over until it's over. And so with plenty of time left, I decided to ride through it, diamond hand it, right? Like as someone who's a bit of a knuckle dragger does. But that knuckle dragging, Jermal, that patience here the past few days has been rewarded. There's plenty of time on the board. The whole idea was 45 in, 21 out. Anything can happen during that window, and the market didn't really break down yet. So I feel comfortable holding, but now the question is, do we add in more? Because it's a 97 IVR, and like what we've seen in previous pullbacks, this 1 month moving average is holding this market up right now. Maybe as we're getting ready to work through a bit of a turn here, a bit of a double bottom down here. Jermal, it feels like this is a good time maybe to take a good old look at semis. If we can break through 610 or so, another run up to all-time highs seems like would be technically at least in the cards.
All right, what are you looking to do?
We have the lows to operate around 560. I think that's the place to look. We can go out to 43 days. That's a weekly option, but 560 is the place to look right now. And so 560, 540, it's just 560, 540. Look, in a market where we can just basically tether our trade to the weekly low, to that candlestick low, and we can risk 3 to make 1 at a 65% probability of profit, that's a trade you got to take. Got to take it. So hopefully this one works out as well. But we're adding another leg in here. We got a little bit of a turn. First position doing well. Get through 612, 613. I'm going to feel even better than I did this morning when I woke up, Mr. Chandler.
I mean, what can you say? That was an amazing win for you guys, man. I mean, and you still got one to go. Are you going to get it in San Antonio or what?
I hope so. Because if it's in New York, and like Jermal, if semis go back to 650 and the Knicks are playing Game 6 in New York, I'm gonna have to get rid of all those positions and sell them so I can buy Knicks tickets.
I know. I know. It's pretty worth the price of admission.
I have a cocktail party to go to on Saturday night at a friend's house, and it's like, do I go to San Antonio instead?
No, you don't want to go to San Antonio. You know you don't.
No, as LeBron said, there's nothing to do there.
Chuck said. What Chuck says about San Antonio, it's hilarious.
Some people can say those things on TV. You and I are the kind of people who cannot. So,
I can say it. I'm just choosing not to.
I mean, technically, we could say it.
I'm 50 tomorrow, Chris. There's the DGAF. You know what I'm saying? Like,
good for you.
Yeah, man.
You look 35.
Thanks, buddy. Appreciate it.
73.95 here, 1.6%. We're taking a little bit of cream off the top here as we're going into the close final 8 minutes of the trading day right now, Jermal. So semiconductors are having their best day. Again, hard to believe, best day since the rally started at the end of March. President Trump calls off strikes. You don't want to call it a taco, call it something else. But oil's down now 3.8%. There's been some pushback by the Iranian government, naturally speaking here, Jermal. Do you find anything interesting to do in oil now after these headlines, or do you feel like what you've been doing is the right path? You mentioned something about a call spread here.
Yeah, and I'm still trying to see if I can get some of these Adobes. I did buy an Adobe calendar, by the way. I bought the 250s. I'm trying to layer in a couple of more. They're pretty cheap, so I'm going to do it. But to your question about oil, where is I was trying to notice it earlier. I couldn't figure out which expiration in oil has the most options, volume at the moment. I was trying to figure out where I'd want to buy the call spread. Thinking through it. Is this something that's going to flare up again in 2 weeks, right? And so that would probably be my idea. But, so you got to really check these CL markets. Some of them can be a little wide. You got to make sure you're in the right term, and then also paying attention to what the oil price is in the term you're in.
Is July 4th a problem for you? Do you think the president's going to want to be, Trump's going to want all attention on himself in D.C. for the 250th, right?
Yeah, so if that being the case, I would go to the July 10. Why not go to because that's Friday, right?
Did we not wait for the Winter Olympics to end for the U.S. to bomb Iran? We talked about that on air in February. The bombing's not going to start until after the Olympics ends.
I would go to July 10 expiration then.
July 10.
Right.
Just keep those things. Yeah. I mean, if you want to be an oil bull, you got to kind of look out into the middle of July right now. They're starting to get a weird calendar compression next week is Juneteenth, and then you get July 4th. So markets are going to be closed. And then Trump has never, for American holidays, has never really gone out on a limb to take attention off of the pomp and circumstance back home. So I think you're right. July 10th is probably the place where you'd want to look if you want to start being an oil bull and fade this. I'm thinking that if you want to do that, though, Jermal, how far can you go? How far is too far? Do we just go to the 1 month? Do we just look for a small play up to $92? 92, 93, a little bit of an oil hedge there. Risk 1 to make 3. 33% probability of profit. I think Jermal froze out on us. I guess we're going to keep going. 5 minutes left to go in the trading day. We're going to take a quick bounce over to volatility here over on VX. We can see how far it's come in, 20.42 after hitting a session high today of 22.3. I mentioned earlier that the VIX 3-month VIX spread closed. It did close earlier this week. In fact, it had flipped over into negative territory at one point. When you take a look at where we were on Tuesday of this week, negative 0.43 points. Today we're back to 1.86, which is not necessarily where we were throughout the duration of the rally in April and May, and that the spread was sitting roughly between 2 and 3.5 at most of the time. But we're starting to get back into a place where the contango is returning to volatility. Now, whether or not this lasts, because it's a headline, thanks to what President Trump was saying, is a totally different story. But for now, the bulls seem to have it here. The top movers today, even after SMCI's faceplant yesterday, it is clawing itself back up 8.6% today. A lot of the names that you're seeing here, some of them may even be tied to SpaceX. SPCX is their ticker, folks, not SPCE. But if you follow Wall Street Bets, this has been one of those names where folks have been piling in because this is the kind of thing that happens around IPOs. Uninformed, less educated, less knowledgeable investors, they make the mistake like this. And so folks are front run that. Maybe it's a good trading idea. Seems to have worked out today, up 28.1%. Your triple levered SMH, SAHILL, sitting up 24%. SanDisk of 14.5. DRAM here at 65. SanDisk is actually going to close out a new all-time high with today's move in the market. Micron up 11.4% today. Western Digital having another good day, 7.86% higher. Pick a name out of the hat. The memory stocks, they came back and they came back hard. Even some of your hardware in the AI infrastructure trade is back on the menu. Your Intel up 9%. Your Dell is sitting up 5.8%. We can go to an HPE, which is even having a good day, up 2.5% here. Producers, if Ilya's around, we could bring him in early, perhaps, to help wind down the show. Maybe not. Whatever works for you. Let's see if any questions in the chat here. Anything of interest? Hey, Frank tells me 15 million SPY options, 10 million Qs, 5 million SPX, but the usual big volume equities are not trading that big. Frank, if you have any other interesting volume stats here, pass them over in the last few minutes. But it's a good volume day. And that's something that we're going to have to pick Ilya's brain about because we're nearly 2 million contracts traded here on ES as we go into the final 90 seconds right now. 7,400 is back on the menu. NASDAQ in here trading still by 3% higher. Overall, for me today, I was tending the crops basically. Just waiting to see if the existing positions that I put on at the start of the week would be able to hold water. I intend on doing that still. At the start of the week on first call, when we had that big washout move lower on Friday, down to more than 2.5% in the S&P, but the VIX stayed below 25. Historically, the next day was always green. We had another one of those days earlier this week, intraday at least, where the market was down more than 2.5% and the VIX was under 25. So perhaps this bounce back is just mechanical. I'm in the 29 days to expiration here. It's at 28,700, 28,800. I plan on sticking through it. We got the bounce that we needed. A little bit more of a reason to add in, as far as I'm concerned. So some new things going on in semis here on last call. Jermal taking on some exposure for Adobe. Those earnings are due at after hours. We're looking about an 8% implied move in a stock that is sitting right now at a 52-week low, trading it at $218.22. The expected move through the end of the week is about $18.50. Other than that, the earnings calendar is fairly quiet for tomorrow morning. I'm taking a look at the little tool that we have over here with the NAS, maybe Lennar later today as well, LEN, but I don't have any exposure here. Friday, tomorrow, Sabine Stillwater Limited. Yeah, that's not a company that we pay much attention to. Next week, we have the Fed meeting, so maybe Friday is a quieter Friday, all things considered. But it's a great day for stocks, 1.6% on the upside. Volatility comes in. The VIX is going to give us a closing print of 1955. Too bad Jermal had to leave, but we're going to bring in a new co-host. Ilya's coming on next for overtime. He's going to relieve this voice. See you in 90 seconds.
We built Tasty Trade's web platform for today's traders. Drill into data, find opportunity, and track the action with hundreds of indicators. Fund your account and start trading right in the app. Join the club. Tasty Trade.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform. being able to see graphically where your profit and loss zones are. Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better. In fact, I've never seen anything like it in any corporation in the United States.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
Taco Thursday. Oh, we're not supposed to say that, Ilya. It's still Thursday, June 11th, 2026. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco. We're here for the next 27 minutes to wind down the trading day. Miraculous trading day, sparked by the president himself calling off another round of strikes on Iran, downed U.S. Apache earlier this week, and U.S. retaliation against the Iranian coastline batteries near the Strait of Hormuz. Got the market a little bit of a tiff, Ilya. Perhaps
are we saying basically
noise.
here that if Knicks win, risk on? Is that what we're saying?
Did you see the stats that I put in the research channel today?
They manage by a point, and this is what happens.
The stock market's green every day after the Knicks win in the NBA Finals this year. So
I'm going to need. Listen, I've been rooting for them, but if this is what they're going to do to my exposure, I'm going to have to reconsider.
This is all the more reason to root for them, given my exposure. So Ilya, you know what makes today interesting?
It's a fascinating day. It's the
best day for semiconductors since the bottom in March, up 6.7%.
Yes.
How does a bear square this? Is this just short covering? Everyone was getting loaded up and bared up the last few days, and then the president pulled and rugged everyone, and so people are just caught flat-footed?
Yes. But also, I think there is something real and material that's occurring here. It's just not what people think it is. I think we started to see it in the CPI data yesterday, and we talked about this on Macro Money yesterday. Go check it out on YouTube or on tastylive.com if you haven't seen it and you're interested in seeing it. I also wrote up a short blog version, written version. So if you don't want to sit through 30 minutes of me unpacking CPI data, you can read it in much more condensed form. That's in the News and Insights part of tastylive.com. We saw it again in PPI today, and it was evidence of demand destruction. Something that's been happening that's interesting is oil hasn't really come down, but break-even rates have started to fall. And that's an interesting set of circumstances, because what that tells you is Number one, the oil shock is already baked in. You could have a deal, not have a deal, end the war, not have the war, whatever. It doesn't matter. From the perspective of the oil shock as driving rates higher, that's it. It's in the mix. Now the question is...
Trump is claiming that Iran approved the deal.
Great. Now... First of all, this isn't the first time.
It's a very strong MOU, a memorandum of understanding.
Of course it is.
To quote Zero Hedge, so the deal is an agreement on how to have a deal.
How could it not be a very strong MOU when the president wants it to be signed? It has to be. I think, the larger issue here is in the first quarter, what we watched was an economy with a diminishing consumer that was being driven by spinning the business investment component of GDP really, really, really quickly. And what you're looking at now is increasing evidence that the consumer is going to retrench further. I think the market is very happy about this because it's looking at bonds go up and it's saying, oh, well, this is a response to this deal. We're going to have inflation go away, but that's not what's going to happen here. What's going to happen here is you're already seeing in the PPI, in the CPI data, that the consumer is abandoning some purchases, in particular, big ticket purchases. In the PPI, take a wild guess here what the biggest squeeze on wholesalers' margins was.
Final energy demand.
Automobile sales. This is not what you want. Well, because people are looking at the price of oil and not buying cars. The other thing that sort of jives with this is what you saw in CPI. Guess which category of goods drove the overall goods component to be a negative contribution to CPI? Used cars and trucks. So we're already seeing the demand destruction. It's in front of us. And so I think the market is looking at this and going, well, okay, how in the world is the Fed supposed to hike rates in this environment? Isn't it a good thing that they won't? And the answer is no, it's not a good thing. Because if the consumer steps back here in a way that dramatically overcooked and overclocked, for that matter, business investment cannot offset, the problem here is recession.
So that's kind of where I'm going to. Is that the trade then? I'm thinking about how many times in history have we seen both TLT and SPY up more than 1% on the same day. It doesn't happen a lot.
No.
Number that I see here on the screen from OddStats, it's happened 59 times in the prior 5,355 trading days, so only about 1.1% of the time. Not that it has any predictive value for what happens to the stock market next. Is that the trade? Now that
I'm increasingly thinking so. I'm increasingly thinking that part of my portfolio that's offsides is being short bonds.
Is being short bonds. Well, I mean, maybe there's a turn coming here. This has been
it could be
the
so.
market's been pinned right between 109.5 and 110. You could see it in ZB here, similar levels. Although ZB has turned here today. This is a nice little bullish engulfing bar, right? Pushing back through the 50-day. We haven't seen a close north of the 50-day in ZB.
Well, and it's at the range top, so it's basically it's getting wedged face first into range resistance, and we're going to have to find out what it does here.
We've closed every session below the 50-day in ZB since March 10th. So today, not quite there. 112 and 23 ticks is
now, by the way,
50-day.
An interesting case in point here is what happened with the ECB overnight. The ECB is looking at an economy that is much, much weaker than the U.S. economy. In fact, looking at the PMIs, it's been shrinking in recent months. And yet the ECB hiked rates. Now, they hiked them unexpectedly. The market did not think this was coming.
Was it? I feel like we've been talking about the possibility of an ECB rate hike in June.
And
for
yet it was
weeks.
not priced in for this meeting.
I guess I haven't seen the pricing. I had gone into June thinking like, okay, so the ECB's hiking this month. Maybe I just haven't checked.
Yeah, it was not priced in for this particular meeting. And yet, here we go.
Well, you would have made money on that. Even if I was like, oh no, the ECB's definitely hiking, I'm going to get long the euro on that. The euro didn't do jack.
Well, and that's and that's exactly the point.
That's the problematic tell. I was talking
that's
about this
exactly
with Liz on
the that's exactly
today.
the point.
That's really alarming
Exactly.
you.
Nail on the head. Exactly. The ECB goes, we're hiking rates. This inflation is out of control. And the market goes, yeah, okay. Sure you are. And the conclusion here is, I can almost hear it in my head. Remember when the ECB hiked rates on the way into the 08 collapse? And top ticked the market perfectly?
Well, they did not do that today because the market's up 1.7% here.
Well,
after
I
hours.
mean, in central bank terms, top ticking the market perfectly in central bank terms is within a policy meeting. So talk about a month.
Draghi did that to the day years back.
It wasn't Draghi. It was Jean-Claude Trichet.
I'm not thinking about the 2008 episode. I'm thinking, what was it? It was sometime in like 2012.
Don't you blame Mario Draghi for this nonsense.
No,
that was a Jean-Claude Trichet.
I have such a specific candlestick in mind in my head. It's a sickness.
This, by the way, folks, is the level of insanity. Chris and I have been watching these currency markets for this long, that we have specific candles in mind.
Can I go back 20 years? Oh, it's only giving me to the start of 2022.
Are you trying to go? You trying to go to the whatever it takes candle?
Yeah. July 23rd.
You see, folks,
2012.
it's a disease.
Here we are. This is the
God, I loved this euro sell-off.
Yeah,
it was still the best trade I've ever made.
So
It's
this
like a 300% year.
This is literally them bottom ticking the low, right? Like he says, we're gonna do whatever it takes to save the currency. And if you're like, okay, the guy with his hands on the economic levers is saying he's going to save the currency,
right? Thank you.
All right, and that's it.
Also, the Sintra Forum is coming up.
Yeah, that'll draw some tension, but the dollar today, though.
That's when he did it, if memory serves.
Big picture, though, for the dollar today, it looked like it was really trying to break out here.
Yes.
We've had this going back years. Support, resistance, basically par. We'll call it 100.
Sure.
Today we get a failure trying to break out.
For a few
We're
days
still
now.
stuck in the range. We've been levitating up here, but the dollar's off, right? It's no longer sell everything. Oil's up. Oil's up. Gold is up. Gold is even up today, Ilya.
So I saw this thing, and you should take it off the daily chart and put it on a 12-hour chart so you can really see, or even a 24-hour chart. But I got out of this today. I booked P&L on this. I was frantically tracking this overnight, and once I saw it get back over that spike low on a 4-hour basis, I covered my shorts in this. Because if we're going to start to see a turn toward, okay, the economic damage here is done, let's gear up for rate cuts for the wrong reasons, this is going to be one heck of a gold bottom.
Yeah, gold, silver have a nice little bounce at levels where maybe they should be bouncing. We have former lows here in silver. We can just take that right like that, pretty clean, right down to March. I don't have any exposure here. These are catching falling knives. That's just not how I trade.
No. I'm not getting long here. I don't think there's that logic yet.
The long-term investor in me has no problem looking at gold and silver pulling back because they're part of just like an allocation that I DCA into every month. A little money goes towards the precious metals no matter where the prices are, in terms of like, how I push capital into the market for the investing side of the portfolio. But for the trade here, maybe this is the low. 67.45 right now. So on the daily chart, that means that we are going to be well clear of the high that we had yesterday, which was 65.89. And in doing so, Ilya, that means that you get a bullish engulfing bar, key reversal down here at the low that you have for March. There's something to work with there, at least trading around it. I'd like to have seen a little bit more volatility come into play to maybe sell at put spread, but even then, I was looking at the options pricing earlier in SI. I don't want to go out there and do that right now at 47 days, like 65, 66.
Yeah.
You know, that's 1-to-1. So to get below the lows, we're going to have to go 61, 62. $2,000 of buying power for risking 2.5 to make 1. Maybe through SLV. Yeah. I don't find SI to be it's not doing it for me right now.
No, I don't think this is in a place where I'm prepared to say that it's ready to go. I'm not prepared to basically conclude that gold has really and truly turned, that silver has really and truly turned, but it wouldn't surprise me if it did. Much like I don't think the bonds have confirmed that they've fully turned, but again, it wouldn't surprise me if they did, because if all of what we're seeing here is the demand destruction that it looks like, then we're going to get back into a rate cut conversation. It'll just be the wrong rate cut conversation. It'll be the recessionary rate cut conversation. And so if that's what it is, then the bearish stock exposure is correct. The bearish Bitcoin exposure is correct. The bearish bond exposure is wrong. And the bearish gold exposure is wrong. And the long dollar exposure is questionable, because then you're looking for the dollar to rally on risk aversion and not much else. We'll see. And here come the Adobe earnings.
Here come the Adobe earnings, $6.62 billion versus $6.45 billion expected. Beat. EPS 5.96 versus 5.60 expected. Beat. They raised their FY26 revenue target to $26.5 to $26.6 billion. Guidance is up.
This is, by the way, the third year that this stock has fallen. It fell last year. It fell the year before. And we're talking about it's down like 20 to 30% a year for the past 3 years. This thing is just absolutely getting demolished.
A bear flag, if I've ever seen one, that lifted off today, and after hours extending now down to 205. I mean, I don't. This is a top line and bottom line beat with a raise to guidance. What more do you want?
I don't know how you be a contrarian in a stock like this. I mean, I know that it's always tempting to go like, okay, I want to be out of consensus. I want to be buying the thing that is unloved and selling the thing that everybody is hype about, because that's where the edge is. That's where the sort of risk reward and the
I think people got that all
the
wrong.
well-positioned kind of opportunity is, the asymmetric opportunity, but I don't know how you do that here.
The asymmetric opportunity, it's like when things are loved versus unloved. It doesn't mean stock top right or bottom right.
Right.
In my view, it's like, what's unloved right now? Banks are unloved. Industrials are unloved. Sectors that aren't touching the AI trade right now, that's unloved. It doesn't mean, so you go into those areas, you get a little bit more asymmetric opportunity, because there's not enough coverage. There's not a lot of coverage. There's maybe not a lot of people trading it. So when something happens, it surprises the market more broadly. Yeah. Whereas how many millions of people, maybe billion people at this point in time, are trading NVIDIA and reacting, and NVIDIA is reflecting the most up-to-date information at any given point in time. But when you go into sectors that don't have all the attention, don't have the volume, you have the chance for the bigger dislocation. So, I mean, that's where we should maybe be fishing right now, Ilya. Mm-hmm. The banks had a pretty good day today. Give them some credit. The banks seem to be breaking out a little bit here. Give them some credit. We'd like to see the high at 53, 52 cleared out. But the banks, no one loves the banks. No one talks about the banks. It's one of the sectors that people don't care anything about. It's bouncing today. In terms of the sector performance, I suppose we can go into that. One of the winners in recent days, as the broader markets were coming off, Staples, a defensive name if there ever was one, that's off. It's one of the few sectors that are off. What's off today? XOP, XLE, IYE.
No, it's a risk on day.
VNQ,
There's no
IYR.
no question here.
No, so your top performers are GDX, GDXJ, SMH, XME, ITB, XTL, XLK.
Because cost of money. I mean, again, look at the bonds, right? The entire song and dance that I've been doing around here is what matters is the cost of money. And then you decide whether you want to take risk or you don't. And then you decide where you want to take the risk. So by the time you start to get to, I want to be long this, or I think that's a better bet, that's like you're already 2 layers of the decision-making process in. So if you start to get into, okay, well, the cost of money is not conducive to me taking risk just in general, well, then I'm not buying anything new. And if the cost of money is really uncomfortable, well, then maybe I'm selling some things. And that's what we've been seeing. So today, the cost of money is significantly improved. Bonds are up. In fact, we've been talking about this. The sell-off that happened earlier this week happened in gold and in stocks. Dollar didn't really go anywhere. Bonds didn't really go anywhere. And so the conversation that I was having yesterday around this was, well, okay, if you want to sell stocks and you want to divest from gold, that looks like a cash out. So but if the bonds aren't moving and oil isn't moving and the dollar isn't moving, it's not inflation getting worse or the Fed looking like it's going to be even more hawkish. It's recession risk.
So what's the next trade then? You're fading this move in stocks?
I'm not touching it right now. I'm plenty deep short calls here. So actually the diminishing...
Where are your strikes?
So the diminishing vol is actually not hurting me all that terribly. I'm in SPY and I've got... I'm short the 744 and the 730 calls.
How much time to expiration? 36?
50 days.
50 days. And so what were the strikes?
So I'm short the 744 and the 730. And I'm covering at 748 and 736.
Mm-hmm.
So, and then it's a similar structure in the Qs. I'm short calls there with, and I have a little bit less time there. There I'm 50. Actually, well, no, I've been sitting in one of them for longer, but it's still 50 days out. I just peeled one on this week, and the other one's been sitting there for 27 days. The one that's the problem is IWM. That expires in 7 days and is a little bit underwater. But because you had this really advantageous setup, the P&L is underwater, but the premium received exceeds that P&L. And so actually the trade's going to make money. So that's sort of the thing I've been banging my fist about all last week going into the Friday sell-off. Is you had this advantageous setup where when you were selling calls, you were receiving better than one-to-one risk reward. So you were essentially locking in a max loss smaller than the premium received. Now, again, I don't believe in free money. I think the market will find a way to take that from you if it so chooses. We've seen negative crude oil futures, for heaven's sakes. Weird things can happen. And so I'm not saying that's a setup for free money. I'm saying it's a setup that's very advantageous. And this IWM expiring is sort of a case in point. The P&L at this point is at a max loss that's smaller than the premium received. Now, it'll be a small winner, but it's locked in. But that's probably the biggest problem. Everything else, the 50-day expiries, I'm sitting on for now. And the reason they're 50 days, of course, is I'm trying to dilute exposure to upfront delta because I'm shorting a market that doesn't like going down. I want all the protection and all the guardrails I can do. But that's why it's ETFs and not futures, even micro futures. That's why it's selling calls with this advantageous setup, et cetera, which, by the way, the market pricing isn't giving you that setup anymore. It's gone. The vols have
the Russell
reset.
Yeah, the Russell here, 50 IVR still has a very big day today. It gets back above former range support, the congestion zone that we had at the end of May going into early June. It bounces again between the 1 month and the 50, just like it did here in mid-May. We've seen a few days down there, but we've now returned back above. Talk about breadth widening out. This is really not a day that's defined by the Mag 7. RSP is up 1.57%, which is not too shabby. This still looks like this is a great looking chart, Ilya. I know you and I have disagreements about placements of inverse head and shoulders patterns, but
I don't think it's a bad looking chart. I just think it's a chart that looks the way it does for bad reasons.
For good reasons. It's going higher.
Well, if you are trading it and not the broader markets, okay, fair enough. But if you're looking at it as an indicator for what's going to happen at the headline index, not so much.
No, and if the Mag 7 are going to continue to struggle, it's only up 1.04% today, so it just goes to show like there's a little bit more breadth spreading out. Breadth has been a problem in this market. It's been an ongoing problem in this market. When you look at the number of stocks setting new highs on a daily basis when the S&P 500 is rallying, you're like, what? Where is everyone? Right? We shared the chart yesterday from JP Morgan. It's the worst that it's been in over a year in terms of the breadth right now. But regardless, Ilya, a market with small caps and the Russell in the position that they're currently in, we got to give credit where credit's due.
Sure.
The crap is rallying. Isn't that we explained the other day? Why in this marketplace do we see often that when you get a little bit of good news, the junk rallies first? It's because all of a sudden the boot comes off of their necks. They were almost dead. They can finally breathe.
Sure. But again, it's the cost of money. The stuff in the Russell is the most cyclically sensitive of the three major indexes.
Okay, so that winds us out to oil because we have 1 minute left. Are you doing anything in oil here today? Are you buying the dip? Jermal wants to buy the dip. He wants to put a call spread on.
I bought the dip yesterday. So I'm not buying anything new here.
This feels like
I basically reloaded at support. I'm just looking to see if we hold it, because when we look at our favorite ETF here, the shipping oil freight ETF, BWET, freight costs are not going anywhere. Market doesn't think that this thing is going to change anything.
CLQ6 still, this right shoulder is north of 94. Ilya, here's my game plan for tonight. Okay, and before we close this out, neckline in this head and shoulders pattern is about $83, $84 in CLQ6. Uptrend from the lows that you have preceding the war to the April 17th low. It's the lows that we had here May 28th. That could be breaking. If we start to see price down here, I think this thing is toast. I'm going to actually kill a bunch of my short put spreads that I have. I'm going to take profits on them. Instead, I'm going to go out to, we'll go to 36 days, 35 days right now. I wouldn't want to go up to 101, 103 again. The risk to reward's not great. What I will do instead, though, is look to the recent right shoulder, which gives you a high near 93.5. So then 94, 95, maybe 94, 96. It's a little bit more appealing. It's 4-1, a little bit worse than that, but it's not an 8-1 anymore. And there could be something to do there. So I'll take profits. We get down below 84 in CLQ6. Take off that spread trade too, which today was a rough day for the spread trade because the Q6 contract's down 380. When you look at the Z6 contract, that is only down 252. But both came in. Ilya, we are unfortunately out of time here on overtime, which is good news for everyone because they won't need to listen to my you have a good Tom Waits impression. I do not. For Ilya Spivak, I'm in Chris Vecchio. Good luck trading. We'll see you tomorrow on air, but you're going to stick around because Ilya's sticking around. He's here with Macro Money coming up next.
See you then, everybody.
thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
Think you know where ball's gonna go? Test your theories with backtesting. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial the DTE, stack the legs, see what survives. Trade what you want, when you want, with Tasty Trade.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform. Being able to see graphically where your profit and loss zones are. Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Is it really turnaround Thursday? Markets recover aggressively across the board. We're going to see what this is all about and whether it has scope to continue. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we are asking ourselves, of course, on a day like today, where the markets, of course, had an explosive sell-off, we are looking now at that sell-off unraveling rapidly. And the question becomes, okay, are we ready to really say that the story has changed? And so we'll go directly to the price action. We'll pick apart the moves that have transpired here and then see what's coming up next. Here's the S&P 500. We can see we had a break of that range that we were looking at yesterday. This was major, major technical damage. And today we come roaring back. Now, it's tempting to say that we've broke back into the range, but of course, this is where we need to be flexible. Support and resistance are never just a line. They're usually an area. And so what we're looking at here is essentially a retest. We're kind of testing back against these lows. And indeed, if we zoom in here a little bit closer, we can see that we're kind of grinding where we were on the way down. So where we came in and stopped to digest before yesterday's breakdown, that's where we are again. Is this a convincing reversal back higher? Well, time will tell. We may see that come tomorrow and say, okay, well, this really was a legitimate reversal, or it may fail. But for the moment, we are back to essentially retesting whether the market really wants this breakdown. It's a similar story in gold, although here the turn is more violent. We end up erasing almost all of yesterday's bar in the process of also erasing the push through this spike low that we had down here. Now, again, the big breakdown in gold was here. So we might rally all the way back into here, find some level of resistance, and this sort of shallower decline resumes from there. So this may yet be just an overshoot, or the bounce to here may yet be a selling opportunity, but certainly the turn here is considerable and has to be taken seriously. Now, what's interesting on the oil front is it still doesn't really go anywhere. And so, tempting though it is, and certainly the financial media have taken this ball and ran with it today, to look at the president having essentially canceled the strikes he was threatening on Iran because he needed them to apparently sign the memorandum of understanding to start the conversation about ending the war. Mind you, this is not a peace deal. This is a document that would say we're going to start talking now. That would ostensibly set the stage for some kind of a peace deal, but who knows? We've gotten to the place as of yesterday where the talking had been dragged out so long that, again, the president was threatening to move things along by bombing there. Well, we've canceled the bombing because apparently we're going to get the progress. Signing of the MOU is apparently imminent. But crude oil doesn't break out of its range. And so the idea that this is some sort of ending of the war trade, or that crude oil is going to magically start to flow through the Strait of Hormuz, even if there is a deal to end the war, which this is not, that's not what the market is showing here. If the market thought it could extrapolate all the way that far, then perhaps it would, but it hasn't. And so, interestingly here, crude oil looks at this and says, yeah, whatever's happening in sentiment is probably not what is the headline explanation. Because whatever this means for the price of energy doesn't seem to mean that the market is prepared to say it means an unclenching of the war trade premium on oil and its inflationary implications. However, the bonds look very interesting indeed. Because as stocks rebound and as gold rallies, bonds do too. And so this whole thing starts to look like a story about the unclenching of interest rates and the idea that maybe the market got ahead of itself when it fully discounted one rate cut or one rate hike rather for the Fed for this year. Maybe that was a bridge too far. When we look at the dollar, we see it continues to hug the top of its range, essentially where it's been oscillating for the better part of a year. This is the peak here from late July going into August last year. And we can see we've rallied back into that range top, and we've been holding there for a few days. The dollar doesn't really make meaningful moves away from this level. It's kind of lower relative to where it was a day or two or three ago, but the breakout is still very much holding, and the overall sort of architecture of the move very much remains. We're just still digesting here to see if we have the wherewithal to break higher beyond this multi-month barrier right here. Now, as far as the data is concerned, we have probably a more potent catalyst, but it's perhaps not the catalyst that people think it might be. We get the producer price index today. That, of course, follows CPI yesterday. And we see that core inflation holds steady. Headline inflation extends higher, as you might have expected against the backdrop of what's been going on here. And so we get a report that's, as far as its overall sort of settings here, does not seem as scary as it might have looked. Now, the month-on-month increase in headline PPI ends up being larger than expected, 1.1% versus 0.7% expected. But the rise in core is a little bit softer, 0.4% versus 0.5% expected. The year-on-year core reading ends up holding steady at 4.9% against expectations of a rise to 5.4%, even as the headline number jumps to 6.5%, just a touch more than expected. The forecast was 6.4%. So we get the kind of fire and fury at the headline, but in particular, looking at the core, the increase is actually a bit less than what was feared. And when we look at the internals, not surprisingly, the part of this that's the most inflationary is on the goods side. And where that's the case, it's energy. We can see that clearly. There is no big shock here. And when we look at the internals, the most striking thing, perhaps, is just how much of an inflation shock we have here. And perhaps the most interesting thing here to note is that these bits right here, residential electric power and residential natural gas, those things that hit consumers the most directly, we're talking about around 4% inflation here, year on year. The reason these look small is because the jump in gasoline, jet fuel, heating oil, and diesel is just astronomical. The price of diesel has doubled. The price of jet fuel has more than doubled. The price of gasoline has almost doubled. And obviously, this is very relevant for consumers. The price of heating oil has almost doubled. And so, or at least is growing at a pace to double year on year, or close to double year on year. So these are astronomical increases in the cost of fuel inputs. And of course, even though this part of it looks much smaller than this, it's because this is so huge. Considering the Fed is targeting 2% inflation, a 4% rise here is not helpful. But of course, a rise of almost 75% year on year here is much more ominous. Now, when we look at the services, the key here was to see if we can find some evidence of spillover, to say, okay, this inflation shock from the war, the energy jump, it's spilling over into some sort of a broader concern about what's going on with inflation in a kind of service sector way. That would be, of course, the kind of thing that would get the Fed concerned. That would be the kind of thing that would be a driver of potential rate hikes. That would be where sort of that fear would start to see evidence. And when we look inside this data, a couple of interesting things emerge. So here, of course, on the service sector side, we already see, for a second month in a row now, it's transportation and warehousing services, so the energy-heavy part of the mix, where we get the impact. And not surprisingly, all across the board, all things that are powered by petrochemicals, we get a lift. So airlines, freight, trucking, all across the board. Now, obviously, it's not a stretch to say that all of this is an input into what's going to be a price that consumers eventually face, because if getting your Amazon package delivered to your door is this much more expensive, well, is that going to impact your consumption? Maybe. Depends what you're buying. And so you get where this becomes a stickier concern. But then when you look at the wholesaler's margins component, you start to really get some eye-catching information, because what you find here is that the place where margins are the most constricted is automobiles and auto parts, and the place where still you get the best margins, not surprisingly, fuels and lubricants retailing. So selling things that are now expensive is, not surprisingly, an attractive proposition. And selling things that are increasingly expensive to use because of the rise in oil is increasingly unattractive, it would seem, because the margins here are clearly declining. So we're looking at wholesalers having to slash their piece of the pie, essentially, in order to protect demand. That is not seemingly the recipe for shielding the consumer from whatever this shock seems to be. Then, of course, we look back at CPI and we find, yes, indeed, this confirms what we saw there. Of course, here the energy shock is the biggest deal, but note, services creeps back up to inflation north of 2%. So we're moving away from the Fed's target now at what is easily the most significant component of consumer inflation. The headline, of course, is at 4, but we can see that half of that is just this. And of course, there's a big component here, almost 1.5 percentage points, that is the energy shock. But this now is the evidence of spillover. And as we showed yesterday, of course, services are the big component here. And transportation services, that is to say things sensitive to the cost of fuel, is the driving force. But even if we look at what's going on inside this core goods situation, what we find is that the reason core goods prices fall is a decline in used cars and trucks. So again, demand destruction. This is, of course, exactly what we end up seeing here, where we see margins for the selling of autos and auto parts are getting squeezed. In other words, the cost of energy, and in particular the cost of fuel, is already hurting sales of expensive, dependent things, of course, cars, very much front and center here in this data. So we seem to be looking at demand destruction directly in front of our face. And so just as we said when we were looking at the core CPI numbers yesterday, we have a pickup in services inflation. It is now at the highest since back in January. We have a decline in goods inflation, but apparently for the wrong reasons, because it's not like the war has unclenched or tariffs have gone away or changed dramatically month to month here. No, this looks like people are actually reducing the demand pull impetus on prices. That is to say, demand is declining. The price shock is already crowding out consumers, is what this suggests. And so when we look at the probabilities for what the Fed will do, we start to see evidence that what we're actually watching here is a decline in rate hike probabilities, but perhaps for the wrong reasons. Now we're looking at about a 60-40 chance of a rate hike at the December meeting. So looking at still better than even odds of a hike, but much lower than the certainty with which we came in on Monday. The markets had this at all but done, close to 100% at the start of this week. And clearly, we're not there anymore. And so with that in mind, we start to look at this and say, okay, well, if this is what we're looking at, and if this is the reason that bonds are up, well, then should we be happy? Is the stock market reading this correctly to say, oh, goody, the cost of money won't be as bad as we feared, so this is a reason to be happy about where things are going? Is that the correct interpretation? And if the reason that the Fed is cutting rates is demand destruction, well, then it's not exactly the thing that an asset class like stocks, which depends on there being consumer uptake, really ought to be cheering for, perhaps. And this, of course, brings us directly to the University of Michigan consumer confidence numbers that are going to be coming at us over the course of the next 24 hours. Now, the expectation here is that we are going to set a further decline here, but not so much as dramatic. So we hit a record low at 44.8 in the last reading. It looks like we're looking for a slight improvement here, largely driven by an improvement in the current conditions component, looking at the forecasts. And if you then look at the expectations for inflation, the one-year inflation outlook becomes the bogey. So needless to say, it's been going up, and that has been a consistent squeeze on sentiment. So we can see, for example, here is the tariffs from last year, and here's the war. We can see when one-year inflation expectations spike here, sentiment declines. And indeed, as it has jumped and then held relatively high, so too sentiment has diminished. Now, again, the markets are looking for this to be a bit of an improvement this go round, perhaps because people are acclimating. But if these numbers on CPI and PPI and the sort of demand destruction that they imply are going to be telling, then there could be a downside surprise here, showing that the consumer is in fact more pessimistic. Wouldn't really be that much of a change considering we're already at record lows, but it would certainly mark a sense that what is going on here is already less about the immediate situation on the ground in the Strait of Hormuz and in the broader Middle East conflict, and more about the damage that's already been done to the economy as a consequence of all of this. And we've been talking about this since yesterday. We can see crude oil is still holding within its range, but these break-even inflation rates baked into the bond market that approximate inflation expectations over the 5 and 10 year tenor here, they've been falling, having rallied with crude oil almost tick for tick, especially the 5-year break-even, into this week. And what that seems to be starting to show is maybe this is less about, again, the immediate implications for the price of oil, which doesn't look to be unclenching in any kind of a meaningful sense at this stage yet, and more about this is going to be a price shock that is already hurting demand. And the lay of the land is, of course, ominous, because already in the first quarter, we saw that investment, in this case, driven mainly by the AI build-out, the construction of data centers at a feverish pace, outpaced consumer spending as a contribution to overall GDP. Now, it wasn't the greatest rebound in GDP to begin with. GDP averaged about 4% in the second and third quarter of last year once the dust settled on the unveiling of those tariffs. But, of course, in the fourth quarter, we had a government shutdown, and GDP got crushed all the way down to just 0.5%. The rebound in the first quarter was only to about 2%, in fact, less than that on second revision here. And consumer spending contributed less than 1% to this rebound, whereas we can see the investment component contributed a bit more. That's, of course, a striking thing, as we've discussed, because investment is only about 14-15% of the economy, whereas consumer spending is 68%. So to have this, a tiny slice of the pie, relatively speaking, contribute more than this, you'd have to have this growing really, really fast, and this slowing. Well, that's, of course, exactly what we saw. Business investment surged and added in excess of 10% annualized rate contribution. So very strong growth. Meanwhile, the consumer retrenched for a second consecutive quarter. And so the natural question then becomes, well, how sustainable is this when you consider that higher input costs from energy, as we just saw, freight, all of those things that are squeezing consumers, well, they're squeezing data center builders in exactly the same way. They need energy as well. They need to get building materials, buy them, and move them to where they construct things. All of the same things that hurt consumers then hurt them in exactly the same way and for exactly the same reasons. So how sustainable is this? Well, if you were to get meaningfully weaker on a part of GDP that's 68% of the total, it really wouldn't take much more weakening to overwhelm even this aggressive pace, especially if it took even just a little bit of a step lower, thanks to this new cost structure. And so we're looking at a situation that understandably then starts to fuel growth concern. So maybe what we're looking at now is something of a handoff where stocks might very well remain hampered, but bonds might be done falling. And so we don't necessarily have the confirmation here yet, because, of course, as we look at these charts, we're still testing the top of the range. We haven't broken out. But if this becomes a breakout, well, then this will become, again, a story about rate cuts, just the wrong rate cuts. And a story about diminishing growth and recession, less so than just a flash in the pan oil shock. So as far as exposure is concerned, and I hear your comments saying that it's difficult to read this only because before I opened these up so you can actually see the trade structure, it's too long of a list and it doesn't fit on the slide anymore. So we'll talk through it and then see if maybe we can figure out some sort of a solution. But I've taken profit on my gold short. That seems to have been wise, considering it was the meat of the portfolio. And we had that dramatic reversal, but I'm still long the dollar. I am still short the bonds, although I might very well be pulling a 360 there if the bonds break out and closing up these shorts and getting long instead, just flipping the position over. I'm still long the drivers of inflation because it doesn't look like anything's unclenched there. So I still have call verticals in natural gas and oil. I'm still outright short these micro futures for the Aussie, the pound, the euro against the dollar. I've got put verticals in TLT and outright puts in IEF. I've got a put vertical in Bitcoin that's still on. And I'm still looking at short call verticals in the stock indexes, the Qs, SPY, and IWM, because again, it doesn't look like the turn has been confirmed so far. But if it is, well, then it'll be time to flip that over too. But we don't have that confirmation yet, so let's see what consumer confidence brings us. And that is macro money for today. As ever, we are here right after overtime. That's a show that I co-host with Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am also writing for the News and Insights portion of tastylive.com and commenting on former Twitter and on Blue Sky at Ilya Spivak. If you're watching this on YouTube, like and subscribe. Macro Money returns next week on Monday. See you there, everybody. Happy trading.
What's up, everyone? Welcome back to the show. This is Tasty Live. My name is Mike. I'm here with Jermal. It is Thursday, and we have kind of an inside update for now, but who cares about the markets? The Knicks won after coming back from, 29 points?
I can't even think about the markets yet. I'm still tripping on last night.